are back. Good morning. You're watching Tasty Live. Jermal, you and I get the co-pilot seats this morning. Liz, Mike, I think even Dr. J, they're all out of office. So people have to listen to me on the Knicks parade day. It's going to be delightful.
It should be, man. I'm sure it's going to be great, man. It's always kind of fun, having had these here a little recently. No small humble brag. Again, not for a basketball team. It's been a long time since that happened. But, the Cubs and more recently, the Cubs was probably the most recent one. Also the Blackhawks. It's always cool, man, being in the city or being around when they have a parade. That's good times, man. So, congrats, bro.
Our request to do the show from the New York Stock Exchange, which just happened to be along the parade route today, was unfortunately turned down.
Of course. That's actually the cool part too. Like that you go by certain stuff, you know what I mean, on the parade. Like that's gotta be dope. I mean,
it's been so long. Canyon of Heroes is actually downtown. A lot of people think that's up in Midtown, but that's actually downtown on Broadway as you make your way past the Wall Street Bowl there.
It's called that for a reason.
Yeah, no, it's gonna be fantastic. I'm very jealous. I may or may not be live streaming random CCTV footage across New York City to see the throngs of my fellow lunatics, fanatics, dare I say?
Yeah.
At 4 a.m., Jermal, the pens started filling up at 4. It's gonna be wild. I'm incredibly jealous that I can't.
You already know. We already know. It's going to be a day, dude. And again, I mean, most people, I think just about everybody at this point, it's a holiday tomorrow. So it's really on.
I screwed up so bad. Why did all of our coworkers have to have surgery at the same time?
I know, right?
What's up with that? Oh, is that a HIPAA violation? Well, Dr. J's tweeting pictures of it.
I know, right? This dude's tweeting pictures and doing drugs he's taking afterwards.
Yeah. It's like, maybe rein that in a little bit. Take one step back.
I couldn't do it, man. I would just be done. I would be done. But Dr. J's got his people. He's got his people his rabid fans. They want to know what's going on with him every second. Even yesterday, because he was off while you guys were on during the Fed, people were like, "What happened to Dr. J? Where is he?" And they knew exactly. Yeah. Some of them knew, like, "Oh, he's getting surgery. He's gonna be all right."
It was pretty obvious. I mean, he has just much better hair than me or Ilya. So you're like, something's off here.
He has some strong hair growing abilities for real, though. Because, I mean, how do you get it to stand up? I mean, he's got to be like early 40s, I think. You know what I mean? Like, it's pretty good.
It's the power of Olive Garden. Jermal, we go over to... we can turn our attention to these charts this morning. We have a good schedule lined up. Forrest Knight from FKX Capital is going to be here shortly to talk about SpaceX and the Fed meeting. Of course, we do have a market rebound overnight. It's definitely not one of those history rhymes but doesn't repeat scenarios, but Trump signed a surrender deal at Versailles yesterday, which for the history buffs out there is a little bit too on the nose. But the market doesn't care about diplomacy. It cares about the actual movement of the flow of oil. And this is one of those big catalysts that's proving to be important for the market overnight. Oil prices are down another 2%. It's the lowest level that we've seen since early March in both crude and Brent. Volatility continues to come out of the market. Traders are hammering the war premium here. And oil is actually starting to move. We've heard reports that VLCCs from Saudi Arabia, Qatari Energy, Chinese ships have been able to transit the straits overnight. So the flow is coming back. That's obviously good news, Jermal. The Iran war is done as a catalyst.
Yeah, it appears so. Again, the trader in me is trying to play for a rebound at some point in mid-July, but for the time being, it appears the war is over, and it appears that oil is fading once again. So I look like I have egg on my face at the moment. I actually have egg on my face, not look like it. But hey, this is what traders do. And again, it's a risk-defined trade, so I'm not really tripping too much. But this week, we've seen some meaningful pullback here, unlike what we've seen since, honestly, going back to mid-May when we first pulled back from 100 and change.
And it's been kind of meandering down here, so maybe we're getting to a point of exhaustion in the sell-off, right? Mm-hmm. Perhaps things are starting to peter out a little bit, and there could be a long entry. I'm going to keep an eye on this during the day today. If oil is able to go back to green, you may have a conversation. We may need to have a conversation about, is this a materially important low that we just hit near the April 17th low across the board? Because if so, that's quite the interesting place maybe to lay out something even like a short iron condor where you can be below the pre-war lows in oil and go maybe above, go into the mid-90s. So Jermal, oil is definitely one of those catalysts today, but we need to talk about semis overnight because that's driving this market rebound here today. I'm not sure if people have taken notice of this yet, but we closed at 623.88 in semis yesterday. Here's the Fed meeting, and we have fully taken that back and then some. 647 right now. We are on the cusp of a new all-time high. Jermal, if semis aren't breaking down, what hope do the bears have for the indexes right now?
Well, it was the one thing that we noted yesterday on last call as we were going into the close. There was a lot of semis that were still positive. It was Intel, it was AMD, it was Marvell, even Qualcomm. They were positive when just about everything else was selling off yesterday.
Intel 131 pre-market, by the way, after a 121 close yesterday.
Yeah, I mean it's still going, folks. For those who thought it was over, it's still going. It's going to be good to talk to Tim Knight. Tim Knight was talking about this was the point where it seemed like the buying was over and it seemed like it was time to fade some semis, but it's strong. So I know he's not very happy about it, I'm sure. But look, these things still have power, and it's not over here. We got earnings in this next week, so we still got a chance for even more upside at some point if it really makes a strong move. But semis are just showing you they still have some strength, and what can you say? I mean, this is I know I have to pay attention to some of my risks that I have on. I got a couple of strangles that have mostly been untested to the upside in the recent pullback, but now it's like, are we heading to new highs? That's where I got to wonder.
You mentioned Micron earnings. Micron earnings come out next Wednesday after the bell. Market cap now north of 1.1 trillion, and certainly adding some here with this pre-market move. Semis are on the way up right now, and for me, the position that I was contending with yesterday when we were talking on first call was whether or not I maintain my long delta exposure in this basket of semi stocks and the Nasdaq in particular. And the line in the sand that I drew here in the Nasdaq, and ultimately these positions are being built up in MNQ so I can build into that full size of an NQ contract. It was whether or not we basically held 30K. It was a swing low that we had here on May 14th. Again, then support the 26th, the 28th, flips over, becomes resistance again in early June. And yesterday we held it. We bounced. So my game plan right now is going to continue to operate around yesterday's low. I think that's an initial place, Jermal, that we can look for today as a zero DTE of sorts. Why not? Yesterday's low comes in just below 30,000. What would a trade around there look? It is the one standard deviation move effectively for today's session. So let's go say 30,150 down to 30,100. I'm not crazy about that risk to reward down here.
Not crazy about that.
Maybe we get a little bit of a pullback, but 82% probability of profit. I'd want to operate around that level right now. So maybe we can find
what
something
about next
else.
week? I mean, what about for Monday?
That's kind of where I'm going here. We can go a little bit further out, because that gives us something within the standard deviation. We'll go 50 points wide here. We're getting closer to 4 to 1 now.
Yeah.
Okay, and that's a little bit more. Let's get this going. Let's get a little something going here in MNQ, because we're building into something right now.
Yeah, it doesn't necessarily make sense for today, but again, I think you're right. Like just doing something around that tradable low and an expiration that's a little bit better is nice.
Right, and I already have the 30,000, 29,900 short put spread here in M&Q on the follow page, but I'm really enjoying the structure here of this market. The technicals seem like they're firm, and yesterday's pullback into that 1 week, 1 month envelope produces a bounce. So we can't give up on this yet. In terms of advanced decliners right now, earlier this week we set a new all-time high in terms of volumes for advancers versus decliners. The market breadth isn't great, but it's there in enough places where we have to entertain the fact that this rally can continue to go. But Jermal, we have a great guest coming up here as we kick off the show today. Forrest Knight of FKX Capital's here to join us to talk about what's going on with SpaceX, what's going on with this market rebound after the Fed meeting, and what's happening with oil here. Joining the show for the first time, Forrest Knight, welcome.
Hi, how's it going, everyone? Can you hear me?
What's up? Yep. What's up, Forrest?
Fantastic. Good morning. Nice to meet all of you.
Good to meet you.
It's great to have you here on tastylive, of course. Forrest, this has been a pretty remarkable rebound overnight. What are you making this tape action here as we look at semis leading into the open?
Yeah, it's a nice bounce personally. So I was streaming yesterday, actually, and my thesis, you can go watch this, is on the internet, was that I was going to be up biased after the bounce. I think on the weekly chart, we're just consolidating. My thesis overall is that we're ranging on the weekly, right? And we're still in this uptrend, not necessarily downside biased unless we get a little bit more proof. I think the market can run hot for quite a bit longer, and we're just in a pretty protracted like consolidation phase. So, yeah, I went long after the bounce. I have some calls that I'm sitting in. We'll see if those work out today. I did pretty well yesterday, but overall, looking for those to go in the money. And yeah, I'm upside biased overall. I think we're going to go at least for yesterday's prior day high. And on NQ, I'm looking for. I trade the volume profile. There's what I call a naked POC, an untested POC at 30,822 and some change. So that's kind of my price target higher for today.
So let's talk about volume profile there for a moment, if you don't mind. It's one of those tools that sounds somewhat complicated until traders realize that's basically where business is done. High volume areas show acceptance, low volume areas show rejection or fast movement. And so that can be more useful than a standard moving average. I'm a momentum guy myself because it shows you where traders actually care. How are you using your volume profiles in real time to supplement your charts?
Absolutely. Great question. So I try to keep it as simple as possible. I've tried a lot of different things overall. I do use the 200 moving average and things like that. Generally, I have a hypothesis, which is that the market reacts where people are. Okay. So it'd be great if there was an indicator that would show us where people are. Well, the first one is the candlesticks. Okay. Candlesticks shows where people are. And then the volume profile shows us how many people are at each price. And so one question I might ask myself is like, okay, what time do most people show up to play the game that is trading? Well, the market open. Most people show up at market open. And then if I said, okay, that's cool. Well, what price are most people interested in? That's where the volume profile comes into play. And it's important if we think about our own trading, right? Like there are certain prices where we freak out and there's certain prices where we get greedy. It's usually where our entry is, our break even, or if we start to go red, or like the other side of the market away from our entry, right? And the volume profile tells us when other traders are going to have those same emotions. And that's really my system in a nutshell. It's just using the volume profile to understand what prices matter more than others.
Yeah, it's clear. I think that your bias is to the upside, it would seem. I'm curious of your trading strategies. What are you into? Do you like to use stocks? Do you like to use futures? I heard you mention a few calls. What all do you like to do?
I started mostly as an options day trader. I trade futures pretty heavily now, day to day. I think of futures as mostly income generation. If you look at my P&L across a year, it's pretty 50-50 between options trading and futures, though, to be honest. Options obviously give you that asymmetric return. So if I have a really good setup, I'll double dip. I might go long and buy calls, for example. I was in a strangle. What day is it? Thursday? I think maybe Monday, Tuesday. I was in a strangle. So the reason that you should play both, in my opinion, is that your risk is very, very different. Okay, futures has essentially uncapped risk. Obviously, you could put a stop. But when you long options, if you long a put, long a call, your maximum loss it goes to zero. Okay. Now, if you don't put a stop on your trade on a futures trade, obviously the index isn't going to go to zero, but it can move enough to wipe you out, which isn't necessarily going to happen when you're longing options. So I play both of them. I think it's wise to. And the way that I play options is essentially first I pick a price target, and then I try to find, depending on, there's a lot of confluence that I'm looking for. I just try to find a strike that I think will slightly go in the money. That's a really simple way of explaining it is, can I get a strike that I think will, give me a nice little appreciation, then maybe a little bit of some gamma action at the end there.
You got a duration that you like the most? I mean, everybody's talking about zero DTEs. I trade them every now and again, but not a whole lot. But I know that's an area everybody loves. I personally like to be anywhere from a 45-day window a little bit further out. I know that works for me. What duration is good for you?
I don't think zeros should be your first order of business. I think that you should start anywhere from 1 to 7. Personally, and I can just tell you that having traded tons of options, some of my biggest, not some of, my actual largest returns playing options have all been like 7 DTE or higher. So there's a story there in the data. I've had great zero DTE trades. Sure. I've had a bunch of them. I've also had a bunch of losses. And that's just the nature of zeros. Theta gets you. If you're wrong, you're wrong. You're very wrong. So just buy yourself some time. I think you can, if you're really confident that the zero is going to play out, get a 3-day contract. Maybe you're wrong. And if you're right, you're still going to make a great return.
Jermal, I run into that problem all the time. I stopped scalping, basically. Just looking at my performance breakdown. Why am I doing this? It's not helping. It's just I'm using capital to tread water. So performance got better once I stopped doing the 0-day stuff. Forrest, I'm curious here, thinking about what you're talking about in terms of, the options, the technicals, the different vehicles you use. I think one of the problems that short-term traders run into is that when they're trying to scalp or operate on these shorter-term time frames, they can get caught in some of these false moves. You get these liquidity sweeps, right, where you don't actually get your breakout here. As someone who's operating even on these shorter-term time frames, how do you tell the difference between a clean breakout and when a liquidity sweep hits the market?
Yeah, you got to define those terms. So I'll define them for you. I tend to trade on the 1 hour and the 4 hours. The 4 hour is my favorite execution time frame. People say that I move pretty slow. 4 hour in the daily chart. A liquidity sweep to me is the simplest way to think of it is a prior day high, prior day low. Okay, if you ignore all other versions of that, and if you try to long prior day lows and if you try to short prior day highs, follow the trend, you're gonna have the makings of like a decent system overall. And the reason for that is when we talk about liquidity, especially if you mix it with the volume profile across, like if you have a fixed range volume profile, say going across the past week, you're trading the day, and you try to find confluence with a major high value node on the volume profile with a prior day high or low sweep. And so when we say liquidity sweep, what we're actually saying is we have cleaned up, or the price has moved across where there is a lot of participation. Okay, and the reason that is important is because participation is a magnet. So if I'm going to speculate in the future direction of a market, I probably want to make sure that if I'm betting that way, that there isn't a magnet going the other way. That's how I think about it very simply. So if I want to bet up, I don't want a magnet that's pulling me down. So we want to sweep everything on the downside before we go long. Very simple. And so that's what I mean by liquidity sweeps. Literally just think of prior day lows and highs. That's my approach, at least. Obviously, other people have their versions of that as well.
So how do you manage risk around that then? Like, what's your risk management philosophy? What do you keep into your, P&L on every day? I see a lot of folks are saying I risk 5% per trade, which to me seems asinine. We have a lot of the folks that listen to us. It's usually around 0.25%, 0.5%, 1% on any given trade at the high end.
I think it's a tiered system. If you're a newbie, I think you should have fixed risk, right? Mm-hmm. Maybe like 10, 20, 30 points. The ATR right now is not going to support a 20-point stop. I'll tell you that right now. Right. We're having like back-to-back 5,000-point days. So that's the problem with fixed risk. As you develop as a trader, let's say intermediate, you should always be using dynamic risk, in my opinion, right? If you're playing poker, I don't know if you guys play poker, you should not be betting the same on every hand. It doesn't make sense. When you're dealt a good hand, you have to size up. You have to. And then the amount that you allot the trade to breathe should also be dynamic. My philosophy on trades is that you should trade the thesis. There is a price where your trade doesn't make sense anymore, where the thing that you think is going to happen is narratively wrong. And unless that happens, you should stay in the trade. So if you trade your P&L, if your stop is like, well, I don't want to lose more than 50 points, but technically it could go maybe another, maybe I need 80 points of drawdown. I just really don't like that. It's like, well, there's two choices. One, get a better entry next time, since you apparently know where the price was going to go anyways, which is a big problem people have. One of the pieces of advice I guess is enter on your stop. If you're constantly getting barely stopped out, you have this intuition about what the market's going to do. Just change your entry to where your stop is. And then two, just sit in the drawdown. Like, if you know what's going to happen, you have to sit in it, but you can't trade your P&L. It doesn't matter if you're trading 0.5% risk. If you trade 0.5% risk every trade and then you lose every trade, you're not a good risk manager. You're just losing money a little slower than other people. Like, at the end of the day, you have to actually have trade thesis that work in your favor. That's the short version of that speech.
I agree completely.
Last question here. Big week for SpaceX. New options that came on Tuesday. Lots of trading going on there. You got anything going on? Are you interested at all?
I wish I had something for you. My answer on SpaceX, I have not played it at all. I had an opportunity to invest in SpaceX in real life. We'll go down that road years ago. Didn't. But I'm going to let it settle. It's on a run right now. I'm going to let it settle. I think that SpaceX is going to be another like ticker of the day, like in play very often. It's an Elon Musk ticker, right? So I think just like Tesla, it'll be flavor of the week every other week. I think it's going to be a great ticker to speculate on like constantly. But for now, I'm sitting out. I I don't want to deal with Ivy Crush or anything like that on the option side, and I'm not really interested in buying shares right now. So just gonna watch, and I'll get in maybe a month or so and see what's happening.
I hear you.
He's been Forrest Knight, FKX Capital. Forrest, thanks for joining us today on Tasty Live. We'll hopefully get you back again soon.
Sure, thank you. Thanks for having me.
Jermal, we're continuing to keep this train moving here. S&P 500 is still up this morning, 75.60 here now in the market. Nice little 66-point bounce coming together. Nasdaq's up 1.67%, 30,500. Volatility continue to come in pre-market, 1709 implied open for the VIX. That's going to give us a VIX futures, volatility futures here in the July expiry back down to 1860 right now. Jermal, this market's not really freaking out about anything this morning. We're going back to maybe summer trading, steady float higher. Does that sound fun?
I mean, it kind of seems like yesterday was just one of those situations, almost like I described, where you had a lot of things coming together. The Fed meeting, we had a VIX expiration. Obviously, we got expiration today, by the way, June expiration. And I think it was just a lot of rearranging, a lot of paper being pushed around yesterday after the meeting, and it just led to a few things being sold off. But semis held in there. That was the one thing we noted, and so you knew it wasn't a real sell-off if those weren't being sold off, because those have been the biggest things going on in the market more recently. It is notable, though, again, that yesterday was the day that SpaceX had its first red bar. I think that was definitely something, because it's not going up forever. It definitely needed a day of red, and that's one of the things I think that was notable about yesterday. But overall, it doesn't seem like there was a whole lot to really worry about after yesterday's move.
Jermal, it's worth reminding folks here as we get ready and get into the morning show, you can send us your questions, research@tastylive.com, research@tastylive.com. We have confirm and send coming up in just a little bit, maybe over an hour from now. But get your questions in. Jermal and I will answer them and talk about what you're seeing in these markets. I think if we're not already there already, we can go back to the charts there. I want to take a look at semiconductors here because it's a really nice little structure that we maybe have some levels to work around this morning. I want to see if we can clear out the high that we got here on the 16th. Why? In doing so, it would validate that we're really resuming what's been an uptrend. We had a bullish falling wedge here. We broke out. We came back into a former swing level. And then that's where the rally started to resume, Jermal. So I'm thinking about what a short put spread around, we'll go to 43 days here, but around those recent lows, around 615, 612, 610, something like that. Decent risk to reward. Really like the idea of risking 3 to make 2, around a 60% probability of profit. So as we get into the open here, there's some trades that I have lined up on my little watch list right now, given this rebound and strength that came together overnight, particularly in the tech sector.
Those are good, little trades to have layered out here and there because they just work silently in the background. You're selling vol at the downside at an area where it's kind of around that the expected move, and so it's not too close as long as we don't have this big blow off sell off or a huge upside. Whether you're doing an expected move on the upside, they're kind of out of the way, and so you don't think about them as much, and they just kind of work silently in the background on your P&L day in day out.
What are you looking at this morning here as we get ready for a swing through the top of the hour and get ready for the U.S. Open?
Looking at, I would imagine the dollar has faded. That was the other thing yesterday. The 2-year yields moved really big, and so did the dollar yesterday. So I don't imagine there's follow through happening. Obviously, right now, since we're moving the way that we are, and the correlation.
Believe it or not, that's not the case. The dollar's actually still going up. It's having a very strong day.
Ooh. Well, that's one of the reasons I was curious. I was wondering if there was going to be some follow through there. Because look, at the end of the day, we know inflation is rising higher. And we know that it seemed as though yesterday after Chairman Warsh spoke that the Fed is acknowledging that there's some inflation. Inflation is an issue. We might have to raise rates a couple of times this year. And the dollar absolutely took off yesterday, which obviously led to a lot of the sell-off. Didn't hurt semis, though, but obviously led to a lot of the sell-off. So that's the main thing I'm keeping an eye on. I don't have any trades planned for this, but it's definitely something to watch.
The dollar may be putting in a major bottom. I mean, we need to just acknowledge that. This is a weekly chart going all the way back to 2022, right around par, we'll call it 100.
Yep.
Been major support and resistance. And we spent the better part of the last year, more than the year, in fact, going back to April, underneath that 100 level. this may be rounding out right now. So yes, the Fed did what they did yesterday and stocks are back up, which is fantastic news. But the dollar's giving you a different story here, that maybe rate differentials are going to be moving more favorably towards the greenback. I think that we're going to have some interesting opportunities in the currency space coming up around the corner. What I am watching most, though, is the yen right now. Are we going to break the Bank of Japan? I mean, legitimately, 161 almost in dollar yen.
We got our yen call.
They have been defending this. They have been defending this. Absolutely defending this.
Yeah.
And now it looks like it's going to slip through. So like we've cleared Iran now. What are the next big catalysts on like around the corner? Micron earnings, and this is kind of the window with which you'd have some of these interventions in place. So the FX space today, Jermal, not confirming what we're seeing in stocks. I find it to be very fascinating. I would also point to the fact that gold is lower here, Jermal. Gold trading down another 2.7% in today's session. So yeah, stocks rebounded from the lows, but gold has not. Dollar has not changed course. That in and of itself may be a sign that because it's triple witching today, because we have Juneteenth tomorrow and the calendar's pulled forward, today's tape may be a little bit more mechanical and flow-driven than necessarily tethered to what's happening in a broader cross-asset perspective.
Yeah, that's what it's starting to feel like. And you know what, Chris? I know you reminded the people about sending questions to the research, which is, it's cool because the research team is starting to create some really awesome stuff. But also a quick reminder, anybody just put some questions in the YouTube chat. And at some point or another, we'll accept it there as well. So definitely put it in there.
Definitely do that. 75.60 here in ES Jermal, 68 points higher to the upside. We want to talk about that flow problem here today. Because of this triple witching dynamic that's making its way through the market. So with Juneteenth tomorrow, it's a federal holiday. We now have single stock options, equity options, index options. They're all expiring here today. And this dealer hedging, the future rolls, everything, all this flow can have very little to do with today's headlines. So while, yes, we are having a stock market bounce, and that's in our favor, I think, for many of us that have been playing this on the long delta side right now, we just need to be mindful of the context in which this is occurring. Yeah.
In what way? You mean just the economy?
No, I mean, the stocks are up on a triple witching day, and gold and the dollar and yields aren't confirming it. So.
Oh, yeah. I mean, again, I think these last 2 days were a little idiosyncratic, right? I mean, it's kind of showing that. I mean, compared to what we had been seeing over the previous week or so, these 2 days are a little bit different. So, and I think we're going to see a little bit more why. I'm really interested in what's going to happen on the other side of this weekend, right? Is there going to be weekend risk? Is there going to be more talk or more headlines surrounding the war all of a sudden again after the weekend is over? I'm curious about that.
Well, we can see stocks are trying to turn the corner. I mean, I don't know if we're going to get the risk coming here moving forward. Trump yesterday himself conceded that we were at inventory lows. We were about to run out of oil in the next 4 weeks. So we need to restock our reserves. Period. End of story. We can't go back in. So 60 days to restock reserves, rearm, I guess, and then we'll see where we are. But I'm not so concerned. I feel like we have now a window here. And listen, Trump wants to do a lot of stuff in D.C. for, America's 250th birthday. There's now a window where he can focus more on domestic stuff and move away from the war. And gas prices are falling here, which is the most important. Gas futures the past few days have really come in, which I think is the most important part. It went from 360 down to 290. That's big relief at the pump. That's coming around the corner.
I still got to say, though, Chris, let's just look at these IVRs, though, right here on the left-hand side. When you look at ES, 46, you look at NQ, 77, the Dow, the Russell, I mean, they're all above 30, right? Obviously, Bitcoin and ETH are not because nobody's really interested in them. We've mentioned plenty of times we make the content and it's not happening because there's no interest. And that's okay. It really is. We look at those currencies. Vol is up and could be climbing higher at some point, given the way that the dollar is moving. Crude oil has come in a whole lot, but still sitting close, right? This is the reason I'm interested in having the call spread, because if things get crazy again, you talked about inventories, and it bounces, vol could be back in there. Gold, obviously, vol is elevated. So vols are high is my point. Even though we have a VIX in the teens, we have a fantastic market, and I think there's a lot to keep an eye on. But there's definitely still some volatility in this market.
There's still a good deal of volatility in this market across the board. The VIX at 16 or 17, I think, may may or less mask the story of what's happening in a lot of these other spaces. But the good news, I suppose, amongst that volatility quip, there's still not a lot of volatility in the long end of the curve. And so when Treasury vol creeps up, that's really the alarm bell. But right now, 16 IVR in ZN and ZB had a negative IVR yesterday, back to 1.3. Wow. Vol is really, really low. That means volatility 1.3 percentile over the past year. But we're going to move away from bonds because those are boring. There's a reason why the vols are low, and certainly enough out of both of us. Why don't we bring on Errol here so he can give us the lay of the land as we take perhaps a shorter-term perspective on this market. Errol, welcome to the show.
Good morning, guys. Good morning, Jermal. Good morning, Chris. How are we doing today?
Fantastic, man. What's going on?
Good, good. No, I heard Chris talking about maybe some relief around the pump. That sounds attractive right now. So looking forward to see some of those prices slide a little bit. I know I haven't been driving too much since I've been in the city, but I can only imagine a little bit of the grief going to the pump every single week, seeing these prices. When you're not driving as much, you kind of forget about some of these increased prices at the pump. So with that being said, we got triple witching today. I know yesterday we had that FOMC announcement, which caused us to sell off a little bit lower in the market. I think NASDAQ hit a low of like 29,923, putting in the low for the week. But one thing that's going to be really interesting too, as well as, last week we had a gap up, coming in from Friday to Sunday morning, and we got a gap still sitting below. So we're just going to keep eyes on that. I know today's going to be triple witching, so we're not really going to be expecting anything too crazy. It's looking like the market is turning around now here. We got a Tuesday high sitting at around 30,969. We're currently trading at 30,498. So not really expecting too much of a large directional move. And honestly, for myself, if anything doesn't become too attractive in terms of opportunity, most likely going to be sitting on our hands. I know it's a shorter week as well. Got a 3-day weekend, market closed tomorrow, and then again, triple witching. So it'll be interesting just to see how price moves out of the gate. I don't know if we're going to have a choppy day today or if it's going to be a little bit more directional. How do you guys kind of perceive these triple witching days, and what's been your guys' experience?
Well, first of all, you have to excuse Chris. He's a little giddy. He's very happy today. His Knicks are getting a parade. I mean, the city is just oozing with green slime. Now, I got to tell you, this almost reminds me of a movie back in the day. It's a little before your time, Errol, but Ghostbusters 2, where the city was just very angry and they had positive slime. Positive slime has been just hit. Everybody's been hit with it in New York. Okay, they're very happy. Okay. You've never seen New Yorkers this nice. You really have never seen it. It's amazing.
I will say it's nice to see a smile on Chris's face over the last 30 days.
Permanent smile. Yeah.
With that being said,
smile.
Chris, what are your plans? You going to check out some of that New York parade? You're going to be watching from the TV channels and just check out what's going on? How are you basking in the?
I'm not watching it right now. I don't know what kind of question that is, Errol.
It's not happening yet.
I don't have multiple monitors up right
this
here.
Very moment.
Yeah.
That's what happens. Looking to the left. That's where I keep my second monitor. Okay.
There you go. I see you side-eyeing it. Don't get me wrong. I see you.
Yeah.
He's just looking at pictures of the governor's mansion or whatever. It's the city hall as it's happening, whatever. I tell you today, the one thing I want to I'm curious about is if the market is going to hold on to these gains. That's the one thing, right? If for some reason we don't, it could end up being a very ugly day. But I'm certainly not talking my book in that way. It's quite the opposite. I mean, I'm long delta, so I certainly am enjoying this bounce back from yesterday's sell-off. So I think that's the big thing. Is the market going to hold on to this? We just noted like the dollars is continuing its move from yesterday's Fed meeting. So that could be one of the things that derails the rally here. And if for some reason oil turns around, that double-edged sword, which would be weird if those two started moving together, that would be kind of interesting. Yeah. But I think it's one of those. It's a market, honestly, that I think we've seen a lot of the same thing for the last couple of weeks, and every now and again we're going to see little things happen that sort of changes things around. For example, now we're starting to see the dollar go. At what point does NASDAQ start to care about that? Do we see this rotation into some of these consumer staple names or even utilities like Sahil from the research team was talking about the other day? Is there going to be a rotation that happens at some point? Remember a couple of years ago, I think it was 2 years ago, where we had that yen rotation one day, and it was a one-day, August 5th, I think, nasty rotation. Are we going to get something like that over the next couple of weeks into the summer? Because we can get lulled to sleep sometimes in the summer, even though these summers have been a lot more active than years past. I mean, basically since COVID, every summer we expect them to be sleepy, and they really haven't. So I'm not exactly falling asleep yet in this summer.
I hear you. What are your thoughts on triple witching, Chris? What's been your experience in terms of volume and in terms of opportunity? Has this kind of been a day where you kind of sit sidelined just to see how the market digests everything, especially considering we had the interest rate decision yesterday. How do you perceive today, especially going into a 3-day weekend?
I mean, I don't know how serious you can take the price action in stocks on a day of triple witching, because so much of it is flow driven and it's mechanical, and there's not another catalyst right now on the calendar for us to contend with to help push things in a natural natural direction of price discovery. Is what I'm trying to say. So I don't read too much into it. That's the bigger picture. I don't read too much into what's happening with stocks. What I do look for is what's happening in everything else, the constellation of other assets, though. Because if you get a day where oil's down and the dollar's down and yields are down and gold's up, whatever's happening in triple witching, you're probably going to look at a rebounded stocks on the other side of it. So it's curious today. Jamal's already pointed this out. The dollar is continuing to run.
Sure.
If you're looking at rate differentials right now between the dollar and other major currencies, they're suggesting a much stronger U.S. dollar is necessary moving forward, which, again, perhaps more relief in the energy front for some individuals, helps tamp down inflation here a little bit more. But either way, today's setup, NASDAQ's bumping into the highs that we had around the FOMC meeting yesterday. It's stalling there. That's now the clear next level. We were talking with our prior guest, Forrest tonight, about liquidity sweeps, and you really want to punch through yesterday's high around the FOMC before you feel comfortable now making any further bullish bets. So let's see where we go from here. If you picked up pieces yesterday, if you sold put spreads yesterday on the dip or held through the dip, as I did yesterday, now this is kind of the juncture where if we can get through here, we're leveling up. And then maybe the flows help carry us up to a new set of highs. But if we can't punch through yesterday's high and triple witching's in front of us, keep in mind maybe there's a reason why that level's not breaking. No. Don't put your horses before the cart. Cart before the horse. Absolutely put the horses before the cart.
I know we've seen a pretty aggressive reversal yesterday again at the lows on NASDAQ, and that was pretty close to that gap up we had coming into this week, from Friday to Sunday again. So I don't know if prices will make it back down there, but if they do, it'll be interesting just to see how, investors, attack those lower prices and kind of how they gauge, fear and greed at those levels. But the sharp reversal after that sell-off, after the FOMC was announced, is definitely not to be understated. So great points there, Chris. I'm curious to see how the market will respond. I'm not going to try to force my thesis or opinion onto the market. Just going to wait for it to show me what it wants to do there, and then make some more conclusive decisions there. But it's been a little of a boring. I don't want to say boring. A little bit more of a slower week, especially on the scalping side over here. So I'm not going to try and force anything today, considering it is a shorter week in the market once again. But gold seems to be pretty volatile lately as well. I know we got a little bit of a rebound on some of the metals yesterday. And then overnight, coming into this morning's market open, it's looking like we're selling back off down to the lows. So the metals definitely have the volatility, and sliding further to the downside. Looks like there's more air to squeeze out of those ones.
Go ahead, Jamal.
I've been looking at it. I'm starting to maybe get interested in gold at some point. I've been hands off for the better part of, I don't know, 2 months maybe, gold and silver. But given this move, it's starting to get my attention at these areas.
I shorted it yesterday around the FOMC meeting. Just going over to the 4-hour chart here.
There we go.
This nice little rebound. Let's go. Let's just get rid of you here real quick. Okay, so we had this nice little rebound up into 4,400 yesterday, former swing low that we had on May 27th, and then we started to sell off. And once we started eclipsing the low that we had here on, in the 4-hour chart yesterday preceding the Fed, I went over into 10Z just to sprinkle something in a little bit, right? Just to see if I could get a little bit of action in here, and it's working out really neatly right now. So I find this curious that stocks are up, but gold is still down. Gold isn't breaking its lows from yesterday, whereas the NASDAQ is trying to break its highs from yesterday. Mm-hmm. And that might be the reason, that just could be a little tell here, given how the market's moving right now. I don't want to be short gold anymore, even through something like 10Z. Even it's a small contract. But I don't want that position on, because it means the market's going to work against me. So I'm watching this keenly right now. If the NASDAQ breaches the FOMC high and trades through there on a sustained basis, give me a few minutes, gold's probably going to reverse to the upside here, and I don't want to be short anymore. So I'm going to have to take that off.
No, absolutely. The ranges have definitely been there. So it's nice to see a little bit more opportunity to the upside and downside. Anything else catching your eye right now, Chris, while you're on those charts?
Silver, I'd like to buy in again at some point, but
here we go. Here we go.
Wait, what do you mean? Here we go. What lure am I missing? What do we mean? Here we go?
You don't talk to this guy as much as I do. This guy loves silver. I mean, he absolutely loves it.
Okay,
I was on Jermal's case years ago when I was in the 20s.
Yeah.
Okay, my next question was, is it gold or silver for you? To Jermal's point he's making.
It's been answered.
It's been answered, absolutely.
Last year it was silver. This year I've been staying away from the dang thing. I've been taking a few shots here or there, and they all have come up snake eyes.
Yeah.
So I'm really not keen on doing anything until I get some building blocks in place.
They had a nasty divorce.
Okay.
We
Chris
did.
and silver.
The good news is I took most of the assets in January.
Okay.
Exactly, he did. That's the thing. He did. He took most of the assets.
You guys aren't on speaking terms or anything like that. I mean, I really do like.
No,
I mean, Chris
Errol,
is fine with silver. It's silver that's the one that has the problem.
Okay.
I did something. I remember talking with Nick and Jermal. I talked with you about this, but I was really feeling on tilt in silver, and
Right.
because I had been running it up, I wanted to de-stupid my portfolio. So I took a chunk of it out of my winnings out, and it's like I'm putting this aside for my kids.
There we go.
Like for college fund. So like it's out of my hands. That way I don't blow this up and throw away all my winnings. And sure enough, the little that I did keep around, I did blow up. So de-stupefying.
Smart man. No, I'm hoping that the metals can actually rally a little bit more here. I would love a surprise rally in the metals just to be able to get a little bit more short delta on. I've been trading these metals of the thesis that the top has been put in, especially after that parabolic run both the metals had went on. So anytime we get some decent pops to the upside, I like to get on a little bit of short delta and ride the wave back down. But with us coming back down into half of that range that we kind of bull ran into, I don't like the risk reward too much, but I'm not much of the metals trader. But again, if we do get like a 90 silver for whatever reason, or gold, at some previous levels, it'll be nice to get some short delta in there. But for now, I'm gonna have to miss the boat. But I would love to hear more about your trades because I'll live vicariously through you on some of these metal products.
They're not great stories.
Look, the last thing I'll say about them,
calls and them printing.
Yeah, the last thing I'll say about them is I think we have Q come on every morning from the trade desk and shows all the names, and a lot of times it's been 4-letter names, and that's why we haven't been trading gold and silver that much because there's just not as sure there's volume, but it's not the same way. And so let's just wait until they pop back up into that. They did pop up in that list a couple of days ago. I remember gold and silver were in there. Let's just wait till that, right? We just wait till where all the volume is going there. Right now, it's all in semis, and that's where we're mostly trading.
Yeah.
I like to keep it simple when it comes to gold and silver. I want positive technical momentum. I want rising volatility. That's not the case right now.
Yeah.
You look at the prices are below their 1 week, 1 month, 50-day moving averages. The 1 week is below the 1 month, which is below the 50. All have negative slopes, negative rates of change. Volatility is staying down. And real yields are going up. And I think that's the most important thing right now in this whole dynamic. Gold last year was real yields were sinking. Dollar was going, I mean, it was a mess. Now real yields are shooting higher. If you were to look at a real yield model compared for like the euro dollar real yields, euro dollar should be probably trading closer to 113 or 114. It's up at 116 still, 115 or so. And so like there is this pressure in the system that is working against gold, is working against silver. And you want to sprinkle in the Iran war? If you're a central bank or a sovereign and you have an additional marginal dollar to spend, are you using it to buy gold for your reserves or using it to buy oil to refill your SPR? You got to buy oil right now. So gold to me is a really difficult story. I don't know the story that tells me gold's going up in 2026.
I hear you.
Yeah, I'm with Chris on that one too. I like to play gold and silver to the upside. It just is what it is. I like to play them the long convexity way, buying some calls or something when they're making those moves. That's what I did 15 years ago. That's what I did more recently. And until they get so high that the vol is so ridiculous like we've never seen, and then I just put on a short strangle in SLV and ride them all the way down. So that's kind of the way I like to play them. And I think until I get that kind of scenario again, when there's an upside play for gold and silver, I'll do that. But I don't know. To Chris's point, you're starting to see real yields rise. You're seeing the dollar doing what it's doing. And obviously we're in an environment where things are kind of fascinating given what the Fed said yesterday. So I don't know if that bodes well for upside in gold and silver.
I hear you. Well, let me ask you this as we shift gears here, guys. You guys think the top is in gold and silver?
Like forever?
No, just for the year. After that parabolic run we went on.
I think so.
Yeah, that sell off to the downside. Awesome. It was a pleasure hanging out with you guys today. I know to now bring up silver quite often, and I feel good to be a part of the lure of these stories now. So, thank you guys.
It It was a great trade, but there are better trades ahead, I'd like to think. Let's focus on those, right?
100%.
Jermal, Errol, we're done here. Errol, thanks for joining us for the show. We'll see you in a little bit. Jermal, we're about, 15 minutes away from the open? Let's just give a brief check on where the futures stand right now. Stocks are holding on to their gains. 75, 62, S&P 500 up 70 points right now. 524 points to the upside for the NASDAQ, trying to break through the FOMC highs from yesterday, around 30,500 here. Your Dow Jones, which was a leader yesterday, is still up 0.5%. And your Russell 2000.
Awesome, thank you.
We have 2981 here, Jermal. This is getting pretty darn close to a new all-time closing high. The closing high that we had just a few days ago comes in at 2988. So stocks are up. You and I have been taking issue all morning, though, with the cross-asset divergence here. So how are we going to deal with this over the course of the morning? Are we looking for stocks to come back in, or are we looking for other things to confirm the story that stocks have been telling us overnight?
I think we're looking for signs of change, honestly. Is this just it's hard to call this a dead cat bounce because obviously it's not like we're on lows or we're on a bear market or anything, but is this just a reflexive action after yesterday's move to buy the dip and buy it in semis? And we got some strong news in semis today as well. Something from Intel helping push those higher. Is this just that, or is this a situation where we're going to start to see, like I said, that rotation? I'm keeping an eye on it, man. I mean, the Walmarts, the Costcos of the world, they've been very unloved. Some of those consumer staples. I did add to a Costco position yesterday. I just want to be ready because I can tell when I look at my portfolio on days like yesterday, I'm like, man, I have a lot of semi exposure. Like I do. You know what I mean? And so I think those days happen to help you kind of see where your portfolio really is. Those correlation to kind of, although yesterday really wasn't a correlation of one. Like I said, those semis were still up, but I think it's just good to keep an eye on how exposed you are to the market, to these semis. There will one day be a very big sell-off. We've already seen a couple of them. And so I think you don't want to be too heavily in those. I think you do want to have a couple of other things in the portfolio, whether it's you decide to get in metals, whether you decide to get in the consumer staples or whatever. So I'm keeping an eye on, I'm just talking my book here, honestly. I'm paying attention to how my portfolio is going to move after this after the sell-off yesterday, and do we hold on to these gains? And, I did sell another strangle. I had the MNQ strangle for a while. I sold an MES strangle as well now, and a little bit on the long delta side with it. I'll tell you my strikes. This was because, again, I pointed out the vols in these products right now. ES, NQ, these equity products, the vol is still fairly elevated. Even though we're basically removed from the war, if you will, it seems like, but they're still up there. I sold a little bit in the money. The 7,600 put versus
TTs.
This is in July. 7,600 put versus 7,700 call, and this is short that call. Short that call. Yep, and then short the 7,600 put. So yeah, it is a little bit in the money. I'm aware. This is kind of the similar setup I've had for the MNQ trade, long trade, similar that Mike Butler has, and just getting some a little bit longer delta here. I like to be a little longer delta in these things. It allows me to be a lot more decisive. If we do have a sell-off of meaningful, then I can go ahead and sell a future against it if I'm so worried. But for the most part, I think the tilt has been higher in the market, right, until otherwise noted. And there's vol in here, and this thing is very liquid and it moves around a lot. And at one point in time, I would have been really nervous to have a position like this, but it's the market, and the market moves around quite a bit, and there's a lot of volatility in this product, and it's very digestible in the MES, right? And so, 1,900 buying power, right? Like, it's not crazy. And again, you can structure it any way you want. You could make it an actual strangle within the sort of bracketing the expected move. I've found that kind of getting a meteor strangle and being sort of closer to at the money has worked out well. I've done the same thing in MNQ, got so much credits. I got $3,000 worth of credits in that. This has been my best trade so far. I decided to kind of almost double down and do a similar trade.
Jermal, I'm thinking about MES here. It's actually a fantastic product beyond the fact that it's it's smaller ES, but you actually have listed options here. And they are liquid. It's not as liquid as ES, of course. You're not going to find the same levels of open interest that you will, particularly when you go out into the weekly contracts. But the markets are still tight. Tight bid-ask spreads, easy execution. If you're looking to, MES to me is perfect way to get away from SPY and move over into futures trading. But I know that PDT's gone and people may do things differently now. Either way, though, this is really, I really like where you're going with this here. I was looking at the analysis curve, by the way, which is a very useful tool here that we can put up onto. And
I mean, those two are my core positions now. The MNQ strangle and the MES strangle. Those are my core positions in the book, and everything else trades around that.
There you have it. I'm still leaning short the put spreads here in the NASDAQ right now. It's been working out the past few days. We're going to figure out if that's going to work out more today. But we're going to have to figure that out after a brief break. We're going to get ready for the opening bell in a few minutes' time. So we'll be back in about 3 minutes, and then we'll get into the opening bell. Jermal, we have a lot of good programming coming up here. We're going to go through some of those questions that folks have been sending over in the chat. We're getting those questions for confirm and send as well. Keep them coming in, please. We want more of them. We're likewise going to have Tim Knight coming up soon. Tom Preston. Gad will be here from Tasty Research. Gus is going to be here. So lots of great content coming up for you this morning. We'll be back in about 3 minutes. You're watching Tasty Live.
Clip thy waxen wings, thou economic Icarus. Discard these feathery adornments, thy flight's too vigorous. Rather, garb thyself with the soft fur of the bear, and dwell in low burrows of the valley fair. Forsake thy previous highs and perilous summit, for lo, I am short, so I must needs thee plummet. O market, I implore thee, make no high. Like some comic Fozzie, unclip thy bow tie. If thou dost tumble, I shall offer thee up a succulent hoagie. So, ye markets, remain as bearish as beloved Yogi. Follow thee the lead of Kipling's Baloo, and may the move be sweet as honey to Winnie the Pooh. With joy I watch descending chart lines straighten, run down with quickness and sweetness, like Lord Walter of Peyton. Let curious traders admire thy Berenstein way, and joyfully stealing some porridge, let us now say, sweet bearish market, never would I cage her, but admire her drop like some terrestrial Ursa Major. Come down, ye markets, to this sylvan glade, and let the bears have their day at Tasty Trade.
In the world of investing, a beast lurks between the numbers, ready to pounce. Some traders hide from it, some ride it. If that's you, join us on Tasty Trade. Genius loves company.
Okay, cowboy, here's an earnings event. Keep an eye out for them when you open your trade. They're fast, they're loose, and they can take you for a wild ride. But that's no reason to steer clear, because you can be your own personal earnings event if you take the bull by the horns. What makes earnings events so special? Before the event, people will start guessing how the stock will move once the earnings report is released. That, in turn, makes the options IV rank higher. Like way, way higher. The nearer the event, the more the speculation, the higher the IV rank. Then right after the event, IVR goes the way of the buffalo. If you sell high premium options right before the event, when IVR is really high, you can take advantage of inflated prices and lock your profits when volatility disappears. Only if, and this is a big if, the stock doesn't move against you. If it does, well, sometimes you eat the bear and sometimes the bear eats you. Earnings events can hit you hard. They can also pay off big and fast if you play your cards right. Pretty simple.
We are back. Let's get ready for this opening bell, Jermal. You're watching Tasty Live. I'm Chris Vecchio. He's Jermal Chandler. Hey, YouTube. We see you in the chat. If you're watching us on YouTube, like and subscribe for more videos. Jermal and I have some great signal versus noise content coming out later today. You should go check out our videos on Intel, on SpaceX, on Micron earlier this week. And, you know, Ilya had a pretty good conversation with Jeff Curry, the former head of commodities over at Goldman Sachs. That's up on our channel as well. So if you want to know what's happening with oil and why the Trump administration actually signed this peace deal, the ceasefire, go watch the videos. Again, like and subscribe, folks. Jermal.
Yeah.
75.70 here.
Yep.
It keeps going up.
It keeps going up. And it looks like yesterday was just a blip on the map. So, wow, even higher now. Yeah, we're ripping now. I guess it's real. We'll see if it holds on. Again, it's very interesting to have the markets pushing that much higher with the dollar up as well, Chris. So this is the dynamic we haven't seen too much in recent times. We'll see if it holds.
NASDAQ is breaking through yesterday's FOMC high, so we talk about that liquidity sweep with our guest earlier, Forrest Knight over at FKX Capital. You are getting that liquidity cleared out of the market right now, so maybe leveling up here, 30,500. Jermal, we were talking before the show, before we went on the break, what happens if we do get through that level? I'm going to want to start to pick off a trade here for something that's potentially shorter term. I'm going back to our little trade table here. I'm still working my 4-day order right now. Let's see. I gotta just let it work. I want to get filled on this because this thing is starting to break out. I've been building into an M&Q position here across various expirations in recent sessions. We're at 22 days to expiration though here in one of them, which I think is the important point to get to because tomorrow the market is ultimately closed. Mm-hmm. So, if you're one of those folks who do the typical 45 in, 21 out tasty trade, if you're at 22, today's basically 21, unless you want to hold it through the weekend, of course. I don't. I want to see where this market can actually run, though, for the rest of the session. But as we get into the close, I'm going to start lifting anything around 22, 23, 25. I don't need that noise. I don't need to deal with that and think about that over the weekend right now. So this is a nice level up. Hopefully I get filled in that position here. But stocks are in the driver's seat with the NASDAQ up 2% as we're moments away from this opening bell.
Strong move. Yeah. I mean, it's fascinating to see that we all of a sudden, we were up all morning, obviously, but the added strong move here in the last couple of minutes is something to behold.
It is something to behold. And maybe this is all triple witching liquidity flows driven because you're not seeing, a big move. The dollar is still running higher, as you mentioned, but oil is off. Crypto is turning the corner. I don't want everyone to turn off the screen here, which I know you're sometimes
turning the corner by 75 points. It's still been quiet, man. Look, this happens, right? I mean, that was one of the things that was really this niche sort of asset that everybody kind of wanted some type of exposure in, and we talked about a lot, and it's just kind of dead now. And again, as much people like to compare Bitcoin to metals went through this a few years ago. We didn't talk about metals a whole lot. We didn't trade them a whole lot. It was just really quiet. And then it had its moment in the sun. And I think Bitcoin will have a moment in the sun again. So, we loosely talked about this yesterday on last call, but to talk about it in the broader audience, I mean, the idea of sort of layering into positions, whether they're longer term, and something like an IBIT, I personally don't trade Bitcoin itself. I think IBIT is a great vehicle to use, whether that's short puts, whether that's, at this point, you can almost buy stock for fairly cheap, honestly. I think I'm going to go on record, man, and say 2-3 years from now, you're going to be annoyed at yourself that you didn't get any IBIT at 36. You know what I'm saying? And that doesn't mean 36 is the bottom. We could see 26. We could see 16 in the next year before we see, 76. But the point is I think I've learned over time, and especially a product like this that's not going anywhere, I don't think. I mean, again, this thing is in ETFs. It's all over the place at this point. There's been widespread adoption. We watched it happen over the last couple of years. So I think, putting on a position and putting it in a portfolio that you don't look at that often is probably something worth doing.
Jermal, I did get a question here right before the opening bell. We'll go through some of these prints shortly, and a funny comment otherwise. If you're under 40 and you're buying SPY, people over 40 think that the top is in, which is pretty. That's pretty
fun.
good.
That's a trip.
It's pretty good. So, question here though: if you're bearish in low vol, are there any objections to buying puts? For me, this is simple. No, of course not.
Yeah, it depends on. What do you mean? Just in general, you're saying like SPY index type puts, or you're just saying?
Yeah, let's just say stocks are rallying, stocks are going up, right? S&P 500 volatility is 16, 15 in the VIX. We're near highs. It's positive technical if it's low volume. Would you be opposed to maybe buying a put as protection in that environment? Or, well, if you're bearish, how would you express that view? Is the better question.
It's a good question. I used to love buying puts, Chris. I really did. And, well, you know what? This is a good question. I know we got 18 seconds to the bell. We'll get on this on the other side of the bell because this is a really good question. We'll do that in a second.
We have a market here ending at 18 seconds, and I did see someone tell Chris to put down the pen. Noted. Pen is down. A little fidgety here as we get ready for the market open.
Man, don't let them tell you what to do, man.
Hey, we have to give the audience what they want. They don't want to hear the pen clicking into the microphone. I think I can respect
Unless it
that.
prevents you from being who you are, then that's when you stop listening to them. You know what I'm saying?
That's fair. Tesla here. We're looking at the high options volume watch list on the platform right now, which if you go over to watch list here on the left-hand column, you can go over to liquidity and high options volume to pull that up, Jermal. We're seeing S&P 500 hold those gains out of the gate. We're still 1.2% higher. The NASDAQ triple Qs, they're still running to the upside, up by 2.07%. VIX obviously still in, now below 1698 here on our chart. We are getting that bounce in a lot of the usual suspects, though. NVIDIA here is trading to the upside by 1.5% out of the gate. Apple's up by 1.2% here out of the gate. Even your Micron is up 5.7%. Your Intel's up 8% or so. It's a good day for the semiconductor stocks, which leading the rebound overnight are peering into a fresh all-time high here right now. I'm still waiting for my M&Q position to get filled. Hopefully it does before this thing runs.
Yeah, I'm sure. I mean, it is running. Wow, market's pretty strong here. I mean, I'm curious to see if we're gonna hold on to these gains, but so far it seems like we are. I see gold is rebounding just a little bit here. What else is moving around? Let me look at some other big movers as far as names here. And nothing major. Accenture. Did Accenture have earnings? I haven't been trading earnings much. I wouldn't notice, but man, that's a huge move to the downside. ACN. Yeah, it must have had earnings this morning. That's a big
Are you
move.
telling me that the consultants are getting displaced by AI?
Shocker.
I can't believe that.
I know, right?
For one. You know, Jermal, we're making our way through this morning part of the tape. I did have some data here penned down about what's going on with seasonality and what just occurred in this market. We shared this yesterday on the show right after we got through the close. Yesterday was a 1% down day on a FOMC meeting day. That's a pretty interesting, unique occurrence here. Frank was pointing out that on Kevin Warsh's first day as FOMC chair, the S&P fell 1.2%, extending the streak to 4 negative first Fed meeting days for new chairs. Apparently, this is the norm. It marks only the third 1% decline on a first Fed meeting day and the largest drop since Alan Greenspan in 1987. But when we take a look at what happened yesterday, it was 1% or more down on a FOMC day since the global financial crisis. I personally have started to push off using any seasonality data, anything that's pre-GFC. I know I look at the S&P 500 since 1950, but to include something from like 2006 or 2007, and then the shift in regulations and banking laws and leverage, and it's like when I see those charts comparing the market in 2026 to like 1929. Mm-hmm. Yes, the candlestick pattern, the lines may line up, but there's a lot that's different than what was going on in 1929 that prevents a market from collapsing like that. So hold your horses. Anyway, yesterday, 15th time since the global financial crisis that we've seen at least a 1% down move on a FOMC day. What happens next? Typically, the next day return is negative, as is 2 days and 3 days later, but a week out, the market has tended to rebound. I found these stats particularly interesting because I want to put them in the context of the seasonality for the month of June, which since 1950, this is the June swoon period. From June 1st through June 17th, June has averaged a gain of about 0.45%. From June 18th through June 26th, the market tends to give up that entire gain. So when we think about this, I'm trying to put this all together in my head, and maybe I'm overthinking this. But mechanical driven rally here today with the tape going up because of triple expiration. June swoon, bad returns after a FOMC meeting, 1% down day. Maybe this is a day if you're long deltas, you don't look a gift horse in the mouth and going into a long weekend, you take some of those long deltas off because maybe the start of next week is going to be a little bit more difficult.
Possibly, and that all depends on your duration as well, right, of your ideas. I mean, if you're in July or August, I don't necessarily know if it matters too much. It also depends on the type of name. Speaking of type of name, the semis still, where's it, Micron? Micron is becoming, almost in a way, it seems, the one of the more interesting names. I mean, when you think semis, you're starting to just think Micron, at least more recently, it seems. I mean, it's become like that again.
It's become like that again, and I think there's still a very funny valuation argument here. I've been going back and forth with this about Ilya, but Micron's forward PE coming into today's session, 8.95. That's it, 8.95. It's still single digits. NVIDIA, just by comparison, I mean, if we want to talk about, let's just say that Micron gets to a valuation level that NVIDIA would be at, NVIDIA's forward PE is 16.39. There's room to run if we think about the semiconductor sector shedding this old clothing of being a cyclical industry that's tethered by boom bust cycles, and instead having risen to the level of importance as energy or national defense because of the persistent demand for compute under the surface. I'm going to say that the thesis is winning out right now. It's still $1,100. It's a miraculous chart here. I don't know how you stand in the way of it. I am sitting long deltas and semis though, and I'm at 29 DTE here. So if this was this time next week, I would be thinking about peeling this off. I got to say I'm real comfortable staying short the put spreads where I have my exposure, given where I built into the position during the pullbacks over the past week or so.
Yeah, I mean, you look comfortable there. It would take, I don't want to say an act of God, but it would definitely take some real undoing for the SMH to drop 100 points at this juncture, I would say. It's been an interesting week overall when you look at, I feel like the Mag 7 has started to go a little bit quiet, even though we're seeing Apple trying to come out of its rebound. NVIDIA has been fairly quiet. Meta obviously had an ugly day today. I think it was starting to bounce back. They've been kind of quiet, and we haven't talked about them as much. It's been these Microns, it's been these SanDisk, these huge names more recently. When you talk about NASDAQ and tech, it's more been, the discussion has been centered around those names, I feel.
They have been centered around those names. SMH here today is starting to poke through the high that we had. 652.20 is the area that I want to look. I want to see prices. Again, we talk about the liquidity sweep. That's why I asked this question today, Jermal. I wanted to see what happens with the highs recently. If we can churn through them, we have something to work with here. I'm going to keep an eye on this level, 652.20. If we can get a little bit more movement here, and there goes the M&Q position. I like the 600, 615 short put spread at 64 days to expiration. It's not the, maybe we have to go in a little bit here to get better bang for our buck. But at that level, 615, 610, you're looking at, or maybe even 600 here, you're looking at a trade that's tethered to effectively saying the market is going to keep doing this stair stepping up. If we are continuing to rally, we're not going to clear out the lows that we had earlier this week. We should see 616.02 hold, right? And so 615, 600 here, risking 2 to make 1 at a 60% probability of profit, right around 43 DTE. That's a real nice setup that we have going for us here. So let's get a little bit more improvement here. Keep this on the watch list for this morning. Let's see if we can get an hourly push once we get through this first half an hour of trading. Where liquidity's here, let's see if we can get that push through those highs. But I think we may have something to work with again and add in another. Keep building into the momentum position, right? Put money into the machine until it stops spitting out coins.
We just had a quick 35-point drop in the market. Again, I think this is one of those days we're going to have to really keep an eye on things because it would seem as though it's not going to be just a complete undoing of yesterday's down move. We might have a little bit of action on this triple witching day.
And the fact that we have gold and the dollar and all those things doing their own thing, keep an eye on what's happening in the stock market here. We have TP coming up in 2 minutes here. What do you think we should talk with him about today? Hey, audience, what do you want us to talk about with Tom Preston about? Put it in the chat now, Jermal. I think it's going to be SpaceX related.
Well, we get paid to talk about trade stuff, but honestly, it would be more interesting to talk to him about software to architecture and engineering because that guy's a genius with regard to stuff like that. But how do you trade that? I don't necessarily know, and if the liquidity is there. But SpaceX is probably the next best thing, right? Is probably along those lines, and it's getting ugly a little bit in SpaceX the last 2 days. Look at that, man. That's going to probably create a little bit more volatility. This is why we did calendars in both directions. I did the put calendars, the call calendars. Hopefully I'll be able to take each one of them off with profits at some point in time. Matter of fact, I need to take a look at that. Let me see. Folks, what we do is high level stuff here, okay? Trading while we're actually on and we're just sitting here talking to you, it's not easy. But, we do have to monitor positions every now and again.
It's a $14 loss here for SpaceX, down 7.3% today. You can start to see it's spilling over into the broader market right now. Nasdaq was up 2, now only 1.5%. On a day where the dollar continues to hold up, Jermal, which may have been the key tell for everything all along. We'll see as the session goes along here. But it's a good time to bring in our buddy TP. We're just about at that time. Let's bring in TP here. Let's talk about these markets.
You're calling him TP now. You were just calling him Tom. Now you calling him TP? You got the go ahead?
I suppose.
Okay. All right.
Yeah, Chris got the official approval. He should be getting a certificate in the mail, And
my wife has a laminator. I can laminate it.
Yeah, and you know what? You could put it on like a little, along with your other diplomas, things like that. No, I'm Tom Preston.
My CFA charter rolled up in a tube behind me. I got to hang that on the wall.
That's right. That's exactly right. No, it's one of the things when we're first starting these companies. It was you had to create emails, like whatever, like Chris at Tasty Trade or whatever, or Jermal, blah, blah, blah. Mm-hmm. The problem is there were a bunch of Toms, things like that. So it was, how do we make it so it's not like long, like Thomas.pred? Nobody wants that. I didn't want that. So it was just like TP. And it just became an easy way to distinguish me from everybody else. And the problem is, if you actually look up TP and let's say, Tasty Trade or something like that, you get internet protocol information. So that's why it's like, what is it, Jermal? Like TCI, whatever it is.
Yeah, something like that.
Anyway, so it just Tasty Trade, Tasty Live. You'll find my stuff there. That's where we are on YouTube. And YouTube, in the YouTube videos I do, they label me as Tom Preston to distinguish me from everybody else, I guess. But anyway, guys, SpaceX is dead. The rockets are crashing. There's AI has jumped the shark. So the one thing I want to talk about SpaceX today, yeah, the down move's impressive. Two things. We were talking yesterday with Liz. Jermal, remember that discussion. We're looking at unbalanced butterflies, things like that. And the issue with unbalanced butterflies is volatility is very low. You just can't find these trades. SpaceX, if you can click on the trade page, let's see what the implied vol of the SpaceX options is. Well, yeah, they're 152%, 101% of the 29 days. The 8 days and the 14 days, they still aren't printing yet. Are we getting quotes on those 8-day options yet? Can we open those up? Yeah. So I don't know if there's any trading in there, but the markets, and I did a video on this a couple days ago. The markets are impressively tight in a stock like SpaceX. For as volatile as it is, for as new as it is, again, 36 million shares of the stock have traded. And as an old market maker, it's the liquidity of the stock and the ability to execute stock trades as a hedge against the options. In other words, when paper comes in and I'm taking the other side of public orders, I hedge immediately with stocks. If I can get that stock trade off, I can make my bid-ask spreads in the options tighter. One of the things that is interesting, if you are bullish, and I'm not saying you are, but if you're bullish in SpaceX, an unbalanced butterfly is a possibility. Let's see if that's actually true. Let's open up, look at the 8 days. Let's put in a trade, see what it looks like. Can you buy the 185 calls?
Calls?
Yeah. So calls. Let's do a call.
You're going to do bullish this time. I was curious. So wait.
Yeah. Let's just do that
real quick. Why do you decide to go calls in this? Do you typically, like, if the stock is down, would you typically normally go with a put butterfly on this situation? These are pretty good, by the way. I don't trade these, but you guys were putting me onto it yesterday, and I know people do them a lot, but these are fascinating. Why are you deciding to go calls? Are you just using that in the situation, or would you actually go calls in this, or would you rather go puts?
So here's why. Here's why. The part of the unbalanced butterfly, Jermal, that drives the trade is the embedded vertical, not the butterfly. An unbalanced butterfly is a butterfly plus a short vertical. Butterflies have basically zero deltas. They're just lottery tickets. It's the embedded vertical. So if I'm buying this butterfly, so you loaded up the 85, 90, 200, right? That is
90,
synthetically short. Am I doing this right? The 95, 200 call spread. That's what's driving the trade. People say, well, wait, I don't see any 195 calls. You're doing this for 65 or 80 cent credit right now. That's awesome. This has a little bit of short deltas, generates $5 of theta. If you thought that SpaceX might rally back, but not too much more over the next few days, and it might land right in the middle of this butterfly, right around you. The sweet spot for this trade is 190. This is a trade you could consider. There's no risk to the downside. So you just, Jermal, it's because you have that. Did you have a put in there?
No, he's just got the calls. No, I asked calls versus put because like we were talking about yesterday with like nat gas. Like a lot of times people like to do these unbalanced butterflies right on the downside on a day we're moving down, and then we of course bounce back up, and then obviously they move that to make it a more symmetrical butterfly, and right, people love to do that and get the free butterfly on. But in this case, again, it totally makes sense too. You're doing to the upside.
And Jermal, the same logic works on the put side. Same logic. I buy an out of the money put butterfly. I stretch the out of the month, the downside put to a lower strike, create a credit. That's my unbalanced put butterfly. And it has no risk to the upside then.
Just as a reminder for the audience, the difference between a regular butterfly and a broken wing butterfly or this unbalanced butterfly is that instead of having symmetrical strikes, one is a little bit wider out to introduce a directional bias.
And so this platform lets you do this literally, Chris, this is not a pun. I know you hate puns, but you can do this on the fly. So Jermal, see where it says that 200. I know, seriously, and I hate that. And I was going through my head, Chris. Should I?
That was kind of a good corny one, though.
Should I say this or should I not say this? Should I say this? Should I not say this?
Shoot your shot, Tom. It was worth it.
Anyway, Jermal, if you can drag that 200 call down to 195 to prove Chris's point.
TP in the future, you just do it anyway and then say no pun intended. Nobody can, get you then.
I know. So anyway, what Chris is saying is that the 185, 90, 95, notice there are 5 points between the 185 and the 90s and 5 points between the 90s and the 95s. That is an equidistant, regular, quote unquote, call butterfly. You're paying 35-cent debit for it. For a 5-point butterfly has very low probability. It just is a low probability trade generally. Actually generates a little bit of theta here. I'm not convinced of that, but if you drag that call up to the 200 strike, makes it unbalanced. You do it for a credit. There is no downside risk on this trade. Mm-hmm. That's the call butterfly. And like I said, you can do this on the put side, but the reason this is setting up is that these options have 150% implied volatility. When something has 10 volatility or 5 volatility, like the 10-year notes or 10 or whatever, they don't set up. And part of the reason for that, guys, is when volatility is higher, it depresses prices. It depresses the butterfly prices. It flattens them out. So you're paying less for the butterfly, and you're taking in a bigger credit for the embedded short vertical. That's why these things set up in high IV products.
And on the equity side, a given, skew, right? Normal skew, let's just say Inspire something skewed to the downside. How does that affect pricing? Is it easier to put it onto the downside? Let's just say in something like SPY or whatever would skew to the downside. How does that play out? How should you expect those to look? Downside butterfly for a put butterfly versus upside butterfly to that end, right? They're not going to be as great on the upside because of that skew is not the same as it is downside.
They can be tougher, Jermal, only because if the skew is pointed south, in other words, if it's steeper on the put side, the out of the money puts are going to be relatively more expensive than out of the money calls. So you're going to get a little less credit for those embedded short put spreads. they may not set up as nicely as they do on the call side. So you're going to be paying for a butterfly, and then you're going to try to sell that to embed that short put spread in there. If that embedded short put spread doesn't generate as big a credit, it may not be as attractive a trade. But that's the impact of the skew. Now, Jermal, we've seen in a lot of stocks the skew pointed towards the call side. Okay, and maybe in SPY, we don't have to do this now, but in SPY, if the skew flattens out on the downside, that could set up the unbalanced put butterflies in SPY.
Last question before you go, as Chris is doing this, is a good question because duration. What duration do you like? What do you feel is the ideal duration for these trades?
Well, for something like SpaceX, I'm going out for a week only because and I have bills to pay. I need to get paid, right? So I think I go around typically that 29 day. If you're just looking at SPY, Jermal, I would stick with 29 day with an 18% vol if it's a standard stock like Microsoft or Amazon or Apple or whatever, right? Use that sort of as 29 day standard. Why is that? Well, because they don't have, for example, SPY has an 18% volatility. What happens is that extra time, if you push it out to 29 days, it's going to keep the butterflies a little bit cheaper, make them a little bit less expensive, and increase the credit you get for the embedded short vertical. Remember, and I don't like to go too deep down this rabbit hole because I know people can get a little turned around with this stuff, but that embedded short vertical component of the unbalanced butterflies, and this is also true, Jermal, of unbalanced condors, iron condors, things like that. That's what drives the trade. That's what's generating your theta and your deltas.
Nice.
Tom, we're going to see you later today, I'm assuming. I think it's true.
Yeah, I'll be on at 10 o'clock. I'll be on at 10 o'clock to do a little segment about talking about what I'm trading today. But no, great segment, guys. Thanks for having me on.
Thanks for having us. Thanks for letting us have you, Tom, TP.
How could I say no to you, Chris? How could I say no?
It's been our pleasure, honestly. All right, Jermal, we're moving on here. We have This Week in Stocks coming up. Let's just take a brief check-in on the market here, which after that swoon, if you will, at the open, it's restabilizing. 75.51 here in the S&P 500. NASDAQ up 1.7%. 30,517. Trying to hold on to that move above yesterday's FOMC high. Oil staying lower, now down 3.7% here at session lows. Gold prices, they are meandering down 2.4%. Silver still down 5.3%. Should we get into This Week in Stocks?
Let's get into it. Let's take a look at it.
That sounds good. Take us through, sir.
You know what's funny? I kind of forgot that we're doing this segment today because I wasn't thinking it was the end of the week. In that regard, I kind of forgot. I really did. You know what's interesting, too, is that just glancing through them, I mean, as good a traders we are, we've actually talked a lot about these because this has been our week. And I think we just inherently, the beauty of This Week in Stocks is we inherently, I think, start to just look back and be like, what did I just witness this week? What just happened? And what does that mean for next week and the week after, right? That's the thing. That's the beauty about This Week in Stocks, and that's why this segment was created. So the Fed held rates at 3.5 to 3.75% in Kevin Warsh's first meeting. 9 of 18 members now see higher rates in 2026. The Dow sets records early in the week, nearly touching 52,000 before the Fed knocked it down to 507 points Wednesday. Now, again, that's just the actual index. We saw, of course, in the futures, it was trading around 52,500 for the most part. The S&P 500 fell 1.2%. NASDAQ lost 1.3%. And again, this is on the week before today. We'll see if the markets can end up positive for the week. 10-year yield climbed back towards 4.5%. We saw 2-year yield with some highs as well. Retail sales came out yesterday in a somewhat more tape that was a lot more interested in the Fed. And they rose 0.9% in May, well above the 0.5% expected. I mean, what else do you expect in an environment where we're talking about inflation? The economy keeps running hot, which is keeping the Fed on guard. The top 10 U.S. stocks now worth $25.3 trillion combined, larger than the entire economy of China. Let's move to the next slide. Valuations, man, valuations. The market repriced from 2 cuts to 2 hikes this year. And again, across what time frame, right? Going back earlier this year, we were like, oh, this is great. We're going to get cuts. Like, this is going to be fantastic. But not so fast, my friend. Things are now looking totally different. You can blame the war, I suppose, and the move in oil, which has reversed itself strongly more recently. But now we're looking at 4.03% before we're looking at 3.05%. That's a pretty big gap. What say you, Chris?
It's probably something that's going to have to be resolved at some point. There's no other way to put it. Look, if the AI story is strong enough and the earnings are good enough, 50, a 100 basis point change in rates, maybe that's not enough to short circuit the market in the short term. But if we go into a higher for longer mentality, we saw what that did in 2022.
Mm-hmm.
And that's problematic. Cost of money does matter at some point in time.
Yep, it sure does. Let's move to the next slide. We discussed this a little bit ago. Here's a little bit more proof. New Fed chairs keep getting rough first days here. So McCabe, I don't even know half the names in the beginning. I know you do. You probably did a thesis on them and their leans before they came into office. I only know from Volcker on. I actually don't even know McCabe or Martin or Burns. But you can see, I mean, yesterday was not a great day, and there's precedent there. We've seen this in the past. His was only the second worst day to Greenspan's. So, yeah, it's one of those situations where I think people don't know what to expect. I can't speak to all of these, but yesterday just felt like, and you know what? I had the perfect trade set up, and I took it off the day before. I had the Super Bear SPX trade with the idea that maybe we would fall heading into the meeting. I'm so dumb. I'm so annoyed at myself, but it happens. You take things off early sometimes. In his debut, we fell 1.2%, the biggest Fed meeting drop for a new chair since Greenspan in 1987, and only the third 1% overall. Every new chair since 1994 has fallen on day one.
Markets don't like the change. But listen, I know so many people were roasting Forrest yesterday, like, oh, this wasn't Powell. We missed Powell so much. Guys, it's his first press conference. But you go look at Powell's first press conference. Maybe there's a reason why the market falls from these first press conferences, because they're nervous and they don't deliver the message well.
Yeah.
Don't read too much into it.
And there's a task force for that. Let's move to the next slide.
I can't have an aneurysm on air, Jermal. Don't do that.
As you noted earlier, June 17 has historically kicked off the year's worst 10-day stress. S&P 500 average return paths in June from 1950 to 2025 in this chart right here. And historically, it has been not that great, Bob. But I actually don't really typically pay much attention to this. I trade how I trade. I'm not worried about 10 days in a year with 252 days. Let's move to the next slide. Bearish gold bets are the most crowded since 2017. This is a chart of GLD 6-month put call skew demand for downside protection. Right now it's 1.03. That's the highest we've seen in almost 10 years. So kind of fascinating when you look at that. Nobody likes gold at the moment. Totally makes sense.
When we've seen the surveys from like the Bank of America Fund Manager survey last year, we had like 60-odd% of fund managers that were long gold. Those numbers have been halved.
Yeah.
Absolutely decimated.
Let's move to the next slide. Top 10 U.S. stocks right now. Let's start that again. Top 10 U.S. stocks right now are bigger than China, as we said. This is massive. I mean, bigger than China's GDP. It doesn't get any bigger than this. So things are, what can you say? I guess that means it's a good stock market, right?
Yeah, no, that makes sense.
Let's move to the next slide. The biggest IPO ever became a top 4 company in days. I mean, that's wild, man. When you just look at the massive size of SpaceX as it is since its June 12 debut, it's just continuing to move higher. Although today we're seeing a pullback here, but still, this company is huge. It's already one of the biggest companies in the S&P 500. It's not even in there. Let's move to the next slide. Only about 5% of SpaceX floats today, so the unlocks are on the way at some point in time. Keep an eye on August. I know that's an area that Tim Knight noted and everybody else is paying attention to. August 11th is the first wave, the 20% of the float, and this is something to keep an eye on. Maybe we'll see some pressure around these numbers as time goes on. Keeping an eye on these?
I am, and I think that this is going to be prime material that we're going to mine for signal versus noise over the next few weeks.
No question about it, for sure. Let's go to the last slide. Triple witching is today, and we've seen some movement so far. Markets were up pretty big. We've seen a little bit of a reversal. We'll see how that plays out. There's a lot of paper being pushed around, if you will. Chair Warsh launched 5 task forces to review the Fed's communications, data, productivity, and the causes of inflation, with results due by year end. There's a task force for that, people. Always remember. Gold is down more than 20% from its January record, as a stronger dollar and a hawkish Fed weighing on it. Watch whether these crowded bets eventually unwind. You can watch that for the semis as well. The June swoon, let's keep an eye on it. Let's see if it means anything. I'm not trading around it per se, but there's history, and it's something to note. Q2 earnings ramps up about a couple of weeks from now, about 3 weeks from now. So that's the next, I would say, major catalyst to pay attention to, other than the quarter end.
Micron is next week. Jermal, if the FOMC is the country's inflation task force, that's their job. What are we doing? Why are we here? What's going on? I feel like Tucker Carlson saying that. What's going on?
Yeah.
What's happening? Okay, Jermal, we're taking a quick break. Tasty Live continues after a brief break. We're going to be back with Tim Knight, and we have Gad from the research desk coming up here. See you on the other side.
First thing about Tasty Trade is how easy it is.
It's a very quick, light platform. It's all on one page.
And with 1 or 2 clicks, you can be anywhere on the platform.
Being able to see graphically where your profit and loss zones are.
Whether it's a pool, a puddle, or a sea, you can navigate your way out of it with the Tasty platform. So I love that. You guys have the most unbelievable customer service in the business.
Email support, call support, get through right away.
They actively listen to the customers to make changes to the platform to make it better.
In fact, I've never seen anything like it in any corporation in the United States.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options, profit, and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
Jermal, we are back. It's just after 10 Eastern, 9 Central Time. Markets are oscillating back and forth. Nasdaq still up 1.7%. But they've come in a little bit here, and it's a triple witching day, which means we need to bring our friend in with, you said the chickens and the dogs? Tim Knight's here.
It's just me at the moment. You never know what's going to join the party.
It's true.
My neighbor has chickens. It's delightful to wake up to in the morning, truly.
It is. It's like a suburban paradise. We got way more eggs than we know what to do with, and way more honey. But and the dogs produce nothing but joy. So yeah, here we are. You said oscillate back and forth. They're just green. These markets are green, but it's it's still. Listen, it's a good day. It's a good day. There's a lot of good shorts out there. I had a few charts I wanted to share with the group. If you want to bang through them.
Absolutely. Wait, before you start, though, I'm just curious. What'd you think about yesterday's move to the downside? Is there any?
I thought it was interesting. I watched Mr. Warsh's press conference as much as I could. My show butts up against it, so I usually miss the last. Well, I don't know how much I missed because I've never seen the last portion, but probably about 10 minutes or so. there's this weird phenomena, irrespective of who the chair is, which the market ramps up to the announcement and then gets kind of wobbly during the press conference. Then when it's over, it's off. They're expecting, but I was kind of heartened by the move. He also has a really different style, because I always found Powell very avuncular and warm. And Warsh is exceptionally intelligent, but I just felt like I was being sold something. So a bit more of a smarmy feel to it, I thought. But the market liked it, because when the announcement came out, it fell. He started saying his words, and it undid pretty much all the damage. And then the damage came back and accelerated. So overall, a really good day.
I hear you.
That was way too long an answer.
No,
Okay.
No, your thoughts. I was curious. Yeah, let's check out these charts. Carvana is the one I put on yesterday. I put on a little short position there.
Yeah. Well, it did great yesterday, and as I said, this is my, temporally speaking, aggressive one, because it expires in September, these puts. But I really like yesterday's move. We've definitely completed this diamond pattern. I don't have a target for this, but it's a lot lower than it is right now. But it's got to be my favorite chart going right now. It's just a beautiful, beautiful diamond pattern, and I think we're going to wake up one morning to some news, and I think it's going to like blast lower, and that's when I'll scurry out of it. So Carvana's doing great, and as I say, all my other puts are January's, but this one's my only one for this year, which is September. Another item of great interest is our dear friend SpaceX. First red day yesterday in history. Today's 2 for 2. I would not be at all surprised to see this trading next week below its lifetime low. And when I say lifetime low, I mean the retail low, not the 135 IPO. Because as this diminishes, people are going to get more and more skittish. Because after the first 3 days, understandably, it's like, gee, free money. And now it's starting to unwind. We've all seen the fundamentals, which are preposterous. And it occurred to me that SpaceX and Strategy, MSTR, have one key item in common, which is that most of their value is attached to the founder, the man who is associated with it. So Michael Saylor for Strategy and Elon Musk for Space. Because any meaningful examination of the breakdown shows that about $1 trillion of the valuation was just because Elon exists, and that was at the IPO price. So anyway, that's sinking. In Q, all the equity indexes are green. We've kind of undone all of yesterday's damage and portion of Tuesday's damage. I would appreciate it if we don't go above Tuesday's high, because my nemesis here, everything's going really well this morning on my shorts, with the exception of SMH, that's showing a lot of strength. It is still below its broken trend line. If this can start selling off, the stars are really going to line up, because this is kind of the last bastion of looniness. When you look at Micron and the storage stocks and so forth, if this can start to sink, we'll be in like Flynn. XLF, wanted to mention this as an aside, kind of an interesting trend line going here, long term. We're butting up against that right now. So banks are very, very strong lately, but I would say this is a very interesting configuration of the trend line vis-a-vis the price action.
Tim, that looks like a potential breakout to me. I don't know.
Well, that's because you're a perma bull and I'm a perma bear, and the truth lies somewhere in between. My eyes are tinted red. Anyway, crude oil continues to sink nicely, as do like XLE, which we talked about earlier this week, and XOP, which is just a honey of a right triangle reversal. So that's going well. And the individual items like SLB and HAL, things of that nature.
Tim, do you like trading the ETF?
And one last item, oil? Bitcoin. I really like how this is going. I thought it might get up to 70, 71. But it seems to have kind of exhausted itself around 67. And so I'm short this again and keeping a close eye on it, because this might well take out the lows from last week, if we keep this apace. So hang on a sec. All right.
Hi there. She loves being on camera.
perfect guest.
She's a lot more footage than it.
She loves being on camera.
That is my baby bear.
What was your question, Chris?
I'm curious, Tim, do you prefer trading like XOP, SLB as opposed to crude itself? Why not just go directly to the commodity? Is just the chart set up?
Okay, so forgive me, Chris. Your voice is a little soft from this end. Plus, it's being obfuscated by one of my dogs. So it's. I thought I heard you said, "Do I prefer trading the ETFs as opposed to crude oil?" I don't trade futures at all, and I don't even trade the commodity ETFs. I do prefer trading the big ETFs as well as individual items, like I'm in Halliburton right now, for example.
Gotcha. Okay. Yeah, this Bitcoin, it's ugly, man. But
it's beautiful. I'm the beholder.
Tim, thanks for joining us this morning. That's been Trading Charts with Tim Knight here. You can check him out later today. Of course, he's on air in the afternoons here on Tasty Live. What time is he on here, Jermal? It's usually the same time every day. I think that's 2:15.
Yep.
2:15 Eastern, right before our last call, so come back for Tim Knight later today. Hey, you know who we have in studio right now, though? It's the best dressed guy on the team. He always makes me feel like just the schlubby bum. It's Gad. There, of course.
That's going to become a question soon. That's going to become the question soon. What color tie does Gad have on?
Oh, it's a black. So. Yeah.
How you doing, man?
I'm good. I'm doing great, and nice to see you right now.
Good to see you, my friend.
Yeah,
earlier this week you were with us, and you were talking to us about the IPOs and SpaceX, and kind of be careful. You get a little pop at the beginning, but maybe that's not how it works out for the average stock moving forward. Mm-hmm. What do you have for us today?
So today I'm going to come with another research study. So recently we received so many emails. And also yesterday, we went into comments of YouTube comments. Tasty Nations were asking about IWM, small caps, and we're like, oh, this is a great topic to talk about right now. What's the difference between large caps and small caps? What traders need to know about these kind of two competitive caps, small caps and large caps? So let's dive into our study right now and see what traders need to know and how it can be actionable to traders. So, as everyone knows right now, IWM is kind of overpassing or like dominating the small caps. Right now, it's when you compare like last year to year. So right now is 40%, and the SPY is only SP500 is 25%, which can bring so many traders to be interested in trading IWM and say, there's so many joys, there's so many opportunities of growing, there's so many volatility. So that's why this study is going to bring statistics behind this logic. Is it really happening? IWM or small caps is overtaking large cap in terms of like bring joys to the table for traders. So this graph shows like 1 year, 3 years, 5 years, 10 years, and since 2000s. And when you compare 1 year, you see SP500 large cap is already dominating. 5 years, 10 years dominating. But when you compare since 2000s, there is no like big difference between their returns, year-to-year returns. When you do the average, which is like interesting stats we saw as a research, and we can deep into after this. So the next slide. So for the last 13 years, we have seen like when you compare 5 lowering these kind of IWM minus SP500, the positive one is like where the small cap outperform the large cap. You will see since 2006 up to 2014. I mean, since 2000, early 2000, after .com recovery, IWM had like 8% annual edge over the SP500 over the 5-year roaring, which is interesting. And right now, you will see here in 2014, went way back, and it's like rolling down, and everyone is like, what's going on? And right now, because we AI and this kind of crazy movement in the market, we kind of see like small caps is coming to the recovery. Right now is on like 3.8% recovery, which was there in 20 years ago. So, which is interesting stats to see, and how these small caps is heading in the future. So we're gonna see in following slides. So when you go to the next slides, you will see IWM price divided by the SPY price. This is a kind of ratio which shows the dominance, which one is dominating right now, and which one is like spreading the ratio, the strength of the ratio. So the rising, the small ratio, or the rising is like indicate like the small cap is outperforming the large cap, which means like if you have the higher ratio, that means the small cap is outperforming the like in terms of the price, outperforming the large caps. You will see this graph demonstrate perfectly since 2000s. The large cap dominates the small cap dominates the large caps until 2014, and it started going way down, where large caps just take it over and dominate that. It's interesting to see last year, April, during like the rate shocks, it's where we see the bounce back of the small caps. But we see why this bounce back happened last year. Most of the time is because the small caps, it's more sensitive to the market, like 48% sensitive to the rates, to the change of rates. But we see why it happens. Because like almost like 80% of the small caps, the component of small caps, 80% of it depend on internal U.S. economy, while only 40% of the large caps is the only depend on the U.S. economy change, and especially these rates. So we see in the stats on the following slides. So, but this is like a great understanding of how small caps and large caps really operate, and how they do help each other or interfere to each other in terms of ratios. Chris, what's your comment on this?
I'm thinking about IWM and small caps have had such a tough run of luck recently.
Mm-hmm.
I like to think of them as kind of like a sentiment gauge. I trade Russell from time to time, but I'm having just such a hard time trying to think of a world in which small caps outperform like the Mag 7.
The Mag 7. Yeah.
Right? Or the Mag 10 or whatever we want to call it. But it's just because of what's in that, what's in the bucket of Russell 2000 stocks.
Mm-hmm. Yeah, I understand.
Anyway, keep going.
Yeah, I understand. Yeah. So this is like the slides. I'm sure like Chris will like it more because it's kind of like more micro. Why small caps dominate or respond more? Why? It's the same thing I said earlier. So it's like 70% of it, like it reflects to the banking system, these interest rates. So when there's rate cuts, reduce borrowing cost for the small caps. So this 70% of it consists of the small caps rather than 30% on the large caps. And as I said, small caps, the component of small caps, 80% of it, it's US-based economy and also benefit directly from the US growth or stimulus, which is interesting, rather than like 40% of the large caps. So regional banks, like almost like 70% of small caps, they are already priced in IWM because it's like the components of it. So if there's any change in the rates, it affects like vigorously the IWM small caps. Another factor is that 48% of the components of the IWM or these small caps, it's really sensitive to the market, to the bigger market, to the SP 500. I took an example like if SPY move like 2%, IWM can move closer to 3%, which is like almost like 8%, which is like a significant number. If you're going to trade any component to IWM or IWM as ITF, note this factor, like you will have like 40% or 8% of moves more than large caps. And also I put some kind of stats behind our like these meetings, events, how it affects both SPY and IWM, just for you to understand deeply. So when you go to the next one, so we saw kind of like IWM dominates a little bit, and we saw like this downside, how the daily drawdowns really kind of works in IWM and these large caps. You will see like 58% of it has like the way max drawdowns ever. So when you compare to the large cap and small caps have a 59% drawdowns more than that. And also, as I said, it's 48% more sensitive to the market. So it's more dangerous when you don't understand this and you are trading these ETFs. You gotta understand how better to take risk and how to size your positions according to drawdowns, because any sell-off in the market, it's bigger than you think. So to the next slide. So this kind of other stats I put behind this logic, and forward PE ratio is kind of like considers the price when you divide by the next year earnings. This will take like 12 months. So the lower, the cheaper the stock is, and I put the different kind of results on the next columns, where you see where the IWM is so cheap than SP 500 or SPY as an ETF, of course. But when you compare the risk, you can't compare, because IWM is more riskier to trade in more than SP 500. And also, the volatility in IWM is more people are interested in kind of like stocks or ETF, which kind of like bring volatility. So when you go to the takeaways, so this is a kind of a summary of everything I said. Right now, we kind of see like IWM kind of dominate the SP 500. I mean, small caps dominate large caps. But initially, when you go on average, large caps still dominates, which is a good thing to know, and the stats behind can show. So another thing I can conclude this study with, when IWM pays more premium than SP 500 or than large caps. So, but when you want to size it, try to size at 20 to 25%, because when you don't follow the sizing portions, because the risk in the follow the premium, you're gonna take like 48% risk more than you're gonna take into large caps. Yeah.
And that's a really important point, Jermal, right? Not everything is created equally. And so when you look at the volatility metrics, just got to be aware when you're doing one size in ES, it's a different level of risk than when you're doing it in RTY. And understanding that difference is important. That way you set your strikes at the appropriate levels.
Yeah. My takeaway, Gad, we're raising rates, so therefore I'm going to get short IWM and
100%.
Thanks, Gad. Thanks for that. I appreciate that.
Yeah.
That is also one of the takeaways there. Gad, thanks for joining us. I need to get on your Stitch Fix subscription. That way I can fix, because right now it's like all Viore, which is pretty nice. It's comfortable.
No, you look nice.
I need to get on that Gad Stitch Fix subscription.
Good to see you,
we're going to take a brief break here on Tasty Live. We're coming back in just a few minutes. When we come back, we have Gus with a retail watch list, and then we're going to be talking confirm and send. Send in your questions. Research at tastylive.com. Put them in the YouTube chat. We're collecting them. We'll get you your answers. We have Jessica Ramos also coming up shortly as well.
Guess.
You may know her from Twitter. She's a big Knicks fan, so we're probably not going to talk trading. I'm sorry. We'll see you in a little bit. Brief break.
Okay, cowboy, here's an earnings event. Keep an eye out for them when you open your trade. They're fast, they're loose, and they can take you for a wild ride. But that's no reason to steer clear, because you can be your own personal earnings event if you take the bull by the horns. What makes earnings events so special? Before the event, people will start guessing how the stock will move once the earnings report is released. That, in turn, makes the options IV rank higher. Like way, way higher. The nearer the event, the more the speculation, the higher the IV rank. Then right after the event, IVR goes the way of the buffalo. If you sell high premium options right before the event, when IVR is really high, you can take advantage of inflated prices and lock your profits when volatility disappears. Only if, and this is a big if, the stock doesn't move against you. If it does, well, sometimes you eat the bear and sometimes the bear eats you. Earnings events can hit you hard. They can also pay off big and fast if you play your cards right. Pretty simple.
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty Trade. Genius loves company.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Grow a strong community with Tasty Trade's referral program. When your friend joins Tasty Trade, you'll both receive $100. As your community grows, you get more bonuses. Only at Tasty Trade.
Jermal, we are back. We're making our way through this morning session here. Stocks are pressing the highs. NASDAQ up now over 2% right now. Volatility continuing to come in. It's a good time to bring in our friend Gus to talk about what retail traders are watching right now. We've sent him off into the Reddit mines, the Twitter mines. He's coming back up. Gus, what have you found?
I can't hear you guys. I can see that I'm on the network.
You.
I have nothing.
That's great.
Yeah.
Well, we'll get that
I can try to read
real
lips.
quick. We can get that sorted out on the side.
Try to
real quick.
read lips.
Jamal, we can hear him though, which makes us.
I imagine what he's mining at least a little bit is SpaceX. I'm sure there's a lot of people that are paying attention to that, especially these last 2 days being down, I would say. But Gus has an interesting way of looking at things. He finds stuff that I think a lot of people aren't necessarily paying attention to, whether it's like the Rumbles of the world or the QuantumScapes QS or things like that, or the NBIS, which is a name I think that's moving around a lot more recently. I feel like those are the things that he kind of ends up sort of layering into, if you will, more than anything. So, I mean, look, this is an environment that is just very interesting for a lot of retail traders. I don't know the last time you had so many different things to trade. It's been a minute. And I think that's that's an interesting name, that QTM.
Yeah, the Defiance Quantum ETF. I mean, we think about the speculative appetite here. I know Bitcoin's still down in the dirt, but when you look through the various layers of the equity market, it's not just the AI infrastructure stack that's doing well. You're even getting the speculative spillover into the next realm, which here he is back from the Reddit mines. Take two. Gus.
Hello, gentlemen. I am so pleased to be able to hear you now. This is wonderful.
You don't need to read lips.
Just some minor technical difficulties. I'm a fairly good lip reader. I'm not proficient. I couldn't do a whole show like that. But yeah, happy
I was
to be here
willing to
with y'all.
challenge that and see how it worked out.
I heard the kind words before we came on, and I do have a few off the wall, a few underappreciated stocks to talk about for us today. First trending stock I want to talk about, we do all this talking about Micron and SanDisk, and there's a third forgotten player in this space in Western Digital, which is leading the pack of memory stocks today. Opened up 5.5%, up a little bit more than Micron and SanDisk today. Same exact success story as these other two companies, more or less, over the course of the past couple of years here. I mean, it's another memory company. We've discussed at length how memory demand seems to be becoming less cyclical. There's actual backing for this. Chris has alluded a number of times to how the forward PE ratios on these memory companies actually aren't as crazy as you would think. This may not be an overextension. And Western Digital, right there alongside Micron and SanDisk, I think it deserves a little more love. So that's my opener today.
These are probably ones for candidates for some of those unbalanced butterflies like TP was talking about, because they got the volatility. I don't know how in the hell you can get it to land on any given strike that you want. You got to be pretty out of the money. But, I mean, outside of that, these are getting hard. Even for option traders, these are kind of hard to trade at this point. And, again, I've been around a long time.
You talk about Western Digital here. It was trading at a low of $480 just last week.
Yeah.
So these memory stocks, they can just continue to run. I know that, Jermal, you and I have had some exposure in these names. I've been still trading around semis. Semis have poked up into a new high today, so I'm looking to get filled right now on a trade, that short put spread here under the 615 level right now. But, Gus, I'm with you. You have to pay attention to the semis. The infrastructure stack is still running right now. And until the momentum fades, how do you step in front of it? It's so difficult to do so.
Yeah, and I think it's easy to forget that there is a third choice in that space if you're looking for one. Something else catching my eye this morning: Pfizer is down 1% after their CEO said that he's going to step down on August 15th. This kind of raised the question to me: if you're a CEO and you say that you're leaving a company and it only falls 1%, are you kind of mad about that? I feel like I'd be kind of mad about that. I only have 1% impact on this company. You know, this stock should be down 5%. So yeah, surprised to not see Pfizer falling a little bit more aggressively with that kind of managerial change. But I suppose the view of the market, and perhaps accurately, is that it's the products that do the talking for Pfizer, not the CEO.
Yeah, but what's much worse is when you get fired
and it goes
and
up.
then the next week the share price goes up.
It's true.
Yeah,
it's true. It could be worse.
It happens.
It does happen. I know we saw the same with Target when they let go of their COO.
Yeah.
Cruise operators also up today. Carnival, Royal Caribbean, Norwegian. You can pick your poison there, but it's falling oil prices driving those higher. Airlines rising higher alongside them. Any industry that's massive, that needs massive amounts of oil, is standing to benefit here. Airlines. I was told airlines were going to see a 4% increase in EPS because of GLP-1 drugs. We haven't seen that come through yet, but that was they were projecting. Jefferies had projections out, I don't know, maybe 6 months ago now, that within a year there would be enough Americans on GLP-1s that it was going to bring average flight weights down, which would then translate into increased earnings because airlines have to expend less fuel.
That's a guy trying to justify his job. I don't believe that.
Oh no,
that's what that is.
There are tons of second order. I mean, can we see it up here? It's not pulling up. But Victoria's Secret stock was up 40% after their recent earnings.
Very sexy.
Very
sexy. Remember? Yes, that's why.
Yeah, that's what I thought. But
yeah.
VSXY. That's not VSKY. VSX. What am I doing here? New hands.
First day, new hands.
First day, new hands. Yeah, I mean, there are secondary effects that are coming through from the GLP-1s. And what I really think what's so interesting about the GLP-1s themselves, and I've been holding my Eli Lilly stock since $88 a share all those years ago. These drugs fundamentally rewire your brain. They impact your ability for ambition, desire, right? Your cravings. We have how many industries in America are predicated around people's inability to control their impulses? And
this is a deep convo.
Like 40% of the population is going to be on GLP-1s moving forward.
We could talk about this for the next 10 minutes. I like where you're going, though.
It's true, yeah. I mean, it's an ever-growing number. The last I checked, which was when that Jefferies report came out, it was 1 in 8 Americans. I know projections, indicate that that's going to become closer to 1 in 4, 1 in 3. And yeah, I think
they should put it in the water.
Yeah,
for my shares, they should put it in the water.
They should.
Okay?
They should.
Eli Lilly should have exclusive water rights for the GLP-1s.
Now you sound like the first Batman. Batman Begins.
That's okay. I'm okay with that. The Knicks won, Jermal. Nothing can. We're kings of Gotham, baby.
I know.
Last thing I want to talk about.
They filmed that in Chicago, by the way, just so you know. I'm just throwing that out there.
There you go.
Okay, we'll talk on the side.
last thing to bring up here. Marvell continues to run here. I feel that this is one that also, I wouldn't say gets swept under the radar, but just another one that's just integral to this AI space, does all of the plumbing for all of these data centers. I think this only continues to grow as data centers and AI demand continues to grow, a lot like the memory stocks. So yeah, I've been a big fan of Marvell. I've been long that in the long-term portfolio for not the entire run, but about the back half of the run to this point. And I think there's only more growth in store for them.
Well, it's really, Jermal, what's really fascinating about those companies that they are semi-caps. They are the companies that produce the machines that you use to build the semiconductors. And so if you're seeing the bottlenecks in chips, well, what happens? The market's going to want to introduce more supply. How do you get there? You got to buy more machines. Mm-hmm. And so Marvell, ASML, they're sitting up at the highs. Again, the entire AI infrastructure stack, from memory to cooling to power, I mean, it's all just on fire still. Can't get enough of this stuff. Gus, what's your favorite trade right now? I know it's triple witching day. How do you behave and operate in a market around triple witching? Honestly, especially with a long weekend coming up.
Sure. I usually find myself more on the management side of the equation when witching days roll around. Honestly, I constantly, I keep a robust set of positions going in my portfolio at all times. So usually for me, it comes more down to management than looking to open when witching days like this roll around. I would say that, I don't know, my favorite trade right now, Probably long Meta. I just keep going back to Meta. We're in an abusive relationship. It hurts me over and over and time again. I still choose to go back. But Meta, off these levels, I really like everything that they're doing. I really think that these, especially the glasses, are a very bullish thing for me. I think we're only going to see continued adoption of Meta's newer products over the past few years. They realized that the metaverse was stupid and killed it, and now they're rolling into the actual things that are of the future, I believe. So I would have to say long Meta into the next few months off this mid 500 level is my favorite.
Buying Meta. I was really into the Snapchat CEO yesterday. I was walking around with those dorky AR glasses around.
Specs.
And I miss that kind of tech CEO when these people are being, put out on stage and embarrassing themselves by wearing this clunky hardware and trying to convince us like this is the future.
Yeah.
Let's go back to that. That's fun. All right. We're done here with Gus. Gus, thank you. We can put you back into the Reddit mines, and we'll bring you out later today. We have another guest coming here who's first time on Tasty Live, Jessica Ramos. She is a trading instructor. You probably know her on Twitter at Say Yes to Jess. She's also Jermal. She's also a Knicks fan who happens to be in New York City right now, which means she's in the center of the universe. Jessica, my jealousy, if you could tell, is coming through. I try to convince our producers we should do something at the stock exchange Thursday, and it was turned down.
That would have been awesome.
I can't believe they said no.
Oh.
Hi, Jessica. How are you?
I'm doing good. How are you? Thank you for having me.
Thanks for being on. We love it.
Jessica, I want to talk to you about your trading process here a little bit because you do call out levels in real time on social media, and you're very open and you explain to people about how you work your way through the market. You're very disciplined, having seen some of your stuff in the past, and that's very hard for new traders to do. Mm-hmm. I'll just let this loss run, or I can move my stop, or okay. So for most new traders, managing the risk and finding the setups is the most difficult part. When someone is just getting started in trading, what's the first thing that you're trying to fix? Is it strategy? Is it risk management? Is it psychology and approach?
It's psychology, because the first thing you have to be comfortable with is losing. And we are naturally programmed to win. We want to perform, we want to do great. That's just what we do. So having to get comfortable losing and learning from those lessons is the hardest part about being a trader. And when you understand that it's the tuition that you're paying in order to be successful, you start to trust the process and you take it more seriously. So it's about changing their mindset, not to be a comfortable loser, but to understand that this is just a part of the process. It's adaptation. Make the changes that you need to make, learn from them, and you'll start to see the results that you're looking for through any strategy that you implement.
Jermal, that's why Mets fans and Knicks fans are better traders than Yankees fans, because all we know how to do is lose and still show up for the next. Jess, this is like causing my brain to be rewired. Like I've seen myself as this loser that always is resilient, and we always come back, and now like we won something.
What 27 years? Right, 53 years.
53.
And years. 27 since finals, so that's huge.
It's true, incredible.
It's awesome. I'm happy for you guys.
Jermal, I'm like drunk on Knicks highlights right now.
I know it.
It's all I'm watching outside of work. It's like, kids, Daddy's got to watch the hand of Og tipping that ball.
I know it. I'm seeing all kind of stuff, man. I saw like sort of this mock-up of one of the movies that I love, Belly, with Nas and DMX from back in the day, and those dudes walking into the to the club. That was hilarious to me. Jessica, what are the things you love to trade? Little Birdie told us you like to trade SPY, you like to trade GLD. Is it the ETFs that you like more than anything, or do you do any futures options? How do you set your days up?
So I trade both. Typically, I will trade gold in the evening, anywhere between Tuesday to Thursday. Gold futures, excuse me. I'll look for a setup between 8 to 10 p.m. Eastern Standard Time. My trade typically will play out until the next day, and I'll compound a position around 10:15 in the morning. And I'll either hold for another 24 hours or I'll be done by the end of the day. I'll just hold and trail my stops. And while that's going, I will look at SPX, definitely ETFs. SPX, SPY, QQQ are my primary ones. They're easy to trade. They're very predictable. So I'll look at that. I'll look for a setup sometimes around now, like around this time, or I'll look for a pullback between 11:30 to 1:30 to see if I can get something for an overnight setup. I haven't been trading the morning madness anymore. Usually I do, like I'm in there by 10:15, there's a pullback. a little bit earlier, but I've learned that the afternoon pullbacks have given a really nice overnight gap, and I'm in profit at open, maybe in there for another 15, 30 minutes, and I'm out.
Could you just expand on why you choose to trade gold during that specific time frame? That's the Asian hours, of course, so U.S., Europe are closed. You're not the first person who I've said that they like trading gold at night around the Asian Open. Why is that?
It's the best setup. It's the best entry setup, minimal drawdown, very predictable. I studied the behavioral patterns for years. I came from Forex 9 years ago. It was once afraid of gold, so I took on the challenge to study it, learn it, and it's been very predictable. And I do use the dollar index as kind of like an indication of what's going because of the negative correlation. And that has made me really successful with it.
I mean, she trades Forex, she trades gold. She's the female Chris Vecchio, it seems like. She roots for
I
the
don't
Knicks.
think Forex anymore.
But that's it. No,
much
I bring that up because that's his background, actually.
That's where I got
Chris's
started.
background.
Oh, very cool.
Yeah, so you guys got a lot in common. Yeah, what do you are you? So does that mean you don't really do too much with sort of individual names? Obviously, SpaceX has been a hot button topic more recently. Is that something you pay attention to? And all those things you mentioned too. Is it more futures for you, or is it options as well? Do you do involving
And
the options?
options for me is easier. It's easier money to make, in my opinion. It's more predictable. Same retracements, Fibonacci retracements. It's very predictable. So for me, it's like that's my automatic go-to money. And then for futures, if I want a thrill, I'll do that. And I typically trade about 2 days out the week with futures. I do swing, so I'm holding. And if I see a setup, great. If I don't, it's no big deal because I'm usually putting my money into stock options. Like that's what I look at. I do trade Tesla. I do trade Meta. I trade AMD. Apple's very easy. SpaceX. I haven't traded SpaceX because I knew this drop was coming after the hype. So I'm waiting to see if we can come back to this gap around 170 area. I'm looking to see how price reacts to that first before I even think about trading it to the upside. Now, options wise, the sell has been easy, but for long term, I'm waiting for that pullback.
Yeah, trading around an IPO is always difficult. I personally, one of my trading rules is I don't trade a stock on the first day it's trading, and obviously the options are not not applicable because they're not there. We just got them listed 2 days ago here. So, how do you stay consistent in a market where you got all these crazy headlines and narratives? It seems like you just ignore them. You have a little bit of a system here. You trade gold at night, S&Ps during the day. You have your technical levels. You're looking at volatility. Do you just can a trader be successful ignoring the headlines, the news, the fundamentals of it all?
I have been. News moves my trade in a direction that I already anticipated. And the biggest takeaway with this is to use higher time frames. And I will stress this until the day I'm no longer here. But anytime there's an FOMC, a CPI, a PPI, any type of high economic news reporting, it's usually right around a weekly, a daily level, a very strong level, or market structure. And if I get that indication, I just know, it's around there. For example, let's look at SPY yesterday. Everybody was anticipating a gap fill, right? That's common sense. Like most people were anticipating that. But what we actually retested last week's close, and we also retested the 50% fib, the bullish fib on the higher time frame. So that was already expected because we were due for a retracement regardless. And we had all the technicals that told us that. I didn't know what news was going to be. I didn't know if we were going to have a rate cut. I didn't know if they were going to stay the same. I did not know, but the technicals told me what was going to happen. And it went right to a weekly level. So again, this is something that I've back tested so many times throughout the years that I'm very confident in it. And I was a little worried because we have a new speaker, but only one thing was different, which was like the movement of the candle while he's speaking. So that's one thing I'll go notate, and I'll check to see next time he speaks if it does that.
Yeah, Jermal, it sounds a lot like how I approached that yesterday with the NASDAQ when it was selling off. We had our key technical level. As long as we hold it, we don't need to panic. We fill the gap. We've held it. Let's add another position in, and that's what we did.
Exactly.
So, you know, you have to. You can. There's more than one way to skin a cat, as they say, or more than one way to win an NBA championship. You don't need to have a 7'6" center to do so,
or take $100 million pay cut.
Well, it's funny. I was just about to ask you who's your favorite player on Knicks. I feel like based on that statement, I kind of know who it is. Is that the case?
So here's the funny thing. I live in Orlando. I'm in Orlando, so I cheer my magic. I'm at every probably magic game. I always post it. And but Brunson is obviously good, but the whole team. I mean, we have.
But you grew up in New York, I assume, then, right?
I'm from the Bronx.
I
That
knew
will
it.
never go away.
I knew it.
I'm a Bronx girl. I was just on Fifth Ave a couple weeks ago shopping. So yeah, I'm always there. But I like the entire team, and I'm not just saying that because I don't know my sports. I think they understand Brunson's strengths. They understand one another, like where they come through. They're great at those, those three pointers that we need to get us, like they work well under pressure. So collectively as a team, I think everybody does great. I think MVP was rightfully deserved. I love basketball. I am more of a football girl. I'll just when we ever get to talk again, I'm a football girl, but
love it.
Yeah.
Well, as a Jets
she
fan,
trades and she watches
to,
sports, Chris. I mean,
I try not to talk about football.
So don't get on me, but I have been an Eagles fan for like 6 years. So I am a bird. I go birds.
Curveball.
All right.
I'm not a Giants fan, but I am an Eagles fan. I mean, if you have good football IQ, we have
I like Jalen. I do like him.
Yeah, Saquon is amazing. Jalen's a great quarterback, but Saquon is absolutely amazing. So I know. I'm probably going to get a lot of hate in the comments.
Jessica, I went to college outside of Philadelphia, so most of my friends are from the area are Eagles fans, and you know what? Our new CEO is from Philadelphia. Philadelphia is the best city on earth. I'll leave it there.
Go Birds.
She's been Jessica Ramos. You can find her on Twitter. Say yes to Jess. She's a trading instructor. She puts out her trades in real time. She scalps the market, gold, S&Ps. Thanks for joining us here on Tasty Live. Hopefully we'll have you back again in the future.
Good to see you.
All right, have a great one. Thank you so much.
Jermal, we continue to press on. This market is holding up here. It feels like we've been doing a little bit of jostling. Maybe Tim didn't like my description of it oscillating, but when you're bouncing between 1.5 and 2% up, it seems like that's an oscillation. I digress. 2% up again here on NASDAQ. 75.63 in ES, 30,603 in NQ. Getting a little bit more levity through those highs that we had around the Fed meeting yesterday, as it were. Volatility is still pinned here. 1707 on the VIX, down $1.40 right now. The market isn't really so concerned. Seems to be unclenching a little bit here as we make our way through the session.
Yeah, it's definitely sort of triple witching taking place. There's a lot of things that are happening today that I don't necessarily know if carry over going forward. So, that happens. I think we're seeing some kind of little weirdness in the triple witching situation.
We're going to take a brief break here. When we come back, Q's going to give us live from the trade desk, and we are going to squeeze and confirm and send. Jermal, we promise we're going to deliver. We can't let the people down. You're watching Tasty Live. See you in a brief, 60 seconds.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options, profit, and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
So why are we all doing all the things that we do inside of the active trading space? Simple. To make money and generate returns. Well, inside of the Tasty universe, there are essentially 5 keys to making those returns. And in this crash course, we're going to break down all the details of each one of those keys. So I'll see you inside.
Tasty Trade has crypto, and you can trade with 0 commissions, Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
First thing about Tasty Trade is how easy it is.
It's a very quick, light platform. It's all on one page.
And with 1 or 2 clicks, you can be anywhere on the platform.
Being able to see graphically where your profit and loss zones are.
Whether it's a pool, a puddle, or a sea, you can navigate your way out of it with the Tasty platform. So I love that. You guys have the most unbelievable customer service in the business.
Email support, call support, get through right away.
They actively listen to the customers to make changes to the platform to make it better.
In fact, I've never seen anything like it in any corporation in the United States.
Jermal, we're back. It's that time of the day, which means it's time to find out what's happening on the trade desk. Sound the music.
You got to give it to him, or he's not going to talk. You got to give him the DDD. The Q's not going to talk otherwise. Literally, you won't.
Thank you.
He has stated he will not talk unless he hears DDs. So
that is very true. So thank you, Vecchio. We need to work on your DDDs a little bit, though.
I'm trying my best, man. I'm getting cooked out here today.
It's all right, fellas. How's it going?
What's up?
Nothing much. Trade desk has been good. Very busy morning, actually.
Yeah.
After yesterday, as you could imagine, the morning's been very busy. You know, we had the AM options this morning as well. And so, yeah, a lot of activity going on the trade desk, whether it's assignment or just people talking regular trades. As always, been a very active morning.
We've seen that this is a triple witching day, so we're getting a lot of volume and flow through the market, obviously. All things considered, though, I'm looking at the S&P 500, only 664,000 contracts traded here today. That does seem somewhat light, comparatively speaking. Mm-hmm. What are the figures looking like on your end here? What are people trading right now? More importantly, how are they operating around this market ahead of what's now a holiday weekend?
Yeah, I would say typically when it comes to holiday weekends, a lot of people are usually taking that risk off for the extra day of that weekend when they can't manage their positions. And so that's what we've been seeing a lot of customers managing rather than placing new trades, rather wait until next week. And then we're getting in the thick of the summer months where there's typically a lot of bouncing around in the market as well. And so that's what we're seeing from the customers.
Jermal, this Thursday here is giving us a little bit more levity in the AI trade. Q, I'm assuming that a lot of people are still focusing on SpaceX, the Microns, the NVIDIAs of the world.
Yeah, SpaceX, Micron, NVIDIA, SNDK, things like that. Those are for sure the most active symbols that we get questions about, whether it's like actual volume or the questions from the customers. That's what we're seeing a lot of.
What are the top tickers? Yeah,
because your list is always one of the most interesting things as far as consumer sentiment to me. I mean, you can just see what people are trading, and it just shows you how people are leaning in the market. Not necessarily delta-wise, but just what names are the most active and has the most volume.
Mm-hmm. Yeah, exactly. Let's get to it. Top 20 symbols going through the system and their IVR. And then for Laura, no ETFs or broad-based indices. At number 1, SpaceX with a negative 63, just because there's, volatility is contracting intraday and there's not much to compare it to. SpaceX, the negative 63 IVR. And then Intel, 89, Tesla, 29, Micron, 93, NVIDIA, 19, TQQQ, 70, Microsoft, 58, Palantir, 23, Broadcom, 38, Marvel, 93, Apple, 34, AMD 87, Robinhood 64, Meta 44, Amazon 24, Google L 30, SNDK 88, SLV 31, Netflix 84, and MSTR 55. Again, lots of four-letter symbols, lots of NASDAQ, lots of tech.
No question. And SLV sneaking in there a little bit today, if you will. I also noticed that Apple and Microsoft are the only ones that kind of have an eye off there.
Yeah, I mean, I would say like the tech, because this is where all the movement is, right?
Sorry.
Is the tech
Messed up a little
names,
bit
the
there.
AI names, things like that. And IVR is pretty high across the board. So a lot of opportunities for premium sellers looking to sell options into those high IVR numbers.
You know, what's so interesting about Apple coming back here, I feel like I haven't seen or heard Apple's name at the top of any of these lists in terms of, most interested stocks to trade or highest trading volumes on our platform and other brokerages for a number of weeks here. And when I think about where the trading volumes have shifted, because I listen to what you have to say here. I've noticed that names like Palantir and Broadcom have fallen down your lists over time. And you're starting to get almost like maybe this was in the run up to SpaceX. People were taking down speculative capital elsewhere, kind of putting it on the side to get ready to trade in SpaceX. But Apple all of a sudden has started to rise back on these lists. And the speculative names have indeed kind of fallen off. Do you find that maybe as we're going into the summer months, people are falling back into perhaps a little bit more of a familiar trading style? And I point that out with saying that over the past 3 days, according to Bank of America, this has been the lowest retail stock buying volume on a rolling 3-day basis that we've had in all of 2026.
Yeah, which I find very funny because I don't think that matches our numbers like at all. Like our activity just keeps increasing across all the months. I don't know necessarily for stock trades, but when it comes to options trades, that's usually what I'm looking at. We still see so much activity, like increasing all over, at least from our customers when it comes to retail volume. And so, yeah, I'm thinking that like over the summer months, as volatility is still there across, the broad-based ETFs and indices, things like that, people might be moving more into those names rather than, the speculation's great when things are going up, but after that first down move, people get a little skittish typically when it comes to those more speculative names like the Palantirs and things like that.
Palantirs and things like that. Well, we have Apple here, $299 right now. What's the name that stands out most to you on this list? And you've mentioned that activity is going up. Obviously, when you have a market raging like this with the volumes that we're seeing, clearly there are people who are trading it. But what stands out to you the most over the course of this week? How people's trading preferences and the tickers that they've been using have shifted?
Yeah, I would say a lot of people are talking about the SpaceX, especially when it comes to that IVR, you can sort of ignore that because it's looking at the past year, but it's only at a couple days of volume, right, when it comes to options. But I would see a lot of people are trading the SPX, and a lot of people will see potentially, a lot of mispricing when it comes to those options based on like what they think the underlying might do, just because the options are so brand new, right? There's not much history when it comes to SpaceX, and so people are thinking there might be an opportunity, whether that's to buy or to sell. That's up to the investor. But it would be like, where can I find that opportunity since these options are so new?
SpaceX to me has been the single thing that's drawn most of the market's attention. The data continues to pour in, but the amount of trading done in SpaceX has been basically equivalent to every other single stock combined right now. Are you seeing that kind of interest?
One. Yeah, we're seeing that kind of interest across customers as well. And I can't believe it's just taking over Tesla as like the king of volume on the list that we go over.
It's already at 75 million shares traded today. Just by comparison, NVIDIA is only at 60 million shares. You can go over to a Meta. Meta's trading at 7.5 million shares. Micron, 20 million shares, right? So SpaceX has quickly become one of the most liquid tradable vehicles in the world less than a week into its inception. By the way, Jermal, NASDAQ now up 2.1%, S&P crossing the 1% threshold, Micron $1,129, SMH soaring into new highs here, up 657 as it were, Jermal. We do need to get there quickly though. We're gonna running a tight ship here this morning. So we're gonna say thank you to you. Jermal and I need to get over to Confirm and Send. We have a cherry bomb coming up from Tom Preston, so we're gonna keep this train moving. Live from the trade desk. That was Q. Jermal, before we go over into those Confirm and Send, I want to go back to this SMH trade because the levels that we're looking at here are being pushed through near 653. We're going out to 43 days. the shift has occurred, right? The profit potential here is not the same as it was, but 62% probability of profit at 43 days to expiration, 600, 615, risking 2.5 to make 1, almost a 2-to-1 actually on this. I'm very comfortable with that. Let's get the order going. We have our technical condition in place to add a little bit more to the semis, which I have a lot of right now. I've got.
You're in it. You're in it.
I'm a momentum junkie. It's the momentum name in this market, so I can't, I'm like a moth to a flame. Maybe I get zapped again sometime soon. But Jermal, we want to go through the questions that people have brought to us here at the show before we bring on Tom Preston for his cherry bomb here. Can we throw up the slides for confirm and send? Let's run down these quickly. Thanks to the audience for sending in these questions today.
Let's do it.
There we go. All right, Jermal, let's get through this. On the platform, I see both IVR and IVX, and I know they're not telling me the same thing. As a trader, how should I use each one? When would IVR matter more, and when would I use IVX to give me a better read?
Well, this is funny because this is a fantastic question for Tom Preston himself. But I will say this. IVR is looking at the rank over across time, right? And so it gives you an idea that currently this is higher, this volatility, this particular IVX. IVX is sort of the measurement of volatility, kind of I think it uses a VIX style calculation, looking at downside and looking at the tails, downside and upside. But it's more of just looking at the implied volatility itself versus the IVR, which is the rank. So how does this rank across the last year versus what is this currently implied volatility at this moment in time?
Fair enough. Next question. Jermal, when selling a strangle, do you choose strikes mainly by delta, by expected move, or by the chart? I'm trying to understand what actually drives strike selection. This is a great question.
I mean, to keep it simple, they're kind of similar. If you look at the expected move, that should usually be somewhere around like a 15 delta, depending on the name. Usually, if you look at that, that's kind of where they line up in a lot of equities. If you're looking at that expected move, and the expected move is like kind of within this window, and that's the orange bar. Usually, at the top of that is the downside, and that's usually around like 17 to 19 delta, and the same thing to the upside for the most part. So I kind of use both in a way. It's like a double check. Is it in the outside the expected move? If I'm selling a strangle, cool. What is the delta? Probably 17 to 19.
And I got layer in the chart there. You got a good chart set up with all that. I'm with you. That's why there's no one approach that works. You can blend everything together to give you more confidence and an edge as you get into a trade. We can go to the next question here. Let's see. On the platform, I see both POP and P50, and sometimes they point me in different directions. As a trader actually choosing between trades, which one should guide the decision more? The probability of making any profit or the probability of reaching the 50% profit target?
This is an interesting one because these are fantastic things to look at as far as data-wise. I honestly don't look at this on every single trade when you're looking at your chance of making 50, the chance of making a profit or 50% profit. I look at POP more than anything, right? Because usually I want a good POP number. I want something greater than like 60% for the most part. And so depending on the trade, of course, right? You don't always get you're not going to get those butterflies for the most part. But I just look at POP more than anything. I actually kind of ignore the P50. I just look at POP.
I'm with you. I pay more attention to the POP. And because when I'm doing something like a long call or a long call spread, right? I'm the whole point of buying the long out of the money calls is for the juice, is for the convexity. So I want to do more than 50% on those. We can go to another question here before we bring on Tom Preston, TP here. If IVR is too low, but the options still have good liquidity and tight markets, is that an automatic pass for selling premium? Or are there still setups worth taking? Jermal, if you don't mind me answering this, there are still setups worth taking. You have to give what the market gives you, right? You go to war with the army that you've got. It may force you to adjust where your strikes are or your risk management or your duration cycle. But yeah, if there's low volatility and it's tight markets, I'm going to make the trade if the chart setup looks good for me.
Yeah, and there could be a situation where it's low vol. The name is, on its lows, and you're interested in selling a put in there. That's one situation where you'd probably sell something because you just want to. That's classic old school. Like I want to potentially take stock at this level. That's that's not necessarily selling vol. That's just saying if I'm right, I'll eventually get filled on stock at a level that is advantageous to me. If I'm wrong, the worst thing that happens is that it moves away from my short put strike and I still make money. So there's different ways to do it. There's also other setups.
Jamal, that has been another edition here of Confirm and Send. We're running over, but it's been it's been a good morning so far. We've kept the pace going here. We've had a lot of good guests so far. We have another great guest coming up now. We're just going to hand it off to Tom Preston for his cherry bomb. I'll be back in a little bit. You're going to get Gus and Errol for a quick risk to reward, and I'll be here for a FOMC breakdown with Kim Escue, who's a portfolio manager over at Shelton Capital Management. So we'll be speaking with them shortly. TP, take it away.
It's all yours.
Okay, what's going on? Let's talk about some trades today. And okay, let me check something here. Make sure my video is coming through okay. Okay, so we're having a market rally today, and one of the things that I like to look at is different sectors that are responding. And one of the trades that I talked about in the cherry bomb this morning that you can get if you sign up if you go to Tasty Live in the News and Insights page, you can sign up for the newsletters. My cherry bombs come out every day, and the cherry picks that I write come out on Tuesday. And this morning, I sent one out talking about XLF. Why XLF? XLF is the ETF that tracks bank stocks. And what's interesting about banks right now, they're all rallying a bit today. On the news, first of all, the whole market's up. Okay, SPOs are up, and that's dragging every sector higher, or just about every sector higher. But interest rates are a key part of a bank's business model. So banks, obviously, the way they make money is by taking in deposits. Our cash, your cash, my cash, and investing it in interest-bearing products, T-bills, or different investments they can make. In turn, they pay a part of that, a fraction of that interest they earn back to us as our earnings on deposits. And that works true. The same is true for CDs, things like that. But banks and brokerage firms typically make a little bit more money when interest rates are higher. So the bias towards when they came out with the Fed minutes yesterday, and Forrest was talking about how you get a majority of the governors thinking that rate hike is going to be more preferable than any rate cuts later on this year. And the probabilities generated by the Fed funds futures suggest that. Okay, so we're getting confirmation by the actual markets that higher interest rates, even in the short term, are going to benefit banks. So that's why I was looking at selling a put in XLF. XLF is a nice, it's a liquid product. Has lots of options to trade, and is a relatively high IV rank. So I was looking at selling the 50 put in there, and I know the guys are talking about the P50 number versus the pop number. I disagree completely with what they're saying. The P50 number is the probability of making 50% of the max profit on a trade. Okay, and I think if I recall that P50 number for selling that 50 put in the July expiration in XLF had, I don't know, a P50 number, maybe 75, 77%, something like that. What does that mean? Well, if I sell that put for, let's say, 40 cents, the probability of making half of that, 20 cents, is about 77% before expiration. P50, you will only find that on this platform. Why? Because I created it and I didn't give it to anybody else. So the P50 number is something you can only find here. It lets you take trades off once they hit a certain profit target. P50, making 50% of a max profit on a short put or a short put spread, something like that, or a short call spread or a naked short call. Either way. It's a great number to use because you can capture that trade, capture that profit, and move on to the next trade. So the P50 number is what I rely on. You can look at POP. You can be a probability profit. Probability profit is making at least 1 penny before expiration, or at expiration. Not before expiration. Let me restate that. So the P50 number is usually higher than the probability of profit for a variety of reasons. I'm not going to get into the math of that. But if I sell that 50 put and it has a 77% probability of 50% P50 number, it might have a probability of profit of maybe 65, 68, 70%, for example, of profit at expiration. That means that short put would make at least 1 penny of profit at expiration in 29 days. So that's the XLF trade that I'm looking at today. A couple of the other things I'm doing today. I'm looking at some short put spreads in the grains. Corn right now has had a little bit of a rally over the past couple of weeks, but the ZCs in the July options. The trick with the corn futures or any of these grain futures is you have to watch out for the delivery period, where the future goes into, I'm not saying it gets wacky, but there's a point where you can actually take delivery of the underlying corn or soybeans or wheat or whatever. You don't necessarily want to get into that. It's not catastrophic. The corn just means you own some 5,000 bushels of corn in some silo in Illinois or Iowa or something like that. It's not the end of the world, but it's not great to trade. If they become illiquid, you don't want to do that. But the last trading day, I think for the July futures, somewhere in the middle of July, looking at the June options with about 15 days to go, in corn futures, I'm selling some put spreads in there, just as a contrarian trade. The skew is pointing towards the upside in corn options, and so why not? And again, it's a hunch. You could do that in. I didn't look at soybeans or wheat for the skew specifically, but they're both bouncing now. Corn, it's just I like to trade corn a little bit more. So that's what I'm looking at for today. What I would expect going for the rest of the day, I would expect to see the S&Ps continue to rally, only because the research we've done is that after a big move in one direction after a Fed meeting, like we had the big sell-off in the S&Ps, taking the other side of that, in other words, a bounce back over the next day or a couple of days, is more likely than not. So just like we saw SPOOs down 100 points yesterday and up 50 today, up 60 today, I think we're going to continue that, or at least close higher on the day. So that's today's cherry bomb. Thanks, everybody.
First thing about Tasty Trade is how easy it is.
It's a very quick, light platform. It's all on one page.
And with 1 or 2 clicks, you can be anywhere on the platform.
Being able to see graphically where your profit and loss zones are.
Whether it's a pool, a puddle, or a sea, you can navigate your way out of it with the Tasty platform. So I love that. You guys have the most unbelievable customer service in the business.
Email support, call support, get through right away.
They actively listen to the customers to make changes to the platform to make it better.
In fact, I've never seen anything like it in any corporation in the United States.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Tasty Trade's active trader interface makes futures markets your arena. Built for the bold, not the bored. Trade CME futures with a single click, from micro contracts to major ideas. And go even further with futures options. tastytrade lays out multiple ladders and charts for total visibility. Plus, hundreds of built-in indicators for traders who want a broader view. tastytrade, pro-level tools, intuitive design, total control.
If your trade's not going how you expected, it's not necessarily that your assumption is wrong. Maybe it's just not right. Yet. Rolling is managing a trade by closing your position and opening another one like it for a credit all in one order. The cool part is that you can change the expiration to get more time, or you can tweak the strike for a higher probability. Usually we want to roll the expiration instead of the strike. Remember, duration over direction. Exactly when and how to roll trades is a learned art, and it can be a little bit subjective. Usually we only roll if we haven't changed our assumption, and we almost never roll winning trades. If you have changed your mind, don't roll. Instead, you probably want to close it if it has undefined risk, or just let the probabilities play out if it has defined risk. So before you cut your losses, consider rolling the expiration or maybe even the strike. Pretty simple.
Just for a minute, let's forget about your favorite stocks. Just for 1 second, let's leave specific strategies on the shelf. Let's talk about what really matters. Your portfolio. How do you build it? What should you target? How do you manage it day to day? The answers to these questions and more are inside our newest crash course. So I'll see you there.
When you trade options at tastytrade, you see your probability of profit and loss right where you need it. Earn up to $3,000 in commission rebates.
Trader interface makes futures markets your arena. Built for the bold, not the bored. Trade CME futures with a single click, from micro contracts to major ideas. And go even further with futures options. tastytrade lays out multiple ladders and charts for total visibility. Plus, hundreds of built-in indicators for traders who want a broader view. tastytrade, pro-level tools, intuitive design, total control.
If your trade's not going how you expected, it's not necessarily that your assumption is wrong. Maybe it's just not right. Yet. Rolling is managing a trade by closing your position and opening another one like it for a credit all in one order. The cool part is that you can change the expiration to get more time, or you can tweak the strike for a higher probability. Usually we want to roll the expiration instead of the strike. Remember, duration over direction. Exactly when and how to roll trades is a learned art, and it can be a little bit subjective. Usually we only roll if we haven't changed our assumption, and we almost never roll winning trades. If you have changed your mind, don't roll. Instead, you probably want to close it if it has undefined risk, or just let the probabilities play out if it has defined risk. So before you cut your losses, consider rolling the expiration or maybe even the strike. Pretty simple.
When you trade options at tastytrade, you see your probability of profit and loss right where you need it. Earn up to $3,000 in commission rebates.
What is going on, everybody, and welcome back to Risk and Reward. It is Thursday, which is usually the second to last day of the week, but as is well documented, it is the last day of the trading week today with Juneteenth tomorrow. It's also Triple Witching Day, and I'm joined as always by my wonderful co-host, Errol Coleman. Errol, how you feeling? What's going on?
Feeling good. Good afternoon, America. No, good morning, America. No, Triple Witching Day for sure. Shorter week in the market. I was really curious to see how this price action was going to pan out into the day. And we got a lot of whipsaw action at first, and then we really steadily started marching upwards to the highs. So it'll be interesting to see how much more pace this market has underneath it right now. But we'll get into all of that. What's new with you, brother? How are we doing today?
Doing good. Yeah, the AI trade is back. It seems.
It's back. Okay.
If it is a bubble, it's inflating further.
Right.
If not, we're moving to higher highs.
Yeah.
Either way, I'm a little long delta bias, so I'm a happy camper with all of it.
Nice.
What is killing me is Bitcoin. I will say. I can't believe this just continued downward action that we're seeing in Bitcoin through. I just can't believe that there's no bullish sentiment streaming into Bitcoin at these levels at all. And it just, as this trend continues, I just think more and more that the market really seems to think that the fair price for Bitcoin might be down around here somewhere. Bitcoin was, initially conceptually viewed as a gold-like asset. This thing, there is a finite amount of it. As time goes on, some get burnt, some get locked up in these old wallets, supply decreases, and price steadily ticks upward. And that could still pan out in the long term, but it just might be that the 60 to 80,000 level, I don't want to be too specific, but somewhere in this range that we've been range bound in since the beginning of the year actually is fair value for Bitcoin.
Yeah, and I see the point that you're making there. It was looking like we were getting a little bit of a relief rally off of those lows that we tested back in early February, actually. We slid back to those lows early June, trying to rebound a little bit there. But to the point that you're making, it doesn't look like it can hold on to much of its gains. And it's looking like the shorter term momentum in the market is headed downwards. So, I mean, it will be interesting to see if we get a retest of 61,000, 60,000. Again, I know last time we bounced at around 60,000. So, where is that fair value going to be? And where is that level in the market going to be for crypto for these, large investors to feel more confident in loading the boat again? So we'll have to see. We'll watch it pan out. But I mean, if we were to continue on this pace, I mean, it's got to be 60,000, 50,000, right? I mean, the market doesn't have to do anything, but man, I'd be pretty surprised to see if they let this thing slide down to anywhere near 40,000. I would genuinely be shocked. So maybe we're near a bottom where it becomes a little bit more of an attractive sale price for,
well, yeah, and it's important to note too that all of this comes as the broader market is rallying like crazy.
Absolutely.
Beyond new all-time highs through this entire time, and Bitcoin continues to sell off. And with the broader bullish sentiment going on, particularly as it pertains to speculative assets, which I don't know if I would throw Bitcoin fully into the speculative category anymore. It's obviously proven itself a little bit, but everybody's willing to be increasingly speculative with the AI companies of the world and all the companies that do the plumbing, the Marvells, the SanDisks, the memory companies. All of these are seeing such massive swings to the upside. People are still willing to buy and buy and buy off these insane highs, and yet Bitcoin can't find a bid. So it's a very interesting situation, contrary to the broader market. It's something I'm definitely monitoring. I don't know. Ultimately, it's just with every passing day, I become less and less confident that Bitcoin. I mean, I don't want to say ever sees 100,000 again, but that Bitcoin is back at 100,000 in the next, I don't know, year and a half, 2 years.
Yeah.
Like it seems like these might be the levels that we're looking at for a little while.
It's kind of funny too, because when it pertains down to the crypto market, it feels like we're always in a bullish market or we're like in a bearish market. I feel like we really don't, or we haven't taken much time to really consolidate within a wider range. So it will be interesting. Maybe it takes a little bit longer to get up to 100,000 this time, but it does feel like the sentiment has shifted a little bit in terms of just the tenacity, that the energy that people had for this product. I feel like it's gone into a little bit of irrelevance. So again, we'll see how it pans out.
Yeah, you're right. I mean, true neutrality in the crypto space really is something that's never happened. It's always been a hyper directional market, but I suppose we're just getting into, we're getting to the point where this sector has grown to where neutrality can kind of happen for a little while now, and there are potentially fair valuations for these things. And I've said a bunch of times that you don't expect Bitcoin to just 10x every year forever. That would be insane. I wasn't expecting anything like that this year either. But to be now, I mean, more than 50% off the highs, off the all-time highs, and just stuck at these levels is shocking to me to see. To not have put in any gains in many months now. It's quite something.
And I know many places makes a really good point here, especially now that we have institutional players. I like that the fact that institutional players are brought up here. And I think this is why it's a little bit surprising to see the action we've seen in crypto, because of the fact that there has been more institutional adoption of these products, more banks looking to build their own blockchains, produce their own coins. So we've seen the adoptions from the institutions, and you would think that would aid to the thesis that we'd be seeing a little bit more of a bullish rally. But at the same time, maybe we're just moving liquidity around the crypto market now, and maybe it's starting to become a little bit more of a stable asset. Maybe this is the beginning of crypto becoming a stable asset to hold or trade, because before then it was to the point that you made, we were heavily either trending in one direction, either to the upside or downside.
Institutions just suck the fun out of it.
Yeah, they suck the fun out of it. That's why I moved away from bonds, when I was like 4 years old.
When I was 4 years old. Hey, I was gifted a Disney bond at birth that was 15 years to maturity. So then when I was 15, I was given, I think, 10 shares of Disney that I still have.
Yeah.
I don't even know where these shares are. I've brought this up on air before sometime in the distant past, but I get a dividend check, a paper check from the Walt Disney Company mailed to me every year.
That's pretty cool.
Yeah. And I don't know, I don't know where the shares are. I could probably figure it out and move them into a portfolio somehow, but it's kind of fun. I just got this massive thing.
Do you know if you have at least 100 of them?
No, it's like 10 or fewer. It's not like
but I mean,
dividend checks. It's always funny because I'm always like, man, they spent so much more to mail this to me than the price of this check. Well, it'll be like 85 cents. Like it's like a giant fancy Walt Disney letterhead check for like 85 cents or $1.12 or whatever.
That's a pretty cool souvenir just to have. First of all, I was getting a check from Disney, and then I was gonna say if you had 100 tucked away somewhere, like maybe you could be selling some calls off of it, for the time being.
They send me the big like shareholder voting packet every year too. Like when I get the dividend check, and like if I wanted to, I could go through and check all the stuff and mail it back in, and like my
I'm not gonna lie, I think that's pretty far. I would absolutely be framing some of those. I hope you keep them.
Yeah, I have the shareholder packets. I have one or two of those from over the years.
That's actually pretty sick
because it's a funny thing, and I think we're obviously moving into a world where shareholder packets are going to become a thing of the past, and that'll be a cool little thing to.
Hey, look, if you want a front of the line pass, make sure you take Gus with you. He's just going to slam those documents on the table for us.
Do you know who I am? Growing for me today. That's the other funny thing is like I never even think to check Disney. Obviously, it's way up since I got it 11 years ago, but I don't know to what multitude or anything. These shares just exist. I don't know that I will ever sell them or do anything to them. But thank you, Grandma, for gifting me these shares of Disney at birth. Aside from that, I did go ahead and liquidate my short dated Meta. This was one I've been talking about for the last couple of weeks, really. I needed it over 605 by the end of the day today. On Tuesday, that looked excellent. We actually got over 605 for just a minute on Tuesday, and I'm like, oh man, the trajectory's there. Here we go. And then Meta, as Meta does, wham! Big day to the downside yesterday. Close to unched on the day today, opened slightly up, close to unched intraday, up 1% since yesterday's close. But yeah, I decided that this was a lost cause yesterday. After we were about halfway through that sell-off, I was like, okay, this is irredeemable by the end of the week. So I was able to get out at like a 50% loss, which isn't really too bad when you're talking about being $30 from where you need to be 16 hours before expiration, more or less. So yeah, I was pleased to be able to get out of those at not a total loss.
Is that one of those positions that feels good to just kind of be out of now and redeploy the capital elsewhere? How are you feeling about
it's
being
like
out of now?
Yeah, it's like it's sort of like the end of a relationship. I joked earlier on the show with Jermal that Jermal and Chris that this is like an abusive relationship that I'm in with Meta. Like I just keep being bullish and it just keeps hurting me over and over, and I just keep getting long and going back in.
Stockholm syndrome.
Yeah, exactly. So it's sort of like that, where it's just like I wish it would have worked out, but I'm just glad that it's over and I can move on. But don't get it twisted. I'm still very long Meta. We have, let's see, I'm sure it's down here in the loser column somewhere. Oh no, right here. No, we're up on the day a little bit. We still have this other ladder going on. I have a 183 DTE 690 700 and a 547 DTE that's December 17th 2027 820 830 vertical on Meta. I got this one at something like a 6-to-1 risk premium. Usually, and I'm a leap guy. Yeah, anyone who's been watching for a while knows I'm not afraid of a leap, or at least getting 3 to 6 months out. But 2 years out is a little long even for me. And if I wasn't being rewarded with that kind of premium, there's no way that I would do this.
Yeah.
The only other situation where I'll get long, that far out is naked calls, like a pure leap.
Sure.
The only time I would ever do something defined risk this far out is if I could get a 5-to-1 or better sort of risk premium. There has to be orders of magnitude on the table for me to put on something defined risk this far out and tie up the capital for that long. Because it's just like, you got to think about what you're getting out. If it's, say it's a 1-to-1 risk premium 2 years out, it's like you want to tie up this money for 2 years to get a 1-to-1 risk premium when there's other products where you can get a 1-to-1 risk premium a week out. Like it's, you don't, it has to make sense.
2 years is some time. I mean, your mustache is going to be growing some gray hairs by then.
Probably. Gotta keep it trimmed. If I let this thing go, I don't know what would happen. I'd look like the Lorax. We have this bonds position that you and I put on together, which is going swimmingly. TLT up over 87 now.
Up on the day as well.
Only needed over 85. Yeah, up on the day. Just a nice little growth chart happening with
bonds. Bonds are back. Bonds are back, baby.
Yeah,
bonds are cool again.
This gap up that we got today. Obviously, Warsh's first meeting as Fed chair yesterday, first FOMC, had an initial impact on bonds, but the momentum seems to be swinging right back into them. So yeah, happy to see that. Shout out Kevin Warsh. Interesting, which by the way, I don't know how much you read into the minutes of that meeting in general, but it's going to be different.
How so? What are you insinuating?
Warsh has pushed forever that the Fed over-explains. The Fed doesn't have to give as much information as they give, and he really stood on that. The statement that they released yesterday was 138 words, which is down from a 350 average during Powell. So he's slashing a lot. He's giving us the bare bones information, and we don't need to know anything else.
You think this is strategic rather than, I don't know, coming from personality or just the way that they like to conduct business?
No, yeah, this is like he has stood on this platform for some time now that he feels the Fed over explains. That's the word that he's used.
Okay.
We don't need to give these over explanations. We can be more concise. And that's exactly what he went in with yesterday. Much shorter statement. No major changes, but it seemed a little bit more hawkish. And it's going to be less. It's going to be less information, less guidance, less of all the things. And so the market is trying to price that in.
Yeah, absolutely.
Beyond that, what else do we have going on here? I put on this SMH position on air with Vecchio maybe a week ago now. 43 DTE on that, I guess.
Oh yeah, I heard you guys yapping about some semiconductors.
Yeah,
what's going on over there right now? Still sustaining the momentum.
Was that beginning of this week or last week? These days all run together in this eternally up market. But yeah, did get long some semis. I have a 570, 575 short put vertical on here. This was slightly out of the money when I put it on. I'm one to get in the money with these verticals sometimes for the risk premium that they afford, but I was able to get considerably out of the money when I put this one on at a 1-to-1 risk profile, basically. I might have been maybe risking 2 to get 1, but it was well out of the money, but looking good on this position on the semi space here. And the momentum just can't stop, won't stop on these things. This is another one. I mean, you look at SMH, obviously not as parabolic as what we're seeing with some of these memory stocks, but it is close to 100% move, even just since April that we're up. So this is one that has kind of quickly gotten away from the levels that I need, and I have little concern that we're going to reapproach those levels in the next 43 days.
No, there's so many new products like we've been talking about the last few weeks that are still rallying to all-time highs. I mean, it's SNDK, Micron, and I totally forget about the semiconductor space. I know of their relevance right now, but didn't even recognize a product like SMH is trading at about 656 right now at its highs today, putting in its high today as we speak. So, triple witching day. I guess it's the day to do it.
Yeah, I suppose so.
It's the day to do it.
Aside from that, nothing really too exciting happening for me. I mentioned that I took off Meta. Nancy Pelosi's going to lose me this trade, and I'm mad about it because Nancy, what are we doing?
Is that one AB?
Yeah, Nancy's the greatest trader of all time. She has a multi-million-dollar position in AB. I've had this open 143 days, so that's how long ago she put her position on, and it hasn't moved. Nancy, what?
Yeah.
You know things. How could you be wrong?
Yeah.
How is this taken 143 days and it hasn't moved, Nancy?
She's got to throw in a dud to make it seem legitimate.
It's true. She's got to throw off the scent.
Yeah.
Another Congress position I have going on here, if I can find it, is this Baxter International. I have a lot more time left on this one. This one is really strange. I am up on this position just slightly, but this is another one I saw The congressman himself is escaping me. A congressman put on a $500,000 position in Baxter International. This is an S&P 500 company, people. If you weren't aware, 0.01% of the S&P 500 is Baxter International. But yeah, way down there at the bottom of the list. And I just thought this was so strange that somebody from Congress would take that big of a swing on this, because it has just had a terrible, terrible string of years, just down, 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 down as far as you look. It has shown no signs of growth. I'm shocked it's still included in the S&P 500 today. But my spot on this was in the mid-17 range, kind of down here at the bottom. And so the efficient market hypothesis certainly holds up in Congress, and this continues to rise. So I don't know exactly what the angle is there. This was basically a blind tail, which is never super smart, but there's some times when the position is so big and the company is so obscure that you just gotta dive in blind. These were both incredibly cheap when I put them on. Something like, 80 cents a pop basically. I grabbed two of them. But yeah, 35 call leaps. That's the other Congress position that I have going on. Hopefully a lot of meat left on the bone. We'll see. Obviously already up something like 10% on the underlying right now.
No, I see we're getting a lot of volatility in there. Bax, that is, what company is that again? Baxter
International.
I got you.
Yeah,
a lot of volatility. Solid IV rank. It's another good product to trade for the options.
Ask me what they do. I have no idea.
Can't tell you.
Could not tell you.
Could not.
But yeah, that's pretty much all the excitement that I have going on my end. Triple Witching Day, as I was saying earlier, usually winds up being more of a management event for me than a putting on new positions event. Just because I constantly have a portfolio that looks like this, and so much can change on these triple witching days, quadruple witching days, that I find it's better for me just to monitor, see what kind of alarm bells are going off. But the only alarm bell that I have going off today is MicroStrategy on account of Bitcoin, which we already discussed. My IBIT is so dead. along with that.
No, yeah, it's going to be an interesting day. Where's volatility sitting at right now, despite the market ripping to the highs? I mean, we're pulling it back a little bit off the highs right now, but still put in a pretty decent range, surprisingly, with Triple Witching Day. Got to say it one more time for you, Soul Train. And then also, again, it being a shorter week in the market, I see we're recovering from the volatility lows at 15, 18 there a little bit. So as the market's creeping up higher, volatility is still pretty muted right now.
Yeah, on account of it being triple witching and everything getting witched thrice, I believe, volatility climbing just a little bit here. As we've discussed, different goalposts for volatility these days. 17 is something you would typically consider to be an elevated VIX. It doesn't feel elevated in this environment that we've been seeing. But yeah, 17, 11, we're coming in at right now on VIX.
Yeah.
Slight little move up. Well, I shouldn't even call it a move up. Down from yesterday, elevated above the levels from the beginning of this week.
Yeah, disappointing that we didn't hold. I know we've seen a little bit of an expansion of volatility, and it was so interesting yesterday again. Prior to the FOMC releasing, we started to get a lot of chop. We started to get a lot of whipsaw action. That's the type of price action that can drive a scalper crazy. And I know for myself, at least, I've tended to kind of sit on the sidelines a little bit more prior to a binary event like that. But whenever the announcement did finally drop, we ripped towards the highs, cleared some levels, and then we put in a new day low. And that day low that we put in yesterday is sitting pretty close to that opening gap that we got on Sunday open on the futures market. I know last Friday we gapped up over the weekend, and we gapped up to about 29,916. We sell off yesterday to a low just above 29,916 to a low of 29,921. So pretty close. So it's going to be interesting too. Whenever we can get back down to these levels, I know we've tracked some statistics before on gaps being filled and whatnot, but seeing a weekend gap like that, just chilling in the market to kind of respect it, it's going to be interesting whenever we can get back down towards these lows. But with that being said, if we go back down to the lows and retest some of those prices, would love to see some volatility sitting above 20. I know we kind of got a spike in volatility yesterday whenever we went back down to 29,900. But it didn't sustain very long. Overnight, we got another gap up. So I really don't know what it's going to take to see, a VIX at least consistently stay above 20. Now I'm hoping again for VIX at 20, 21, 22, when that's what we continue to get. And I was hoping for a VIX at 25, 30 at that point. So I'll take the 20 if it wants to give it back.
Yeah. The gap fill logic is sound, and as you mentioned, there's good data to back that. But it's always important to remember that it basically just means they get filled sometime. But on what time horizon is anybody's best guess. Obviously, highly situational, particularly when you're talking about an MNQ, an NQ, a SPX. When you're attacking the broader market, often it can take a long while. So it can often be better to kind of sit on your hands and wait for that. Wait until it looks like we're approaching that gap fill, rather than blindly making a move thinking that the gap will get filled right away, because it's not always the way that things go down, obviously.
No, yeah, and lastly, just kind of taking a look from an order flow perspective, at both of those price levels, we have tons of sellers dumping into the market at those prices. So to say that they might be trapped might be pretty accurate. And then also, whenever we do get back down to these levels, it'll be interesting to see if we get any large orders coming through, because if these sellers continue to get soaked up, I mean, the price of the market is king. If they want to remain these prices at these levels, I guess we could see another all-time high soon. So that's something I'll be keeping an eye on for the rest of the week, at least headed into next week.
For sure. I'd be remiss if we did not discuss oil. USO is my preferred vehicle when I discuss oil. I know we probably have some CL fanatics out there. My apologies to you, but I'm going to go USO terms here. But yeah, continuing to dive down about another 2% on the day today. Did open lower. We've pulled back in on that a little bit. But yeah, we're sitting at just below 112 on USO right now, and continuing to sink. I'm really tempted. I'm really tempted to go bottom fishing myself. I don't know. I have PTSD about this oil situation. Really, for those unaware, the stupidest position in my account right now, and I have bigger losers, but this is the most brain dead thing I've done. Is these two stupid long naked puts on oil. Just so dumb. Just so dumb. Don't do this, you guys. Why did I do this? I don't know. This was totally a sell premium situation. Why did I buy it? I don't know. I was too excited. I was too excited that oil might dip. I had one of these go successfully when we got
that's
the fake
recoverable.
It is recoverable. We have time, but it would take quite the sell off. And obviously, with every passing day, Theta is beginning to eat me a little bit here, being this far out of the money. I made great money right here when we got this initial fake out move. I don't even remember which fake out headline this was at this point. We've had so many of them, but I was short oil. Getting into these levels, and then we got a big fake out headline, and there was a trade that I had on for like 12 hours that like 2x, and I was able to get out. And then we worked back up to pretty much my entry, and then it was like right around here that in my infinite wisdom, I was like, let's buy premium on this stock that just took a giant gap up. And suddenly we're back below those levels now, but so much time has passed that I'm way down on these positions. But like I said, I'm tempted to try to bring my cost basis down here and get even shorter. But I already have a lot of short exposure, and like I said, just kind of traumatized by my own stupidity on that original entry. So
these products got a little bit out of hand, very headline driven too. So a lot of uncertainty, a lot of headlines you really couldn't have seen coming, to be honest. So
just a lesson in choosing your angle of attack. I'm sure that Sun Tzu has a quote in Art of War about what I did wrong here, that maybe somebody could find one.
I mean, I will say again though, this is the first kind of crack in oil that we've seen. So if the market remains beneath these levels, we could see a little bit more air come out to the downside. So I don't know. You got a lot of time on those contracts. I think we could whip back around at some point, especially if we get any more headlines. So headline driven. Yeah. And I mean, it was about time we seen a pullback in these oil products. So with that being said, nice to see oil still continuing to make some downside moves for us.
Yeah, I'll start to maybe have a little bit of enthusiasm if we get below 100 USL, but until then, I'm depressed isn't the word. Unhappy. I'm unhappy. And then what else? What was the other headline I wanted to talk about today? Oh yes, Pfizer CEO is on his way out. Mm-hmm. I briefly mentioned this while I was on air earlier today. But he said that he is going to be out August 15th of this year. Pfizer has sunk to down 3% now. The joke I made this morning was shares only opened down 1%. And I was like, man, I'd be mad if I was a CEO and I left. And
you said this need to be down 10%?
Yeah. I only have enough impact in this company for shares to go down 1%. But he is being validated a little bit here. Shares down 3% now and continuing to drop on this news. I think this might be a buy the dip spot on Pfizer, and I'm looking for this. I'm waiting just to see if lower lows come through today. We have been gradually bleeding down. There's been some buying action with people with the same sentiment as me, but the bears still do seem to be winning. So not racing to put this on, but before the end of the day today, headed into a new week, I do feel like this is a good buy the dip level on Pfizer. Currently sitting at 25.09. Last time we saw those levels was pretty much at New Year's this year. It's grown to that point and has just erased its year-to-date gains. So feels like a good level to jump in with Pfizer. If nothing else, just for the logic that they're a strong company that I know isn't going anywhere, and they continue to have a giant hold in the pharmaceutical market. So I'm not gonna, hesitate to get long here. It would be leaps. I would do something 180 days or longer. Just let this all kind of shake out, because to me, the CEO of Pfizer doesn't actually matter all that much. Their product line is what carries them in their innovation and their lobbying, to be quite frank. So I just don't know that a CEO change is really worth this much of a sell-off to me.
Yeah, no, I mean, especially with something like Pfizer. Looks like it was a very difficult product to trade, I will say that. I mean, it's still got a pretty solid IV rank as well. And I'm a little surprised that volatility didn't increase a little bit more, considering the gap down in the sell-off today. But to your words, I'm sure the CEO is a little bit happy to see it down on the day, even if he doesn't want to admit it. Yeah. But again, with that being said, cheaper stock can definitely get pretty creative in there. 2509 we're trading at right now?
Yeah, 2509, basically 25 flat.
Yeah, cheaper stock can pretty much do anything you want in there.
Yeah, exactly. Could be a zebra candidate, actually. Yeah. This is sort of the classic spot for a zebra candidate, although volatility is obviously elevated right now as we think. I don't know. I mean, 19.9 IVR actually isn't that crazy at all, considering this down move. What is
SNDK and the microns looking like today? I could have swore I'd seen micron at another all-time high. I wouldn't be surprised if that was the case. But what is SNDK and micron up to?
Both good, but I've decided that there's another company in this fold that's not getting enough love. I mentioned this earlier today. That's Western Digital, which has done the exact same thing.
And Western Digital, man, let's take a look at wow.
It's the same. It's the exact same. It's just, I don't know why SanDisk and Micron get all the media coverage and I never see Western Digital talked about, but it's just another memory company in this same industry. The multitudes aren't as crazy as what we've seen with Micron and SanDisk. Well, I mean, I guess there's an argument to be made that they are. I mean, we're coming off, what is this, sub 30 at the lows, that being Liberation Day last year. And yeah, we're all the way up at 700 now, mid 700s. So yeah, I mean, actually pretty much same multitudes, something like a 20x, nearing a 25x here. Is that right?
Something along the lines, yeah.
Yeah, I can do math because a 10x would be 300. Yeah, I can do math. So yeah, I mean, it's the same multiples. I don't know why Western Digital isn't getting the same love as these other companies, but I'm going to give some love to Western Digital here. But yes, home memory industry doing really well this morning. Western Digital itself up another 8% and leading the pack, I believe, or at least it was at open. Micron slightly behind at 7.5, and SanDisk winning.
Everybody putting in a high today.
SanDisk up 11%. 11%. I mean, it's absurd. It's absurd what keeps happening with
efficient markets. Apparently.
Yeah. I mean, how? I mean, yeah. It's incredible. It's incredible that we can keep doing this with these memory companies. When you're talking with SanDisk, you're talking about a company that is up now 40x, 42 in the last year and a half. And it does 11% in a single day. It's incredible what we're seeing with these memory stocks. I know we talk about them all the time, and some people are probably sick of hearing about them, but it just can't be understated. I refuse to let myself grow numb to the insanity of this. No. And that's the craziest part, is I don't even mean it's insane objectively. Like it makes sense. There is fundamental backing for these moves. It's not insane. Like, I can't believe that it's at these levels and I'm going to get short because this thing has to come way down. It's just an incredible, real growth story. One of the most incredible we've ever seen.
No, it is. I think I'm going to have to add, what is that, Western Digital?
Yeah.
I'm going to add that one to the watch list. I'm really looking forward to these things cracking down if they operate that way. Like, for example, I know we had seen silver finally crack and show its backside. We saw gold finally crack, show its backside. Oil is kind of starting to get to the point where it's putting its backside in. I'm very much so looking forward to the SanDisk, Microns, Western Digitals now. Since I pretty much missed the boat for the long trade all the way to these insane, exaggerated highs, I believe, that we're trading at right now, I think it'll provide a lot of opportunity on the backside to the downside, whenever we slow down off this parabolic momentum run that we've been on lately.
The crazy question starts to become, have we missed the boat?
I don't think prices will remain. Are you saying this could maybe have another leg to put into the upside?
If I came to you and I said, hey, I have a time machine and I'm from the end of 2026 and SanDisk is at 3,500. Are you shocked? I'm not shocked.
No, I'm not shocked, but I'm not shocked at all. But I mean, good Lord. I mean, how do you position for something like that? Because if you load the boat here at the highs, I mean, who's doing that?
Yeah.
You know what I'm saying? Like at the levels that we're at now without getting any type of substantial pullback. So I don't know. We might miss the boat. Maybe this goes to 3,000. Maybe it goes to 4,000. At this point, I think the sky's the limit. So I'm not going to try to guess the top, but whenever we do get some type of substantial pullback and we do have some type of relief to the downside, it'll be nice to attack those opportunities. It's just a little too uncertain for me, at least. It's like definitely we can get on some long delta here, but I don't mind missing the boat on this one.
Look at these premiums. It's
very expensive. I mean, any strategies is very expensive in those. I mean, look at that $1,000 at the money.
I mean, yeah,
it's insane.
$1,000 a contract. I mean, it's incredible. It's incredible what we're seeing with these memory companies. But that's enough of beating that dead horse. Western Digital exists, people. Western Digital propaganda coming from me. I'm not even really partial to them. They just deserve love. I don't know why they're not getting any love. They deserve more love. And then, metals. I haven't had a look at metals at all.
They've been pretty volatile. We got
SLV, not anymore.
We got a little bit of a recovery overnight and kind of just been giving back most of its gains.
Yeah, just sinking a little bit here, down another 1% on the day. This is another one. It's kind of similar to oil, where I just don't really know where the bottom is, and especially with these metals. Like, zoom out a little bit here for a better picture. It feels like we're really beaten down because everyone has these levels
the top is in
their mind, and this is when they were getting all the attention. I think the top is in. I think we can say confidently that the top is in.
Hey, but I will say a few months ago, we were saying this a few months ago back in March, that the top was in after that exhaustion and that gap down. That's hopefully something we see on Micron and SNDK, and I think getting on more directional positions is a little bit easier to do that instead of a runaway train. But most definitely a little bit higher in those.
Yeah, but continuing to sink. So I don't know at what level I would think the bottom is in. That's really what it comes down to. Like, obviously it's some insane level. Like, if we got below 30, I would say, okay, I think the bottom has to be in here. But I don't really see that as a realistic possibility. Is it this level of resistance that we saw in October? Is it the mid 40s, perhaps?
Might be. My philosophy is the fact that most of these products in the market don't even move off of fundamentals. So like whenever I say some things that sound a little bit outrageous, it's because I legitimately, from a trader's perspective, I think a lot of fundamentals is a lot of BS, especially with seeing silver, gold, Micron, SNDK. I mean, come on, guys. What are we talking about right now? These stocks are real. Like, what are we talking about right now? And then it's a little bit more obvious in hindsight.
Well, I mean, that's the crazy part about the memory stocks is a lot of them have, like low double-digit forward PE ratios. Or like Micron's has dipped into the single digits at times here. Like the money is flowing in to back those up. But I do totally agree with you, particularly as it pertains to commodities, the silvers and golds and oils of the world, that, I don't know. Mustache hair in my mouth. Sorry, guys. It's a recurring issue. It's tough to maintain. The cost of looking is good. But yeah, with the silvers and the golds and the oils of the world, it's tough to determine. It's tough to really try to apply fundamentals because they're so esoteric in nature, because they're predicated on scarcity. It's more economic variables. There's no PE ratio for oil.
No,
it's not.
But it's like, because let's see, silver, we hit a high of 109, and then a week later, we're trading at 61. You tell me the value of silver legitimately went down 50% in 7 days. Come on. You know what I'm saying?
Yeah.
But great points there. I think a lot of these moves are a little bit over-exaggerated, but definitely wise to definitely separate that from a lot of the underlyings that do have these PE ratios and things of the sort.
Certainly. As we talk about commodities, let's shoot over to one of my favorite tickers. Oh, did they take away Cal? What the heck?
What was that? A Cal, one of your favorite tickers?
Yeah, Cal. It used to be I was
gonna say, was that agriculture?
Okay. Well, they still have corn. Okay, good. They took cow and corn from me. I would have been real upset.
You sound like a farmer right now.
Corn not looking so good. If we're talking commodities, I was just trying to pop off a rando commodity, but they took away my favorite commodity ETF. But yeah, the corn fund. Corn sinking here. Anybody long corn? Let us know in the chat if you're long corn. Perhaps it's time to get long corn. I don't know. I don't keep up with all the things.
It's been really beaten down.
The price of corn.
Yeah, I mean, what's been going on with corn? I mean, corn was trading at 118 not too long ago. Now we're kind of trading at around 16 now.
This is 19 down to 16.
Perhaps hammered.
Perhaps some things to be had here. I'm tempted to blindly get long corn right now, just for the meme of it all.
Get you some elote. Get you some.
Yeah, let's go. What are we looking like here? What can I get what if we sell some on the? What if I straddle moneyness? 40 cents, 60 for 40 at the money. I suppose it is a really slow moving product.
It is a little slow. Sometimes slow is good. Sometimes slow wins the race.
Give me 2 corn verticals. I'm not going to let myself get slipped there. We'll sit and see if that gets filled. I am not that committed to this corn trade, but sometimes just poking around the market, having a little fun like this, you stumble across things. I'm sure that there is somebody out there that is just rolling over right now that I'm getting long corn. There is a drought or a blight. I don't know. I'm sure that there's a reason the corn is at these levels, but I see something like this. I treat it like bonds. If we start to get to these lows, I can see that there's clear support at this low 17 level, high 16 level historically. Why not fire on some corn?
No, I like it. It's been beaten down. I know Organic said long corn, short ribs. Let's eat.
Long corn, short ribs. I like it. Yeah, didn't think I'd be coming in here putting on a corn trade today, but there you are.
Absolutely. What's Nasdaq doing right now? What's the broader market up to?
Yeah, let's have a look. We can go a little more granular on those. I'll go to MNQ because I know that's
shout out to the boy. There we go. Appreciate that.
The micros. Good candle coming in here on the 5 minute.
Yeah, super choppy markets today. It's looking like. I know we put in a day low, then ripped back to the day highs, and it looks like we might stay within yesterday's range. It's looking like.
This is a hilarious illustration of what you were just talking about, because as you were talking about how just 15 minutes ago, how this is a whipsaw market and it makes it really hard to trade, we were on this red candle looking like we were going to make a move to try to put in a low, and then suddenly we just rip right back with a engulfing green one here. Headed back to the highs, perhaps a new high of the day coming in, or perhaps we stay range bound, and that's the difficulties that you're alluding to.
It's absolutely one of the markets that will make you rip your hair out. Oh, I know one thing for myself. Whenever I don't get a good read on the market, look, I'm not saying you always know what's going to happen, but there are times where you have a little bit better of a read on the market in terms of what it's doing. And today's another difficult day, right? It was difficult prior to FOMC yesterday. Things became a little bit more clear after that announcement came out. And then today, once we sold off down to the lows at around 30,409. And if you look at the order flow again, I know we have some other guys in the chat that have their order flow up on their screen. If you look down at the lows, you can see the massive sell orders hitting the market, aggressive sell orders, and then the market completely reverses, right? So we have a handful of people trapped into the market. We rally back to the pre-market highs, trade around there, and then we're trapping buyers at the highs. So it doesn't even look like this is a market where the long side is winning or the short side is winning, or the short side is winning. It's like a lot of these directional positions are becoming a little bit more range bound, and that can be really frustrating. And it really shows in the orders and the executions that are being taken in NASDAQ right now. Again, with that being said, we still have 4 hours into the trading day. Things could finally break out of its range. We could gain a little bit more clarity. But my optimism isn't too high considering it's a longer weekend. And again, we're still digesting FOMC a little bit. So my head's already onto next Monday on my end at least.
Yeah, and it's a big FOMC to digest, particularly with obviously no change coming through, but it's all of these new things to price in with somebody new at the helm, and it's a new environment. It's a new era with Warsh. So we'll see what comes with that, but. That's going to be about all the time that we have for today. You got any closing remarks?
No, that's going to be it for me. We'll see how the market digests the FOMC from yesterday. But again, as always, appreciate everybody taking their time, and we'll see what the market gives us the next few hours.
Yeah, absolutely, and we will. Everybody, be careful into the rest of the day. Triple witching. That's 3 witches. Count them. 3. Burn them at the stake. That's all that we're going to have for today. Thank you so much for taking the time to hang out with us. We dearly appreciate it. We will see you guys. We will be back later today, 1:30 p.m. Central Standard Time. Be sure to come hang out with us. Be sure to like and subscribe to the Tasty Live YouTube channel so you don't miss all the exciting stuff we have coming up next. That's going to be all from me and Errol. We'll see you guys next time.
Peace.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
So why are we all doing all the things that we do inside of the active trading space? Simple. To make money and generate returns. Well, inside of the Tasty universe, there are essentially 5 keys to making those returns. And in this crash course, we're going to break down all the details of each one of those keys. So I'll see you inside.
Tasty Trade has crypto, and you can trade with zero commissions, Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
First thing about Tasty Trade is how easy it is.
It's a very quick, light platform. It's all on one page.
And with 1 or 2 clicks, you can be anywhere on the platform.
Being able to see graphically where your profit and loss zones are.
Whether it's a pool, a puddle, or a sea, you can navigate your way out of it with the Tasty platform. So I love that. You guys have the most unbelievable customer service in the business.
Email support, call support, get through right away.
They actively listen to the customers to make changes to the platform to make it better.
In fact, I've never seen anything like it in any corporation in the United States.
We're back. You're watching Tasty Live. I'm your host, Chris Vecchio. We're halfway through this triple witching Friday right now. Stocks are still up. S&P up by NASDAQ's up by 2.2%. S&P still up by about 0.9%. But the market's calming down a little bit here, so it's time to have a bit more of a conversation. Let's talk about the Fed a little bit. You know, the bond market's in a strange place right now. The Fed may be nearing the end of its tightening cycle or perhaps the beginning of a new one. It's creating some problems in the market. Yesterday's market reaction was obviously bad. Stocks were down. S&P 500 was down by more than 1% on a FOMC day for just the 15th time since the global financial crisis. So we're bringing in Kim Escue here. That's why her perspective is pretty valuable. She sits at the intersection of macro, fixed income, and portfolio construction as a fellow CFA charter holder who likewise needs to pay their dues. She's also a portfolio manager at Shelton Capital Management. Her job's not just to interpret Fed policy, but understand how inflation, treasury supply, fiscal deficits, and duration risk all feed into the broader market behavior. Joining us now, Kim Escue, Portfolio Manager, Shelton Capital Management. Thanks for joining us here on Tasty Live.
All right. Chris, thanks for having me today. I'm like, as Chris said, I'm with Shelton Capital Management. We're a multi-strategy boutique asset management firm. And we have SMAs, ETFs, and mutual funds offerings. And I'm here today to talk about the Fed announcement yesterday. There was really no surprise on our end as far as them holding rates steady,
Sure.
Nor was the updated dot plot with the Fed members that did participate. What I think is one of the key things to take away from yesterday was the changes that Kevin Warsh is proposing around the Fed. And I think it's really exciting because, the Fed has been at kind of the center of most of the large market drawdowns associated with recessions due to policy mistakes. And this goes back, we're talking about like a 100-year learning curve here.
Right. Yeah.
And, you end up in a situation where they're real focused on just narrow data points or particular mandates. And I was real excited yesterday to hear him, speak about maybe taking into consideration some of, more macro things in their views, while still staying data dependent, but just considering how, the macro environment and different things going on, would be impacted or are impacting. As well, because a lot of times, if you're focused on real narrow, and a lot of times it's also some stale data. So I think that I was very excited to hear about that, and I think that it will, have a big impact on, the success of monetary policy if they, can incorporate and update some of the processes.
What stood out most to you from the Fed decision yesterday? Was it something in the summary of economic projections themselves, those rate hikes that are being penciled in, or was it something from Warsh's press conference itself?
I think it was the press conference itself. And I think that just the discussion about, I think that they made it very clear that they are going to keep a 2% target. I think that they made it clear that the Fed would
That's important, right? We don't want them changing the rules of the game while we're behind, so to speak.
Right. And he did, though. I mean, one of the things that I caught in there from the conference was, he did discuss that he's more concerned with the inflation handle, rather than necessarily to the right side of the decimal point. So, a 2.5 to him could be, fine. So it did provide a little bit of flexibility, not much, but, but still staying anchored on the 2%, doesn't really change the game that much.
The Strait of Hormuz is, potentially reopening right now. Oil prices have obviously moved ahead of what the physical market's doing. The paper market, the futures are suggesting the flows are going to resume. So maybe that's becoming less of a concern for inflation. But is this still the central risk this year for policymakers and markets now?
Well, yes, I think it is, Chris, because if you look at market expectations as implied by TIPS break-even point spreads, you can go back before the end of the year, and we have had elevated inflation expectations prior to the conflict with Iran and the surge in oil prices. There's a lot of other elements in here. Now, the geopolitical risks and the shock to the energy prices, that definitely complicates things. But we've had sticky inflation expectations, persistent inflation expectations for some time now. I don't see that going away, even with oil, prices easing up some.
So what specific indicators are you watching most closely right now? Is it CPI, PPI, core services, ex-housing?
PPI, CPI, I think that the housing picture comes a lot into play of the inflation picture. I also am concerned about, we've got a huge, the money supply itself is very large. It's been on the historically large side. However, I think it's something to keep an eye on. At the moment, the velocity of money and the growth rate of the money supply has kind of backed off a little bit, but it's there, and it's something that we ought to also keep in consideration as well. In the big picture, in the right environment, if that came back into play and the velocity of money picked up, we could be in a little more trouble.
I've heard some people say that yields really aren't following the right script these days. Why do you think long-term rates are behaving a little bit differently in the context of the expectations around rate cuts, rate hikes, oil, inflation expectations? Is there a disconnect between Treasury yields and Fed policy right now, as so many are claiming?
I don't really actually think so, because we historically, you can look back in like 95, 98, 2003, and now more recently, there's been a lot of times where rates on the long end stayed elevated while the Fed was in an easing cycle or even in a hold pattern. I think everybody is the textbooks have taught investors to expect a parallel shift in the yield curve. But the bond market just doesn't. It typically delivers something more complicated than that. And I think that this is more of a norm than people really would expect. I think a parallel yield curve shift, where what we're talking about would be, an equal amount across the yield curve. It just is there's more things at play there.
Well, you could absolutely see another one of those like twists again, where in expectation of yields, or at least Fed rates going up, 2-year yields jump up, and you get this depression effect at the long end of the curve. Growth and inflation expectations come back in, and so all of a sudden, you lose that steepness in the curve. It kind of be a bear flattening, so to speak. Maybe that's how it plays out.
Exactly. Yeah. So
let's talk about the yield curve, though. I mean, it's been deeply inverted. It won't last forever. The bigger question is what this normalization looks like. I mean, are we going to go back into that territory where the yield curve's 2-10 spread is back negative? Let's worry about recession.
I don't know that we'll be there, but I definitely will expect a little bit of a flattening if the Fed does get some rate hikes in. That's left to be seen. We've got some things clearing up, and as you pointed out earlier, while the oil has been a big topic recently, it has added a little bit of issues, but I think that when we settle back down, we see what that looks like. I think we are going to have that persistent inflation expectations and persistent inflation, but I don't know that it's going to be to a large degree impacted by some of the things that we're seeing from a geopolitical and oil price standpoint. So we might not get a cut in this year. A hike. Excuse me, I'm going the wrong way.
Well, I mean, I think that's I know the market yesterday freaked out about the potential for a hike, but if we get to September and oil's still trading at 70 or 75, all of a sudden you're going to have sequentially several months in a row where there's this negative energy impulse in headline CPI, and the Fed may sit around and say, this looks transitory to us. We may not need to do anything here. We just have to sit tight, and the best move, as Greenspan so often said, the best move is often to do nothing to provide stability.
That's right, because it's a lag, and you've got to wait and give it some time to come through. That's definitely where I think Warsh will be. He's kind of a disciple of Greenspan, and I think that we could very well see just no move at all this year.
No move at all might be the best outcome for equity markets here. And it kind of speaks to a question going into duration risk. This is less of a question for traders, which is most of our audience. But I want to think about like the cost of money. Duration risk for the audience out there, it's how much a bond price moves relative to rates. So when you have a higher duration asset, it's more sensitive to moves in rates. If we're concerned about a yield curve that could potentially be flattening, or maybe not at all because the hikes never come, how are you conceptualizing duration risk for your clients right now? Are you focusing on the long end? Are you going into the belly? Are you barbelling your bond risk?
We are in the belly, definitely in the belly. We made a move into the belly last year, and we've been kind of holding in there. And I think that's a good spot to be with the uncertainties, and especially with a new Fed chair coming in, and just taking kind of a wait and see in the belly, kind of more neutral to our benchmarks at the moment.
We've started to see real yields spike up in recent weeks. I was looking at a chart today that Goldman Sachs sent around. It was the euro-dollar spot rate versus the euro-dollar real yield spread. And it was anchored back to the start of January 2024. So if you were to follow that line, it would imply that euro-dollar should probably be trading below 114, and that's obviously not where it's currently at in the market these days. Do you find that real yields are an important part of the framework? Should traders ignore them or pay more attention to them these days as they are seemingly weighing on things like gold?
I think real yields are very important. They are the base for what we're, for our markets. And I think that definitely it's something that, everyone should be watching.
How do you incorporate real yields? I know it's kind of like an esoteric concept for traders, but it's just treasury yields less inflation effectively. What are you getting compensated for? Your risk?
Well, the real yields have to be considered, and then you've got your nominal yields that kind of build in that inflation as expectation. But real yields, there could be a case that that's more your market moves, more impacts from different things like supply and demand, and different factors other than inflation. Inflation's a piece of it. You start looking at other things like the federal deficits, borrowing needs, and demand and supply demand mismatches. And I think that you've got to take into consideration your base starting point, which is your real yield, and then you build in your inflation expectation, and you end up with a nominal Treasury yield.
So I've been
So
looking
it all
at
comes into play. It's all important to look at.
One of these factors that's going into this conversation right now about the bond market. I'm sticking with the bond market. It's overlooked. It's underloved. Everyone's trading semis, but the bond market can offer you these signals. I'm thinking about our deficits and our debts right now, which maybe they're not so important, but the question of supply exists. A lot of folks pay attention to Scott Bessent when he does those QRAs and tells us where he's actually going to be putting money into the market. Is it going to be bill issuance? Is it going to be bond issuance? Have you seen that to be a material factor in how capital's been flowing through markets in the Trump administration 2.0?
I haven't really, but the issuance is important because you're looking at most of the issuance has been on the short end. Okay,
which is a continuation of basically Yellen and Powell and every other Treasury Secretary.
Which would indicate that right now the longer end pricing is more inflation expectation dependent. With most of the short-term new issuance.
Right.
Now, we've seen an uptick in issuance across the yield curve, but clearly it's a lot more concentrated on the short end. So we would want to watch to make sure that if they start to issue longer-term debt, that could come into play. The demand picture landscape has changed, where we don't have the Fed in buying through the quantitative easing, and you have our traditional big buyers of treasuries, China and Japan, becoming less reliable.
For this particular bond market, I'm trying to figure out what's the next catalyst here. Oil's basically back to where it was right when the war started, but notes, bonds, they're not at the same yield level. They're still about 50 points, maybe 40 basis points richer. What's the next catalyst or data point that's going to offer that opportunity for the bond market narrative to materially change its course?
Well, I think that's going to be really interesting because I would say Fed policy, but I think that it's going to be really interesting to see how that Fed policy now with a new captain at the realm that doesn't really want to give forward guidance, going forward, and there's going to be changes. So I think that definitely Fed policy, but maybe it could be in following a different path as far as like shocks to the market and kind of the information that we have prior to Fed rate moves going forward.
So we've covered a few things here: income, duration, inflation risks, the possibility of shifts in policy, both a little bit fiscal but mostly monetary here. If you're investing the incremental dollar today, how are you thinking about portfolio construction right now?
Right now, as I said, we're kind of more in that benchmark neutral. We're not seeing a lot of value add in some of the different sectors of the bond market outside of just staying neutral to the weights. I think active management is just paramount here because being active in the bond portfolio, there's so many different factors that are going into this. Like you want to be positioned correctly on the yield curve, in the belly. At the same time, you want to have your duration within a range. For our standpoint, we're kind of in the benchmark, being the ag duration range. But the yield curve positioning is also just as important as the duration decision, as we just discussed. And then you want to look at, there's different sectors of the bond market, and the interest rate picture also changes. As it changes or expectations change, you see different pricing in bonds because of the optionality in different sectors. Some sectors have more callable bonds, as an example, whereas treasuries are more bullet. You get into municipal bonds, you've got sinking funds, call options. Well, the whole pricing, so you want to be careful there. You want to think about the big picture and how the interest rates are actually impacting those things as well. Mortgage-backed securities are a perfect example, where your payment, repayment period of duration can change with interest rates. So there's a lot of moving parts, and I think it's very important for investors to think about being, active in the fixed income allocation and able to, move around to avoid some of the, hiccups and pitfalls.
Does the AI infrastructure build out have any bearing on your outlook for rates and yields at all? There's been so much conversation about AI becoming this big deflationary force thanks to the productivity enhancements it's going to bring about.
It's an interesting concept, but we've kind of stuck, more to, relative value and where we think there's, impacts are going to be across the yield curve. But, that's an interesting concept.
Next 12 to 18 months, what's the thing that the market's going to get most wrong about inflation and bonds?
Most wrong? I think that's going to depend on the Fed and how they incorporate out more of a broader look into macro factors. I think that we ought to really be watching that, because I think that could be an upset here and take them a little bit further away from what we expect. So I think that's what the focus should be on.
Focuses on inflation. Kim, thanks for joining us. That's Kim Escue. She's a portfolio manager at Shelton Capital Management. Previously, she was a co-founder and senior portfolio manager at Stringer Asset Management. She's done a lot in the bond space over a number of years. One of the best minds that we have here to talk on the network. Kim, thanks for joining us here on Tasty Live.
All right. Chris, thanks for having me today. So
we will see Kim again soon. Hey, we have markets to pay attention to here real quick. Let's go back to the charts right now, and I have to get these back up on the screen. But the S&P 500 is still up by 0.9%. The Nasdaq's up by 2.25% here. We see that volatility is staying pinned lower over the course of the session. The VIX is down at 1687. So after that brief jaunt up into the 18 range or so yesterday, we ultimately see that vol has decided to come back in on this triple witching Thursday here, because tomorrow is Juneteenth, and that drags forward the calendar a bit right now. Overall, the market tape is holding up here. We're going to take a brief break here at Tasty Live, though. We're going to go into some pre-scheduled programming. Dr. Jim is out today. He's still recovering, so you've seen his post on social media. Wish him well. He'll be back with us next week, as will Mike Butler and Liz Dierking, of course. But we'll be back later today. Tim Knight's on later this afternoon. I'll be here with Ilya for last call as we wind down this trading week. Go get some lunch. Stick around. You're watching Tasty Live.
Welcome to Trading Trends. I'm Ilya Spivak, head of Global Macro here at Tasty Live, joined by who I think is perhaps only our second repeat guest here on the show. Rick Rule is once again with us. He's the founder and CEO of Rule Investment Media. Rick, welcome back.
Pleasure to be back with you. Thank you.
Rick, I've saved all kinds of hard questions for you since our last conversation, and I wanted to go right to the dollar and gold, which we explained last time, how it has been that since the beginning of this war in Iran, we've had, of course, an inflation scare, and against that backdrop, interest rates have come up. And so, contrary to what people might have thought, episodically, the dollar is up because there's been a reach for liquidity and higher rates, and gold is down because things have sold it to gain that liquidity and gain exposure to those rates. I want to keep that conversation going. Obviously, this inflation scare is now impacting the broad range of markets. We're seeing it in stocks. We're seeing it in all manner of asset classes. And I wanted to see if, in your mind, this is an input into the larger gold conversation. Obviously, people have looked at gold as something of a value hedge against fiat currencies being hampered by tremendous levels of debt across most large governments, not just the U.S. certainly, and not just Europe certainly. And so I wonder if this kind of inflation in your mind, in that it inflates the debt away to some extent, if that hurts the long-term case or changes the long-term case in any way for gold and precious metals and kind of physical value as a counter to fiat in general.
I think a study of history would suggest that fear of the decline, or in certain cases the decimation, of purchasing power held in fiat instruments has been responsible for most gold moves over the last 1,000 years. People attribute all kinds of attributes to gold. What one finds is that, as an example, other forms of fear, war, political unrest, things like that, have a near-term impact on gold, but they seem to have a negligible long-term impact on gold, except sometimes for participants like refugees, the Jewish community, the Vietnamese community. Those people had a different use for gold. It wasn't speculative, it wasn't investment, it was survival. But for most people, in less dire circumstance, the primary motivation for gold is to shield one's savings from the depreciation in the purchasing power of the currency. It's important to note, as a student of fairly recent history, that is to say my lifetime, that reaction to inflation takes place over longer periods of time. As a very young man, I began to notice and become interested in inflation literally in high school. In 1968, I began reading what are now regarded as Austrian economics or hard money books. And I would suggest to you that although inflation was a topic on people's minds, that the investing public didn't really begin to react to incipient inflation till 1972. In other words, there was a hiatus between the point in time when academics and politicians described inflation and the time that people began to react to it. During that 5-year period, as an example, a hamburger at McDonald's went from 20 cents to $1. By the next year, with the Arab oil embargo, the price of gasoline went from 25 cents to $1. In 1968, 1969, 1970, despite the fact that we were undergoing inflation, investors' expectations of the future were set by their experience in the immediate past. And the 1950s and 1960s have been very good times. People were extremely optimistic. You're probably too young, but your older listeners will remember things like the Nifty 50, which is to say high growth stocks that did extraordinarily well. When your anticipation of the future is set by your experience in the past, and your experience in the past 2 decades is rosy, you don't react to negative stimulus as well. So it took probably 5 years for the population to react to incipient inflation. And I think the same circumstance is happening today. Exactly the same circumstance. We have lived through what I believe is the most benign economic climate in human history in the period 1982 to 2022. People's expectation of the future is set by their experience in the past, by the dips. Believe government inflation numbers like the CPI. If you believe in the CPI and you believe that the destruction of your purchasing power is clipping along at 2.5 or 2.6%, then current interest rates seem very adequate. You know, the 10 years yielding 4.4. You're getting over 100 basis points in real yield if you happen to believe in the CPI. My problem is I don't. I believe that the CPI is better characterized by Mike Maloney as the CP lie. I believe that the deterioration in the purchasing power of the U.S. dollar, marked by the basket of goods and services that I consume, suggests that the destruction of my purchasing power is proceeding along at an 8 or 9 or 10% clip. That presents a very different picture. If you're making 4.4 in a currency that's losing value at, say, 9, you aren't making 4.4. You're losing 4.5. It is when that realization becomes more widespread that gold really performs. Gold is viewed by many people right now, after a 50-year hiatus, as an investment class or a speculative class. I would argue that 1,000 years of human history teaches us that gold is a liquidity class or an insurance class. And right now, people don't feel the need for insurance. My suspicion is, unfortunately, that that feeling will change.
Well, I think you make a very clear distinction there, and it echoes what we talked about last time as well, that when we say that the dollar is set to underperform, we're not talking about underperforming against other fiat currencies. No. We're talking about underperformance against hard assets and fiat currencies as a grouping underperforming against hard assets. And typically that conversation is presented as, oh, well, governments will try to inflate away this debt, but we don't need them to try. We have the inflation here. And so I think the next kind of natural question is, well, gold is having a bit of a hangover here after an incredible rally last year. One thing you've talked about recently that hasn't been caught up in this macro narrative is uranium as another kind of vehicle for sort of expressing a view on physical assets and the kind of value storage that is. Break that down. What's the conversation with uranium?
Well, I need to start by saying in most commodities, the easy money has been made. The easy money occurs when a commodity goes from being hated. It doesn't need to go to being loved. It just needs to go to being unhated. When uranium was at $20 a pound, although it took the industry $40 a pound to make it, so the price had to go up, it was a hated commodity. The move from $20 a pound to $85 a pound means that the easy money in uranium has been made. It also means, however, I think looking forward, that the sure money is in front of us. Why do I say that? Well, for several reasons. The most obvious reasons is that the world needs more power of all kinds. All kinds. Global power demands, global energy demands are set to double by 2050, and we don't have the capacity to produce that much energy. We just don't have that much. Energy will be rationed by price. Nuclear power is extraordinarily reliable baseload power, and importantly, in today's political discussion, it's baseload power that doesn't generate carbon. It isn't the same as burning coal and burning oil. Uranium has, in 5 short years, gone from being a pariah to being a politically correct commodity, which amuses me greatly, frankly. The thing that's really changed with uranium, though, Ilya, was and is the conflict in the Gulf. It has been 50 years since the world cared about energy security. If you dial all the way back to 1973 and the Arab oil embargo, that form of energy insecurity stimulated, as an example, the French to build what is now the 4th largest nuclear fleet in the world. It stimulated the Japanese to build the 3rd largest nuclear fleet in the world. The impetus for that was energy security. Energy security ceased to be a concern for 50 years, but is suddenly a very relevant concern. Uranium is the only fuel on Earth that has enough energy density that the Japanese, as an example, could, if they had sufficient reactor capacity, store enough uranium to power the entire country for 5 years in one uranium storage facility. You can't store that much oil or that much coal or that much natural gas. You can't build that big a battery. The only material that can give energy-short nations, Korea, Japan, China, for that matter, Taiwan, Singapore, energy security is nuclear, the only one. And the big thinkers of the world are beginning to come to understand that. And I think ordinary citizens are beginning to understand it too. That's very important. We are right now producing less uranium than we consume. And two things are impacting demand. One is that the Japanese are now speeding up in earnest the restart of the plants that were closed as a consequence of Fukushima. This isn't demand that's going to occur 10 years from now. This is demand that's going to occur 10 months from now. A very different circumstance with regards to pricing. It also is part of a broader trend to nuclear plant construction. Even nations that forswore nuclear, in particular Germany and the United States, are learning that if they are to fund their existing economies, never mind data centers, that they need reliable, inexpensive baseload power, and their voters would prefer that power to be non-carbon generating. I would suggest that the biggest unsung beneficiary, if there is ever beneficiaries of a war, would be uranium with regards to the Gulf conflict. People think of oil, they think of gas, they think of nitrogen, nitrogenous fertilizer, sulfur, helium, all things that move through the Straits of Hormuz. They don't think about the geopolitical attractiveness of a form of energy that gives a country energy security. And there is no other form of energy that gives a country energy security.
Well, I think that's a really important insight here. It's sort of the next step in the conversation where you say, okay, well, today it's a story about a bottleneck, but a year from now, 2 years from now, 3 years from now, there will be some kind of resolution of this bottleneck this way or that, but countries will have learned that they live in a different world now. I think you made the point last time we spoke that the 40 years that were there sort of through the Volcker disinflation almost right up to COVID is a very different period than what we're entering now. Certainly deglobalization and inflation and thinking about kind of the dissolution of U.S. enforced norms would suggest that countries need to start thinking about things like energy security in these kinds of terms. In expressing a view on uranium, because I think, obviously with gold, it's easy. There's any number of ways you can gain exposure, from physical to ETFs to futures. Same thing for silver. What's the vehicle for exposure to uranium in your mind?
There are several. I think for most people, the lowest risk exposure to uranium is to buy something called the Sprott Physical Uranium Trust. Note here conflicts of interest. I'm the largest shareholder of the manager. I'm not an officer. I'm not a director. I'm not an employee. I'm just a beneficiary. The Sprott Physical Uranium Trust is a deposit receipt representing physical ownership of uranium at 4 facilities worldwide. Uranium is one of those commodities that one is well advised not to try to buy and store at home for fairly obvious reasons. So the best form of physical ownership is in fact certificated ownership, and by far the most liquid of those vehicles is the Sprott Physical Trust. If someone wants to take a bit of operational risk, I would suggest that the highest quality uranium producer in the world is the Canadian domiciled Cameco, the symbol CCJ on the New York Stock Exchange and the Toronto Stock Exchange for your Canadian listeners. Highly liquid, really a full cycle uranium shop, all the way from producing uranium to enriching uranium to, by now in its engineering group, building uranium mines and processing facilities for others and generating power. The third that people might want to look at is Kazatomprom, which is the largest uranium producer in the world, formerly a large position of mine. I've sold my stock because of middle management defections. middle management defections that I didn't understand. And I have a hard and fast rule. If there's a risk I don't understand, I sell the stock. There are also a range of uranium speculations, but I'd prefer not to talk to your viewers about those. They require a lot of work to be a responsible holder. And I've found with 50 years of experience that many audiences love the name but aren't prepared to do the work to prepare themselves to own the name. So we're going to leave the speculative ones aside, I think.
And that is perfect. How do you feel about an ETF like URA and sort of ETF type exposure?
For a lot of people, it's probably appropriate. I'm old school. The idea that somebody, including my former employer, Sprott, constructs an index that has probably 50% of the stocks in it being stocks I wouldn't otherwise own. The idea that I have to pay somebody a fee to construct a portfolio that I normally wouldn't own for free is problematic to me. I realize that most of your listeners have lives. They have kids or grandkids. They like to garden. They like to read. They like to do things with their life other than study uranium juniors. And for them, the ETF is probably appropriate, if inelegant.
And there we have it, folks. Rick, I have, of course, 1,000 more questions for you, but we're just going to have you back to get to those. Tell the good folks where they can get more from you.
I'll give them incentive. Anybody who cares what I have to say about natural resources and wants to personalize it, including, by the way, uranium juniors, can go to my website, ruralinvestmentmedia.com. There, if you list the natural resource stocks that you own, I will personally review that portfolio and rank it 1 to 10, 1 being best, 10 being worst. And I'll comment on individual issues if I think my comments have any value. Please, as a sidebar, I know yours is a trading community, no crypto, no tech stocks, natural resource stocks only. The other thing I would suggest to your audience is if you care about natural resources, a conference, which I personally believe is the finest natural resource conference on the planet, takes place July 6 through 10. Not surprisingly, it's called the RULE, Natural Resources Investment Symposium. If you go to rulesymposium.com, you can learn more. The physical conference is sold out, but you can, if you wish, attend the conference from the comfort and convenience of your own home via live stream, rulesymposium.com. By the way, ours is the only conference I know of, live or otherwise, that has an unconditional money-back guarantee. If you attend the conference and think for any reason whatsoever, you being the sole judge, that we didn't deliver full value for your money, email me. I'll give you your money back. Nobody else I know in investor education maintains ironclad money-back guarantee. We've done it for 30 years now. I'm delighted to say we've had to refund about 0.1% of the tuitions that we've charged over 30 years, but that guarantee is your guarantee that we're confident our content at rulesymposium.com can make you money.
And there you have it, folks. If that doesn't explain why Rick is here explaining things to us, well, go check that stuff out and you'll find out too. Thank you, Rick.
Always a pleasure, Ilya. Thank you.
Welcome back to Signal versus Noise, where we take a look at the options tape and ask the question, is there any unusual activity that's worth discussing and maybe even trading around? Today's names are two trades, both hitting close to the close yesterday, but with very different messages. The first one is Tesla, ticker TSLA, which is tied directly to the SpaceX IPO, set to open around 175 perhaps here. That has not yet started trading at the time of this recording. The second ticker is Meta, which may be the AI name that the market has not yet fully repriced. But let's start with Tesla here, currently trading at $394 a share. Someone bought the Tesla June 18th 432.5 call, 6 days to expiration. Tesla was trading around $399 when the trade hit. The strike was about 8% out of the money. Premium was $3.31 million, and the volume was 14,263 contracts. The open interest jumped by 5,389 contracts in a single session. That's a 202% increase. So this is not a quiet repositioning. It's not someone taking a little dip of a toe into the water. This is a big call sweep done into the close 1 day ahead of the SpaceX IPO. And that timing tells you a lot about the trader's intentions here. SpaceX is being listed today under the ticker SPCX. The IPO price is $135 a share. Reporting ahead of time says it may trade closer to 171, 175 around the open, which would be roughly 27 to 30% above that IPO price. And in doing so, the company would be raising, well, that $75 billion that it was seeking, making it the largest IPO ever. The demand behind the scenes is reportedly $350 billion. The book is about 4.5 times oversubscribed. No wonder we're looking at a potential pop at the IPO, at the open. So it's not just another trade here, right? Tesla is coming in the context of this Musk halo effect. Tesla owns SpaceX exposure through its AI conversion, the XAI conversion, with the FTC approved on March 11th. So if SpaceX rips on the debut, the Musk halo effect can spill directly over into these Tesla shares. That is your bull case here. SpaceX opens strong. The retail demand is enormous against a tiny float, roughly 3 to 4% of the shares, and traders start treating Tesla as part of the broader Elon Musk ecosystem once more. The call buyer is making a bet here that a successful SpaceX debut lifts Tesla quickly. It's going to happen within the 6-day expiration window. There's no time for a slow-moving story. This is a bet that things will work out well, and they're going to work out well very, very quickly. There's a little bit more of a piece here. The institutional side, JP Morgan just upgraded its Tesla coverage from underweight to neutral and raised its target from 445 to 475, excuse me. But that's a massive reset from a major bank right before the SpaceX IPO. And the target is now sitting above the call strike in this sweep here. So the tape is giving us the trade. We have a catalyst right now, and we have a sell side upgrade all at once. Now, the risk here is obvious, perhaps. For those that were following the SpaceX IPO roadshow, there were some detractors that popped up along the way. Morningstar, which is seen as a fairly neutral rating agency, said that the fair value for SpaceX is closer to $63 per share. So if it comes in at 71, 71, there's a massive gap between enthusiasm and perhaps fundamental value. But it's an Elon Musk company. Jim Cramer pointed out that SpaceX could soar to unsustainable levels after the debut, which may be a pretty honest description. The float being only 3 to 4% matters a lot here. The founder lockup being 366 days matters a lot here. The index rules, particularly for the NASDAQ, could start to force passive buying within the next 15 days. This structure might make for a massive first day move, and it can create a market where price gets distorted fairly quickly, especially through second order effects like Tesla as a proxy bet on SpaceX itself. So while the SpaceX play here through a Tesla call sweep is fairly clean, it is the halo effect trade. If the IPO opens up strong, if market goes full Musk again, then Tesla's going to catch a fast bid. If the SpaceX absorbs capital away from Tesla, the halo effect may just become competition. But right now, all signs are pointing in the right direction. So maybe there's some signal within this particular trade. There is another trade, though, and that goes through Meta. There were two Meta call trades that went across our screen here. The first, August 21st, 6:30 call, 70 days to expiration. The stock trading around 560 at a time. The strike is 11% out of the money. The premium is about 4.09 million spread across 2,066 contracts. And then you have the July 31st 640 calls that hit the tape here. The strike's about 13% out of the money. The premium 1.14 million spent across 854 contracts. The open interest on that line was 0 before this trade, and now everything that you see here is entirely new positioning. So the combined bet is about 5.23 million in bullish Meta calls. And unlike Tesla, there's no real IPO halo trade effect going on here. This is a simple, the market has misunderstood Meta's business model. It is undervalued. This is a re-rating trade, which may be a little bit less speculative, as it were. Meta trading around 568 is about 29% below its all-time highs established near 796. Meanwhile, the business is still printing the enormous numbers that you would think would be accretive to higher share prices. Q1 revenue is $55.5 billion, 20% higher year over year. That beat by roughly $900 million. Operating margin is 41%. Cash levels, $81 billion. The AI numbers are starting to perk up too. Meta has 1 billion monthly active users. Llama has 1.2 billion downloads right now. Even Threads, which I'm not a Threads user, it still has 450 million active users on a single monthly basis, which has actually surpassed X. That was surprising for me to learn. Ray-Ban Meta sold 7 million pairs in 2025, up from the 2 million total in 23 and 24 combined. WhatsApp business messaging is now up 74%. So right now we have an interesting setup here. It's the AI infrastructure companies, the ones that are selling the shovels that are being rewarded. Those that are buying the shovels, the service layer on top of it all, they've been punished because it's costing a lot of money to actually build the build out. But consider it right now. Meta has one of the largest AI distribution networks in the entire world, and the market does not talk about it as it does in the same way as an NVIDIA, Marvell, or even a Google, because it's not a hardware company just yet. Meta is an AI company that no one is actually calling an AI company here, and yeah, they deserve to be dunked on after the metaverse and all. But this is perhaps what the call buyer's seeing. They're seeing the future where we start moving away from the bottleneck and we start looking at the actual applications. This is a company with over $200 billion in revenue, 41% operating margins, more than 1 billion AI users, and the stock is still 29% below its highs. The trade that we're seeing here in Meta is a bet that we're not going to get back to those highs, but we can make a significant leap towards there over this next, say, 70-day window, 49 to 71-day window here. And that's where the signal versus noise trade today gets interesting. The Tesla side of this, prospect of trades here, these are event-driven trades. These are binary event risk trades. They are hoping for SpaceX to come in with a bang, that the largest IPO in history lights up the board and the Musk halo effect continues to work its magic. But the meta signal is that there's going to be a shift in the theme around AI, that the market is going to get past this recent bottleneck phase around memory chips, and we'll call it hardware with Dell and Hewlett-Packard performing fairly strong in recent sessions. We see there's a little bit of a divergence right now in the expression here, but both may be true. I'm curious how the chat is handling the SpaceX IPO. Our very own Tim Knight tried getting in for 1,000 shares, was only allocated, I believe, 24. Were you successful in getting on in SpaceX? Let us know below. This has been another episode of Signal versus Noise. You've been watching Tasty Live. Like and subscribe for more videos. Welcome back to Signal versus Noise, where we take a look at unusual activity on the options tape and ask the question, is there something real going on here or people just speculating? You know, Jermal, today's episode, we're going to go with a little bit of a twist on that framing. Sometimes when someone says you should sell your kidneys before you sell your Bitcoin, and then they go and sell the Bitcoin before they sell their kidneys, it makes you wonder about the kind of conviction that's remaining in the market. And that's bringing us to MicroStrategy and Michael Saylor today, because Michael Saylor, the man who said, sell your kidneys, he's still walking around with two of them, as it were. At least that's as far as I know here on this Thursday, June 4th. Before people start throwing tomatoes at the screen for my tacky jokes, let's consider how much they've sold here. 32. Oh, no, that's right. 32, not 32,000. They only sold 32 Bitcoin, roughly $2.5 million worth between May 26th and May 31st. So, okay. The size doesn't matter here. This is a bit of a narrative break, if you will. Bitcoin's been getting hammered this week. What's going on here?
Look, this is really kind of more about what's going on with Bitcoin and what it's turning into. I mean, it used to be this never say die product that you just held on to for life, right? And now it's become more like a treasury asset, it would seem. And the real big story here, Chris, is what did they sell for, right? And in this case, they sold to satisfy some obligations. So I think that's the real thing about it. It's not the size, it's what did they sell for? And this is something we're going to continue to see in the future. And so as a result, obviously the stock is taking a huge hit. I mean, it's taken a huge hit over the last year and change anyway, but it's even taken more of a hit more recently as a result of this news. And we've seen some options activity. We've seen, I think of all of them, the most interesting is further out, but there's some options activity that went down in the June 18th expiration. They bought the 131 puts. And again, honestly, open interest didn't change a whole lot on many of these trades, but nevertheless, they bought some options in the June 18th expiration. They bought some nearer term options in the June 12th expiration, bought the 128 puts. So both of those are around strike. But then, Chris, the big trade that happened was further out in October expiration on the 50 strike. The 50 strike. I mean, you can see the stock is trading $131 right now. They bought on the 50 strike, and that, I think, is the one that stands out the most. But nevertheless, I mean, this is just more of a story of once upon a time, there was no chance you would expect Michael Saylor and MicroStrategy to be selling Bitcoin, and now they're selling to satisfy some obligations. And that, I think, makes people just a little bit nervous.
Strategy discloses that it sells its 32 Bitcoin at a price of roughly $77,000. And Jermal, I just want to put this in perspective here. That's absolutely microscopic. MicroStrategy owns roughly 843,000 Bitcoin. So selling a handful of them, 32 is about 38%, 0.0038% of their whole total holdings. That's, again, not anything. But there's a change in behavior. Saylor's been the flag bearer for Bitcoin accumulation over how many years now? He changed his verbiage recently where he called MicroStrategy a net accumulator moving forward. For every one Bitcoin that they sell, they're going to try to purchase 9 or 10. But that's a very different type of mindset and level of conviction than never sell or sell kidneys before you sell. And the market's starting to take notice of that right now. It's just more bad news than what's been a pretty long crypto winter here. But I think perhaps the change that we most care about as tasty traders, volatility has finally come back into the space. There's been a rapid expansion of volatility, which is pushing around these option prices in recent sessions.
Well, there was sort of this romantic idea in a way, right? It's almost like what we experienced for the last, seemingly 100 years with Warren Buffett. I mean, this idea that you're buying something and you're holding on to it forever. And I think as much as people have loved to made fun of Michael Saylor, they appreciated that idea that you're going to buy something and hold on forever, no matter what. And now I think it almost seems more like that MicroStrategy is becoming more like a managed Bitcoin fund, if anything. And maybe this is going to be something, albeit not all the time, that we see every so often that they sell for various different reasons, because that's kind of how funds work from time to time.
And you're right. MicroStrategy is effectively a leveraged Bitcoin company. They've spent about $64 billion accumulating Bitcoin. That's worth roughly $53 billion mark to market. So that's an $11 billion deficit right now. And when you think about the preferred dividends, the financial obligations, and the capital market dependence to keep the whole game going, you're really starting to stand on stilts here. So the liabilities, once they're factored into this equation, the never sell mantra that Michael Saylor has held, it runs into the gravity of the cash flow obligations that they have to the outside world. So Jermal, I'm curious what the audience thinks here. Is this signal? Is this noise? Is MicroStrategy a sign of the times? Is this the end of it all for Bitcoin as we dip below 65K? Let us know in the comments below. Thanks for watching Tasty Live. Like and subscribe for more videos.
Well, what's up, everyone? Mike here from Tasty Live, and we're coming at you with another episode of Options in Action. If you've missed this series, it's basically a new series where I take an old whiteboard concept or maybe a strategy that I talked about previously and bring it into an advanced light. We take a look at the platform and we talk through the practical application of some of these concepts. We're going to go through the entire YouTube playlist, the old whiteboard series. So we have talked about call options, put options. We've talked about premium. We've talked about strike prices and expirations, you name it. And today we're talking about the age-old question: can you make more money trading short premium, or can you make more money trading long premium? And what are the gimmies and gotchas, as Dr. Jim says? What are the trade-offs with selling premium versus buying premium? We're going to take a look today, and we'll break it down on this edition of Options in Action. So we got this SPX chart pulled up here, and this is not the SPX stock or index chart. It is actually a chart of a long call out in December, the 8,300 strike to be specific. You can see here SPX at the top is trading at 7,300. So we're looking at this call option 1,000 points out of the money to the upside. And this is the December cycle. So before we dive into this and before I start spewing nonsense, I just wanted to say, when you're selling premium, there's a difference between selling premium in the S&P 500 products like SPX or MES or XSP or SPY. There's a big difference between selling premium in those sorts of products versus selling premium in the equity space, right? S&P 500 or other indices, even products like SMH that have moved quite aggressively with the tech sector popping off and selling off at the same time, there's things to consider, right? short premium in the S&P 500, I've said this before. I think if you can trade successfully short premium on both sides of a market in an equity, you can definitely do that in the S&P 500 simply because the S&P 500 moves less. It doesn't have the same binary events. It doesn't have the same binary nature of equities. You could have a CEO step down and the stock price be down 20% pre-market or after the market closes, or the opposite can happen. They can announce something that the market likes, and that stock is up or down 20% when the options market is closed. It's not necessarily going to happen in the S&P 500. There's also market stops. Even if there is a big crash in the S&P, there's certain levels where the market stops trading. That doesn't necessarily help you in the case of not taking on risk when it comes to short premium. If we're talking like short puts, for example, into a market move like this, or even strangles. But what I will say is over the years, I've learned that there's a time and place for all strategies, right? I have long premium strategies where I'm buying options. It's a lower probability trade if you're holding trades to expiration. But I like to say if you're buying options, you get what you pay for. I don't really buy options that are near term. I don't buy 0-day options. I don't buy 7-day options. In my mind, you're buying a lot of implied volatility in those cases, and it becomes just that much harder to be profitable on those strategies because you have this super decaying asset that is, if it moves against you directionally, it's basically going to become worthless, and it becomes that much harder for it to reverse and work in your favor. If you're buying a leap option, though, totally different story. Leap options cost a lot of money. You get what you pay for when it comes to long premium. But I think when you're buying premium, it doesn't necessarily have to be a naked option. It can be. I actually have a position on in Nike right now. I bought a leap option out at the 60 strike, all the way out almost 600 days away, January of 2028. So this was a situation where, Nike drops to multi-year lows. We're talking decade lows. This Nike hasn't been 45, at least around this price point, since 2015, if I'm not mistaken. So the further a price falls, especially in a product like Nike, where I think we'll still see some upside potential there, yes, I could sell a put to collect that premium. But at the same time, Nike's already fallen and it's still down at 40. If I sell a put 16 days away for $100, sure, I could sell that. It's a higher probability trade. You can see my probability of profit is nice and high at 66%. But I take on the undefined risk nature of Nike, where maybe they announce something, the stock's not down another 10 points, and now all of a sudden I have a $900 loss on my hands and not much management in terms of what I can do. It also takes a decent amount of buying power, $800 relative to a $40 stock. So for me, instead of selling a put, especially when a product like Nike or any other equity gets to multi-year lows or decade lows, I'd rather just inventory some long-term premium. And you can see here, the further out in time you go, because you're avoiding the implied volatility increase of something like an earnings announcement, something I mentioned earlier, you've got plenty of implied volatility here in the near-term cycles that isn't necessarily reflective of these long-term cycles, right? Look at this expected move for June 30th. You have a plus minus $4.60 implied move with a 60% IV almost, but you look at January of 2028 and it's only a 17-point implied move, and that's because the implied volatility is significantly lower when you get all the way out here on the curve. So will I be trading Nike? Will I be selling premium in Nike around the earnings announcement in a defined risk way? Absolutely. Like I said, there's a time and place for everything. I think for Nike with the upcoming earnings, I'll probably sell something in this 22-day cycle, but I'm going to buy something in July or August. I likely will go to something like a diagonal spread or calendar spread in that sense, because I still want to trade intelligently. I still want to reduce cost basis, which has always been something that we've said here on Tasty Live. I want to make sure that I am reducing my cost basis and improving my probability of success anywhere I can. So in this case, if Nike's offering super high premium to sell something against even a long option I'm buying, whether it be a calendar spread or diagonal spread, we can look at this here, like the 45 strike in July, trading for $2.50, we'll call it. The 45 strike in July 2nd, look at that. You have 2 weeks of a difference in time, but only a 40-cent difference in the option prices. I'm absolutely going to be selling something against that long option that I buy if I'm bullish, and same thing if I'm bearish. But longer term, Nike's down to 10-year lows. So what does that mean? It means I'm going to get really far out on the curve here and risk $500. This option hasn't really moved all that much, which is interesting. Nike's still chopped around, and this 2-year leap basically is trading for $500. My whole thesis is, would I be surprised to see Nike go from 45 back up to 50 or 55 or 60? It was just there a couple months ago. So my answer is no, I would not be surprised. And if I'm buying a leap option that has much lower implied volatility, I know, yes, it's a little bit more costly, but I'm out of the IV spike in the near term. I'm inventorying long-term delta, inventorying premium that isn't going to decay against me all that much. And if we get a move in Nike from 45 to 50 or 55 or 60, that option is going to be worth $1,000, $1,500. And we can see this here. If I right click on the option in the chart, the 60 strike, if you right click on the bid or ask, you can have this menu pop up here. View the option in the chart, and here we go. It's been trading for $500 basically ever since I bought it. But back here, when Nike was at 55 and 60, this option was trading for $1,500. So from a risk reward standpoint, as a product like Nike or any other equity gets to decade lows or multi-year lows, I'm going to be inclined to lean into the long-term positioning. I did the same thing in Microsoft, right? Microsoft went from 550 down to sub 400 levels. What did I do? I was buying into some near-term stuff. We set up some short premium trades, of course, but I also did a really long-term calendar spread at the 500 strike. I bought January of 2027 and sold September of this year, and that was like a $500 trade. I was just like, well, I don't know what's going to happen in the near term, but I do feel like over the course of the year, Microsoft's going to be higher than where it is now. And that ended up being the case. We saw a nice bid, got all the way up to 460. And just looking at the order chains here, you can see I've had some decent trades up until that point. And the only trade I have left is that calendar spread in Microsoft. And it's up a couple $100 right now. If we look at the 500 strike, I bought it for $500. It's up $400 right now. So I still want to have it on. I think there's a bullish case for it. But to answer the question, selling premium versus long premium, I think when you're selling premium, you have to be able to withstand all variance within that product you're selling, right? Because from my perspective, the most success that I've had in products where I've sold premium, it's been in products where I've traded small enough or the product size was small enough to where I could manipulate the strikes, manipulate my time and expiration, or a combination of both, right? That's the beauty of undefined risk. You have the flexibility to be like, you know what? I'm done with this strike. I'm done with this expiration. I'm going to buy this back and I'm going to move it out a month. I'm going to move it out 2 months and move my strike and collect a credit still. So that is how I approach undefined risk these days. It's going to be a much higher probability of success naturally, because when you're selling premium versus buying premium, if you sell an option, you just need the stock price to stay out of the money, or in this case, above your 37.5 put. If you're buying premium, you need a directional move in the stock price, and that's as simple as that. So when you think about that, if I'm selling premium and I just need my strike to be out of the money, I'm going to be much more inclined to sell near-term premium because I know that implied volatility is higher. There's not enough time, or there's not as much time for the product to move against me in a big way. It can still happen, of course, but that 30 to 60-day window is where the implied volatility is nice and high relative to a nice blend of time value as well. So that's why we are selling premium in that window. We have research that shows that that's kind of the sweet spot of implied volatility value plus time value. So selling premium in that 30 to 60-day window. Buying premium, I prefer to be outside of that 60-day window. Honestly, I would rather buy premium in a 90-day, 100-day option cycle if it's something I can afford. In the case of Nike, I can do that in a 25K, 30K account, of course. Even smaller, you have the ability to do it because the stock price is so low. But in something like SPX, $7,300 stock price, I don't have the ability to sell premium in here. I can trade spreads in here. I can do calendar spreads, some diagonal spreads in here, but sometimes the stock price is the determining factor of your strategy. So keep all this in mind and just really make sure if you're selling premium, you need to be able to withstand the variance of any kind of move. I prefer to, if I'm selling a put or a strangle, let's talk about puts. If I'm selling a put, I would rather sell it in a product where I can just hold that premium or take the shares. I would rather not exit at 2 or 3 times the loss of that short put, because if I'm selling an undefined risk put, I kind of want to have that bullish delta anyways if it does get down there. I don't want to be stopping myself out and then 2 weeks later see that it could have moved out of the money. So that's just me. But to summarize, if you're buying options, you get what you pay for. I think in this kind of market environment, I'm always going to have something against it. Like if I'm buying a 60-day option, I want to be selling something in the 30-day cycle or maybe the weekly cycle against it. If there's an earnings announcement where that premium is really juicy and I can reduce the cost basis on my long option, because the more you can reduce the cost basis on your long option, the more flexibility you have going forward to have that long option be profitable or even a scratch. If I'm selling premium, I'm very cognizant of the fact that it is a higher probability trade. You're going to have a lot of winners when you're selling premium, but you should also understand how to manipulate that trade. With defined risk debit trades, when you're buying premium, there's not a lot of things you can do. There are certain things like with calendar spreads and diagonal spreads where you can manipulate that short option by moving the strike or moving it out in time. But with short premium, undefined risk short premium specifically, you can do a lot of different things. You have a ton of flexibility in the ability to manipulate strikes. And if you look at my order chains for the MES position, this is my year-long strategy for 2026. I've clearly manipulated this position over and over and over. And every single time I do it, I collect more credit. I started with 93 points in credit. I now have 700 points in credit overall, which means my break-evens are 700 points beyond my strikes. And this is a profitable trade because I've been selling premium to offset any kind of intrinsic value losses that might show against me. So short premium, I like to reserve it for either products that I can afford any variance in, or something in like an index, like MES is a great example, or IBIT even, the Bitcoin ETF. That was my year-long trade from last year. So I think when you compartmentalize these things, it puts you in a good spot to be able to withstand variance. And again, if you have a day like today and you're like, my account is really suffering, then I think your trade size might be off. I think maybe the strategic decisions might be a little bit off. Again, we want to be able to withstand as much variance as possible. With undefined risk, I think it's got to be any variance. The trade size has to be small enough to where you can withstand any variance. It just sets you up for success in the future, and it gives you that flexibility to manipulate the trade as the markets move. And with defined risk, same story. I like to keep them within $500 to $1,000. I think that's a healthy level for me. But again, if I'm doing a diagonal spread or calendar spread, I have a plan for if things go wrong. I know I can move that short strike out in time. I know I can move that short strike up or down depending on the strategy. But yeah, let me know what you think in the comments below. That was a long-winded segment. Wasn't expecting to go that long, but hopefully that kind of mental shift helps a little bit. Again, if I'm selling undefined risk premium, it's usually in an index product or a micro futures product, and it's sector based. It's not something that's going to move 20% pre or post market. But if I am involving myself in those types of products, it's going to be in a product size that is small enough to where I can withstand any variance. I can manipulate the strikes up and down. And I think that's another interesting and important point is undefined risk trading, super high probability if you're doing out of the money sales of options, but understand what you can do to manipulate that risk profile. And that's just going to give you another leg up in the future of trading as the markets move and things go wrong for you. I mean, you're going to have your winners, you're going to have your losers, but you got to know how to manipulate and adjust those losers if they are undefined risk trades. But thanks for tuning in. Let me know what you think in the comments below. Please like this video, subscribe to the Tasty Live channel, and we'll see you on the next episode of Options in Action. What's up, everyone? Mike here from Tasty Live with another episode of Options in Action. If you've missed the previous episodes, this is a series where I'm talking about old whiteboard videos where we're looking at concepts and strategies, but we're giving it more of an advanced twang, and we're looking at the platform itself, talking about certain concepts that I'm using today and how it applies to everyday trading. We talked about expirations last time, and today I wanted to talk about letting an option expire in the money and ultimately taking shares of stock. Also, we can talk about expiration risk and assignment risk and how it's not something that I'm worried about at all. I think we can wrap those up into one and kind of just give you a nice package of ways to think about expiration and why not to be afraid of assignment risk, especially if you have defined risk spreads or an in-the-money short put or in-the-money short call, something like that. So let's dive into the Taste Trade platform and we'll break it down for you. So we're looking at SPY right now. As you can see, SPY has had a massive rally from the lows of this year. In April, we were all the way down at 635-ish. Now we're sitting at 755. Just an insane run to the upside. And maybe that has resulted in the money options. So for those that don't know yet, if you have an in-the-money option, it's ultimately going to expire and turn into shares of stock. So if I have a 760 put, for example, that is in the money, I will ultimately be assigned 100 shares of SPY at 760. Same thing with the opposite side. If I have an in-the-money call, a short option that's in the money, and it is assigned or it expires in the money, I will be basically have 100 short shares of stock at 750. Now, a lot of times we're not really dealing with assignment risk because we're rolling our options positions out in time. And really, assignment risk is highest when you don't have a lot of extrinsic value in your option strike. So even with a 750 call that's in the money, 15 days to go, there's still $600 of extrinsic value that somebody would be giving up to exercise this option and turn it into shares of stock. In other words, they're taking $600 and lighting it on fire. That's why I don't really worry about assignment risk, because it just doesn't happen all too often. I've been trading for over 10 years and I've been assigned maybe 3 times, 4 times maybe. And one of them was a celebration. In this case, it was literally like I had an in-the-money option that had $200 or so of extrinsic value. And I woke up the next day, I was assigned on it. I got the shares and kept that money, the extrinsic value. I closed the shares and I just resold the option and I basically doubled my credit overnight. So that's another thing. If you are assigned early and there's plenty of extrinsic value associated with your option still, it can actually be a benefit to your position. The only situation where that would not be the case is if you had a dividend that you had to pay. So like with an in-the-money call at 730, for example, let's say SPY had a dividend of $400, there's $288 of extrinsic value here. The counterparty would give up their $280 of extrinsic value to get the $400 dividend. So in that case, it's a net positive for that counterparty. And that is the circumstance where you can get assigned early. Your options can be converted to stock early if there's a dividend where the dividend exceeds the extrinsic value left in the option. But other than that, like you can look at these options here, like this is a 715, 720 option. It's 35 points in the money and it still has $200 of extrinsic value. This is still an option that has a low assignment risk here. So not really worried about options that turn into shares of stock. What I do want to bring up is how it can actually change your risk profile for the better in a lot of cases. So yes, if you have a spread, so like let's say you've got a 755, 750 put spread, right? You're kind of teetering on this short option here. This is a defined risk trade. However, if SPY drops significantly and over time someone exercises this short put, you're still left with the long put here that protects your risk, right? Because a short put converts into 100 shares of stock. A long put represents 100 short shares of stock beyond the strike to the downside. So even if I have a short put spread and I'm assigned 100 shares of stock in SPY, if I can hold that buying power, that's the big caveat. If I can hold that buying power, that would certainly be increased relative to this $300 buying power here for this narrow spread. It actually increases my max profit substantially, potential max profit substantially. And that's because the most I can make from this spread is just the credit I received on entry. However, if SPY drops like a rock and I'm assigned on this short put and I still have this long put, as long as I have the long put, my risk profile doesn't change on that package. But I would now have 100 shares of SPY with a static delta of 100, which means if the market dropped dramatically and I get assigned on the short put, I still have the protective long here. If the market rebounds and now all of a sudden we're back at 755 and beyond, I'm making money on those 100 shares of stock where I wouldn't have been making that money on the shares, because with just this options trade, I can only make the credit received. So another situation where that makes a lot of sense is just like take the shares and just use the shares as a static delta lever is in products that are smaller priced, and maybe you've sold a put and you're trying to roll the put forward. Under Armour stands out to me because I already have 100 shares of Under Armour for this exact reason. But let's say you sold a put and these options expirations, there's not too many here, but let's just say you sold the 7.5 put or like the 10 put. You can see there's very little extrinsic value here. The deltas are super high. And if you were assigned 100 shares of stock in Under Armour, yes, you can only make the amount of the put if you sell this put. And I think that's the big key here. If you're assigned 100 shares, you now have unlimited upside potential on how much you can make if the market does recover to the upside. So the deeper in the money a short put goes, the closer it gets to 100 delta, the less extrinsic value you're going to have. So if you're thinking of rolling a deep in the money put and you're trying to roll it, let's say from July to August or something like that, and you're not picking up a lot of credit, but you have a really high delta on your short put, it actually might make sense to consider taking the shares of stock where you no longer have a option that you can only make as much as the option's worth. You would have 100 shares of stock where you can make a lot more to the upside. So that's pretty much it when it comes to options that expire in the money. I mean, again, I don't really hold things to expiration to risk that. That is one of the things that we should talk about, though. Like if you have a spread that's teetering in the money and out of the money, if you let the spread expire and you're assigned on the short put and your long put goes away, now you don't have the same risk profile. You still have the 100 shares that you're assigned on the 755, but you would no longer have the protective put down here. So something to consider, but deep in the money options that have no extrinsic value, if you take the shares instead, you have a higher max profit going forward, and you have the same risk profile as you did with the deep in the money short put or deep in the money short call. But you now have the static delta in the shares, where a short option that's deep in the money, if it starts to rise towards the at the money price, you can only make the amount of the option itself. So again, deep in the money options, close to 100 delta with no extrinsic value. In almost all cases, your max profit is higher if you just convert the shares, if you're willing to do that. If not, you'd have to manipulate the strategy and change the risk on it by rolling out in time and moving it if you can. But those options that are super far in the money are trading like stock basically anyways. So let me know what you think in the comments below. Please like this video, subscribe to the tastylive channel if you haven't already. But yeah, let me know if you've ever been affected by a short option that had a couple $100s of extrinsic left, not a dividend stock, but like maybe someone made a mistake. Maybe the counterparty made a mistake. They converted to shares. You get to keep that premium. You sold out of it again. It's only happened to me once in 10 years. So hopefully that kind of stuff happens to you guys more often. But let me know what you think in the comments below, and we'll see you on the next episode of Options in Action. DraftKings is down 40% from 2025 highs, but the business keeps improving. Q1 revenue grew 17%, sportsbook margins are expanding, and the new prediction market world is already running at a 3.1 billion annualized volume. Wall Street is overwhelmingly bullish. 29 analysts rate the stock as a strong buy, with targets as high as $52 per share. The World Cup could be the catalyst. Tournament expands from 64 to 104 matches, runs 39 days, and could generate up to $4 billion in U.S. betting handle. DraftKings is expected to process more than 1 billion of wagers alone. The stock is still trading like a company in decline. The question, is the options market pricing the biggest betting event in history or just the 40% pullback? Let's check it out on today's episode of Options Math Check. So we've got the Tasty Trade platform pulled up here, and the DraftKings chart, as you can see, is looking a little bit better than it has recently. But when we zoom out, we can see this thing has taken a beating here. But I think what's really interesting with DraftKings is simply the fact that you constantly have high implied volatility in here. Like even the product right now, not many people are talking about it, not many people are trading it, but it still boasts a 50-60% implied volatility. They've got earnings coming up at the end of August, and I think that could be really interesting. DraftKings is one of these products where it's like when football season's going, when you listen to their conference calls for earnings announcements, they're talking about the revenue from football season and all these things. The World Cup is obviously a layup for them. They're going to be making a ton of revenue from the transactions alone from betting. Someone in the office was just like, can I bet on DraftKings for the World Cup? And we're like, of course you can. So I think it's going to be interesting to see how the stock market reacts, specifically with DraftKings alone. But when we dive into the options here, we can see and take a look at the probabilities of being in the money on either side. And we can clearly see that there's an interesting pricing dynamic here when you look at the out-of-the-money strikes relative to the puts and the calls. So I always like to check out just equidistant strikes to see in the near term and also the long term if there's any kind of skew here, and clearly there's a little bit of call skew. We've got a 40 cent option bid on the 25 strike, which is about 5 points out of the money to the downside, but we've got about a 50 cent bid on the upside, 5 points out of the money to the upside at 35. That's in the July cycle, doesn't account for earnings. But if we look at August, which will have the earnings cycle, and we do the same analysis, we've got a 25 strike at $1 and the 35 strike at $1.25 or $1.30. So the market's pricing in the velocity of risk to be to the upside with this call skew. And that's really what call skew is. It's just the options are more expensive compared to equidistant out of the money puts. And that tells us that the market is pricing in velocity of risk to be to the upside if we're going to see a big move. And if we look at the end of the year, December 2026, looking at these same strikes, the 25 strike, 5 points out of the money, trading for about $2.50, and the 35 trading for way more, $1 more, trading for about $3.25. So I think this is super interesting and super telling. Just the fact that the stock has been beaten up, but to the earlier point, you have increasing products, you have increasing revenues, you've got almost every state available in the U.S. For betting markets and prediction markets and whatnot. So I think when you look at all these things and you bring in the fact that we've got the World Cup, we've got football season right around the corner, I think it's only going to be good things for DraftKings. Now, that doesn't necessarily mean that the stock price is going to rally or should rally or will rally, but based on the pricing alone, we've got plenty of call skew here. We looked at 2 different options expirations. So I would say, if we're looking at bullish strategies, at the very least, we can use that call skew either in July or August or even longer term cycles. We can use the call skew to our cost basis reduction advantage by selling that option against something else. So like a call diagonal spread where you've got a short out of the money call further up the options chain, you're collecting more than if you had a bearish strategy on. And the stock's already at 29. If of course could go to 0. But if I'm playing for a move to 45 or 50 or 55, at the very least, we've got that call skew to help us out in terms of cost basis reduction. But let me know what you think in the comments below. Please like this video and subscribe to the Tasty Live YouTube channel, and we'll see you on the next episode of Options Math Check. The smart money is getting nervous. Bank of America says 7 of 10 bear market signposts just triggered, the same average seen at every market peak since 1990. The Buffett indicator, which measures the total value of the U.S. stock market as a percentage of GDP, was at 219% as of March 2026, which is 65% above the long-term trend line. Buffett himself said that when it approaches 200%, investors are playing with fire. Hit a record of 228% previously. The Shiller Cape is at 39.8%, only higher once at the .com peak. Kramer flipped cautious Monday night, warning a wave of mega IPOs, including a potential $1 trillion OpenAI deal, could drain liquidity from the rest of the market. Goldman says crowded positioning means when this unwinds, it unwinds fast. The bulls aren't dead. Morgan Stanley sees 8% upside still, and history says the fourth year of a bull market finishes positive. So who's right? A lot of conflicting information here. Let's find out on this edition of Options Math Check. So we got the SPX chart pulled up here, and like we were just mentioning, I mean, what goes up fast might come down fast, and we're kind of seeing that play out here. The E-minis went from 6,300 all the way up to 7,600 in a matter of a month and a half, and just over the past 4 days, we're seeing market moves and intraday moves that are massive here to the downside specifically. E-minis down 1.5% today, NASDAQ down 2.8%, kind of mirroring that big washout we saw on Friday. I think what's really interesting about this market, and maybe a testament to the potential bearish case, is that crude oil, the one thing we've been hanging our hat on time and time again in terms of if we see the market down, we typically see crude oil ripping higher. Crude oil is not moving to the upside. It's actually selling off today. And you parlay that with the fact that when you look at the near-term expirations in these different contracts, this is the most narrow backwardation I've seen in crude oil in quite some time. 87.95 in the front, 86.43 in the back. This thing got as wide as 15 points at the height of the war. So I think with this backwardation going away and crude oil down today, I don't think we can lean on that anymore in terms of finding a reason why the market is selling off today. And I think the fact that crude oil is down and the market is down big is a testament to this being an equity move versus a reaction in global tension. So I think that's really interesting. And when we look at SPX specifically, for the end of the year here, 200 days away, we're seeing some really interesting things play out in terms of implied volatility. We've got a $6,600 price on the 8,300 call, which is 1,000 points above the current market price with a 15% probability of being in the money. You go to the downside 1,000 points, and we've got put skew here, plenty of put skew to the downside now. You've got an option price at 6,300 that is about to eclipse $13,000 with a 21% probability of being in the money. So not only is the probability higher to the downside now, you've got more than twice the amount of premium, or almost exactly twice the amount of premium when it compares to put versus call premium. This wasn't the case about a month ago when the markets were rising higher. You saw similar pricing from the put side to the call side, and we also have to factor in the fact that SPX prices in interest rate premium on the call side. So take that for what you will, but as of right now, we are seeing put skew getting infused into this market, into the sell-off, as you might imagine, pretty sizable sell-off. Probabilities are higher to the downside now, and I think the most interesting thing here is this volatility curve. So when we had the big market rally, we saw volatility creep into the teens. We saw the VIX in the low teens. But now we're seeing the volatility curve flatten out here. Just a few days ago, we had a 2-point contango between the M and the N contract. The M contract currently sits at 2040. The N is at 2115. So it's not even a point of contango now. We are flattening out across the curve. A couple months ago, maybe a couple weeks ago, we had a 5-point contango between the near-term contract and the V contract. Now you can see it's only a 2-point contango. So this entire vol curve is flattening out. You're seeing an 8% increase in the M contract, and the VIX, I think, is the story here. Up 14%, up 3 points, up to 21.5. I think if we see this continue, another red day in the market, down 100 points or 150 points, and the NASDAQ selling off as well, with crude oil selling off, I think you could see this vol curve completely flatten out. Maybe we trickle into backwardation. And I've always said, if the vol market goes into backwardation, that is the gate that opens for a further market sell-off. I'm talking 10, 15, 20% to the downside. Until that happens, though, I'm going to be trying my best to pick my spots here to the upside, staying defined risk. But again, if this vol curve completely flattens out, or if we go into backwardation, I think that might be a sign that we could see a bigger move to the downside. There's lots of warning signs out there, like we mentioned earlier. But again, the vol curve and volatility is my crystal ball in terms of my guiding light and how I position myself. But I've always been placing some downside hedges in SPX, NDX. I actually just closed out of a couple of them today. So make sure that you're accounting for all things. Even if you're bullish, you should still have some bearish hedges on, albeit small. That's how I like to play it. But let me know what you think in the comments below. Please like this video, subscribe to the Tasty Live channel, and we'll see you on the next Options Math Check.
Jim Schultz here for Calculated Risk. And don't forget, before we get started, the best ways that you can help us are by liking the video or subscribing to the channel. Either one of those guys really helps us out a lot. All right, so earnings season is here, and we all know what that means. Everybody wants in on the action. We're like, you want to get going, I want to get going. We want to trade our favorite stocks. We want to get in on the big names, use our favorite strategies, take our directional shots, and what have you. But we all know that earnings, man, it can go either direction. I mean, these events are binary in nature for a reason. There is most likely going to be a very explosive move in the stock one way or the other. And so when it comes to earnings specifically, a lot of times using a strategy that is defined risk is going to make a lot of sense. I mean, hey, you guys know, if you follow me for any length of time, you know that I don't love defined risk strategies. You know that I think there's a lot more opportunity with undefined risk strategies. But still, we have to be aware of kind of the potential quagmire that we're walking into. And so around earnings, I definitely have a greater love, at least a greater like for defined risk strategies. So today, I want to walk through my all-time favorite defined risk strategy for earnings, the expected move butterfly. So most of the time as premium sellers, like we're trading time and we're trading volatility, right? We're selling premium, we're playing time passing, we've got the positive theta, we've got the time decay, we've got all those things working for us. Okay, that's great. We're also trading volatility. We're trading volatility's natural tendency to contract. We're trading volatility's natural kind of grind lower over time. And so these two things are non-directional in nature, and that's typically what we're hanging our hat on as a premium seller. Okay. But every once in a while, we might want to trade direction. Like every once in a while, we might want to take a bullish shot. Every once in a while, we might want to take a bearish shot. And around earnings, one of the metrics that can be really nice to kind of have an objective view of the analysis around that stock or the market at that given time or what have you is the expected move for that cycle. So looking at the expected move, using the expected move for that cycle in that stock can really give you an unbiased look at what the market is pricing in for the upside or the downside. And the really cool thing is we can use the expected move alongside the expected move butterfly to set up a really nice directional shot that's relatively cheap to play earnings and play it to the upside or the downside however we see fit. So let's hop into Tasty Trade now and let's set one of these guys up. All right, so I'm inside of my Tasty Trade platform and I picked a real doozy of a time to do an expected move butterfly around earnings because it's not really earnings season right now. And so if you go to like the Tasty default watch list, I mean, you can look at the all earnings. I was looking at this before the video, and it's like, man, we've got Len. Like Len has earnings today. Never heard of them. Right? We've got Adobe coming up maybe later today or this morning. I guess we could potentially trade Adobe. But you've got Kroger next week and JBL on ACN. And it's like, okay, this is not exactly the season for the heavy hitters. Like if I go into the Tasty default watch list and I sort by earnings just by clicking on the earnings column, you're going to see that, I mean, there aren't really any decent ones coming up that we like to trade on a regular basis until later on in July. And so really, this isn't the best possible time to do a video like this, but we are so far into it now, we can't turn back. So we're going to go ahead and still use the same basic principles of trading an expected move butterfly like in the front week around a binary event. And so that way you are ready come time July when there are more earnings opportunities. Okay, so let's use Google for the purposes of this example. Now, I may not have done a good job from a calendar standpoint in terms of the best possible time to do a video like this. However, it is a Thursday. So today is a Thursday, and oftentimes using an expected move butterfly, I'm looking to set that guy up in the front week, so using that Friday's expiration. And the reality is this: Thursday into Friday butterflies are really, really nice because with a butterfly, you want to nail the direction of move close to expiration. That's going to allow you to achieve the most profitability out of the strategy. And so by choosing an expected move butterfly on Thursday going into Friday, if you do get the move that you want, you're going to be in a situation to potentially make a decent amount of money in a pretty short amount of time on that following day's opening bell. Whereas if you did a butterfly, the previous week or even like a Monday or a Tuesday going into Friday, it's a little bit more challenging to make significant profits on the strategy because with a butterfly, you want all the extrinsic value to come out of the options. You want all the extrinsic value to drain out of the options, and butterflies oftentimes cling to their extrinsic value until the very end. And so Thursday into Friday butterflies, Wednesday into Friday butterflies using the front week are going to be my favorites. Monday into Friday and Tuesday into Friday, I'll still do them because they do give you more opportunities to make money, but you're not likely going to make that much money. Okay, so if we pretended that Google had earnings tonight, let's say, and I wanted to set up a butterfly to take advantage of that, then what I might do is, let's say I wanted to play Google to the downside. So a lot of times the way that I'm going to set up my butterfly is I want to situate my strike right around where the expected move cuts off. So this copper strip is the expected move for this cycle. So it's only a one-day cycle. The expected move obviously is only plus or minus about $5. And so if I bought a 345 and I sold a 340 and I went ahead and bought a 335 because the butterfly has to be a 1 by 2 by 1. So I go back into the center and I double that guy up. And you can see that is a very, very cheap way to take a directional shot, right? I'm only paying 90 or 91 cents for a $5 wide butterfly. And so again, very cheap way, take your directional shot. If you miss and if you're wrong, and in this case, if Google rallies, then you're only going to lose what you paid. Like you're not going to lose any more than the debit that you paid. And if we were to set this guy up on the call side, you're going to see a very, very similar setup. If I buy a 345, I sell a 350, I buy a 355, I double up on the 350. Again, it's 95 cents. It's basically a symmetric market right now with Google being right around 345. And so with us kind of starting at that 345 market, we essentially have the same pricing on both sides of the market. So whether you want to play it down or up, it's effectively going to be the same risk in both trades and the same risk return dynamic. And generally speaking, what I want to do here is I want to size my butterfly such that it fits with my position sizing parameters, right? Remember, with defined risk, we want to be typically 1 to 3% of our account. Now, in this account that I'm trading here, the From Theory to Practice account, this is about a $35,000 account. So this is a very small position relative to my account size. I could easily go up a few more dollars, no problem. But generally speaking, somewhere between 1 to 3%. If you want to live on the lower end, you want to live on the higher end, that's completely up to you, of course. But generally speaking, that's going to be a pretty good range where we can live. Now, the wider you make your butterfly, the easier it's going to be to make money. That is just the truth. But of course, we've heard it before, and here it is again. For every gimme, there's got to be a gotcha. And so if I'm going to widen out my butterfly, then I'm going to have to pay more for that additional width. So for example, if I just stay on the call side here, just to make this a bit simpler, let's say I move my 345 strike down to 342.5, and I move my 355 strike up to 357.5. Look at what happens with to the debit that I pay. It's gone up to $2.32. But now I have a lot more money that I could potentially make. Now my maximum profit is over $500, whereas before it was only about $400. My probability is higher than it was previously because, again, the market understands and the metrics understand that this is going to be an easier trade to manage if it moves in my favor. If you have a super tight butterfly like $1 wide or $2 wide, like, yes, it's going to be dirt cheap. Like, yes, it's not going to cost you anything. Like, you're literally not even going to know that it's gone if you lose it. The problem is those are very, very hard to manage. Those are very difficult to manage. You have to thread that needle. You have to get the perfect price at the perfect time. And so I much prefer to widen out my butterflies to give them kind of more room to breathe. So I would probably settle on this butterfly. Whether it's to the upside or the downside doesn't really matter. It depends on, the directional bias that I might have. But this is going to make a little bit more sense. Give me a little bit more kind of meat on the bone when it comes to, the risk-return dynamics. Give it a bit more economic significance. And so when you're setting up your butterfly, your expected move butterfly, I should say, pin the expected move with your short strike, and then choose the width of the butterfly relative to your position sizing parameters in your account. And again, this is a great strategy for a binary event like an earnings release. So there you go. That is an expected move butterfly. Now, again, it's not technically a rounded earnings event because I couldn't really find one today, at least in terms of a stock that we all know and trade and are familiar with. And so save this in your repertoire for when earnings season comes around in just a couple of weeks. And so you will be ready to go because we want to hang our hat as premium sellers on time and volatility. But still, from time to time, taking a directional shot, I mean, it's fun. It's fun, it's part of the game, and you might even make a little bit of money. And now you have a really, really cheap way to do that, relatively speaking, with the expected move butterfly. And I'll see you guys next time. Jim Schultz here for Calculated Risk. And don't forget, before we get started, the best ways you can help us are by liking the video or subscribing to the channel. Either one of those guys really helps us out a lot. So generally speaking, here at Tasty, we like to sell premium, right? We want to play into the high probabilities. We want to play into the positive theta. We want to be on the short side of the option contract, generally speaking. But every once in a while, we also like to flip the script. Like every once in a while, we like to buy volatility. Every once in a while, we like to use debit strategies and kind of play for volatility rising. And one of the classic strategies to set up for that type of play is a calendar spread. So what I want to do today is hop into the platform and let's set up a calendar spread. But before we set this guy up, let's just talk in general terms. What does that calendar spread look like? Well, it is going to be a multiple expiration cycle strategy where you're selling the front month and you're buying the back month. You're choosing the same strike in both months. So it's very much an overlapping feature of the strategy between the short option in the front month and the long option in the back month. And the reason why you set the strategy up this way is because you want to take advantage of two elements. You want to take advantage of time decay, even though it's a debit strategy, and you also want to take advantage of any potential volatility expansion. So the time decay comes from the simple fact that that short option that you're selling in the front month, it's going to burn faster than the back month. It's going to decay more quickly than that long option that is sitting in that back month. And for the volatility aspect, the back month option is going to have a higher vega than the front month option. And so by having that higher vega in the back month, if there is any volatility expansion in that underlying stock, you are likely going to see a pop in your P&L from that volatility expansion. This is why we typically like to do calendar spreads when volatility is on the lower end of the range. So all right, let's hop into Tasty Trade and let's set one of these up. All right, so here I am inside of my Tasty Trade platform and I've got Meta pulled up. And this is a $600 stock. Okay, so the first thing you want to understand is we really like to use calendar spreads on higher price stocks. So not necessarily $600, but the price of the stock doesn't necessarily kind of preclude you or prohibit you from doing a calendar spread in that stock, because the higher price of the stock really plays well with the more aggressive management style that we typically deploy with calendar spreads. We're typically managing these spreads at 10 to 20 to 25% of our debit paid. And so if you choose a really low price stock, like a $50 stock or a $75 stock, it's going to be a super cheap calendar spread, which is nice because that is indeed your maximum loss, but it's just not going to give you a whole lot of economic significance when it comes to the profit potential on that strategy. So, okay, so I'm in Meta. The way that we would generally set up a calendar spread is going to be, again, I'm selling the front month and I'm buying the back month. Don't worry about the earnings right now for the purposes of this illustration. We'll come back to that at a later date. Usually, we like to be at about a 1-to-2 ratio between the front month and the back month. So you can see we're at about that ratio right here with this Meta calendar spread. So when I go to set this guy up, I'm going to open up my July cycle first. Now, in terms of the strike selection, remember, we're going to be selling and buying the same strike. So the 580 in both cycles or the 560 in both cycles or what have you. Usually, calendar spreads, the spirit of the calendar spread is a more of a neutral strategy. So you're usually typically choosing a calendar spread with some strike around where the stock is currently. Now, you want the stock to pin the strike. So whatever you choose, that's where you want the stock to go. So if you want to be more directional, then you can certainly choose strikes on the low end. You can certainly choose strikes on the high end if you want to be more bearish or more bullish. But usually, the spirit of a calendar spread is more of a neutral strategy. On that note, we typically prefer put calendars relative to call calendars. It's not a huge difference, but remember, this is a volatility expansion play. This is a long volatility play. So if volatility rises, that's going to help our calendar spread. Well, we know, or maybe you don't know, and maybe this is the first time you're hearing it, But market prices and market volatility typically move inversely. So when market prices are down, volatility is typically up. You can even see it on a day like today where the market is down huge and volatility is up pretty significantly. And so we typically observe this relationship across the board with a lot of individual stocks as well. So if I'm playing volatility to expand, I'm playing volatility to the upside, then I want to position myself to potentially extract as much benefit from that volatility expansion as I possibly can. So choosing the put option slightly below where the stock currently sits, even if it is mostly neutral, choosing a 580 or a 575, that's going to allow me to situate my strikes such that if there is volatility expansion and the stock price moving lower, that's going to really help me. So right here, let's say I sell a 580 strike, which is just slightly below where Meta is right now in July, and then I close up July, I go to August, and I buy the same strike, the 580 strike. And so notice how this is a debit of $14 on this strategy. So this is a fairly significantly priced calendar spread. You would probably want to have, I would say maybe $30,000 in your account or so, or maybe even more than that, or maybe even a little bit less. But this is not going to be a strategy for a tasty bite-sized account. But if I'm managing this at 10% of debit paid, that's $140. 20% of debit paid, that's $280. So it's pretty significant when it comes to the management. When I'm selecting my strikes, I want to make sure that the extrinsic value in the front month is over and greater than the debit that I pay in the strategy. This gives me the best possible chance to make money from time decay, because I know if nothing happens and the stock just sits here, which we know that it won't, but if it just meanders around and ends up back here when all is said and done, then all that extrinsic value that came off of that front month is going to cover the debit that I pay in the strategy, and it's going to effectively make it a little bit easier for me to make money. So this $14 and some odd cents, if we go back to July, where my front month is, you can see I'm collecting over $22 in extrinsic value. I know that that's all extrinsic value because this option is out of the money. And so the way that this calendar spread is setting up in Meta looks pretty good. This would be a great candidate for a calendar spread. And so hopefully this kind of makes sense from the higher priced stock preference to the put preference. It's mostly a neutral strategy, managing aggressively at 10 to 20% or even 25% of debit paid, and then making sure that front month extrinsic covers the debit. So, okay, so that is a calendar spread. Hopefully that makes sense. And we kind of covered the major points of setting up a calendar spread. Now, in today's market, with the VIX skyrocketing and volatility rising, this may not be the best market to sell or put on a calendar spread in, but when volatility eventually collapses, when volatility eventually contracts, as we know that it will, if history is any guide, now hopefully you are ready with a strategy that can take advantage of that low volatility, and I'll see you guys next time. Jim Schultz here for Calculated Risk, and don't forget, before we get started today, the best ways you can help us are liking the video or subscribing to the channel. Either one of those really helps us out a lot. Okay, so around here, you guys already know the drill. Like, you already know that we are premium sellers. You already know that we want to live on the short side of the option contract. We want to play time. We want to play volatility. We want to play probabilities. We want to do all those kinds of things. But time to time, every once in a while, we want to venture off onto the other side of the contract and maybe buy a little premium. Well, today, that's what I want to talk about. When does it make sense to maybe consider being on the long side of the option contract? Well, I can think of 3 specific scenarios, and I want to unpack those in detail right now. So again, by and large, we want to be on the short side of the contract, right? We want to play the higher probabilities. When you sell premium, especially out of the money premium, you're going to have probabilities of profit that are in excess of 50%. Could be 60, could be 70, could be 80, could be 97 for my 3 delta put sellers out there. I probably wouldn't do that myself, but you've got to blaze your own trail. We want to trade the high probabilities of the marketplace. Okay. We also like being out of the money because that gives us room to be wrong. That gives us a little bit of buffer and a little bit of wiggle room on the position when it comes to not needing to be right historically. And then lastly, we've got the implied volatility, overstating realized volatility on average over time. Doesn't happen every single time, of course, but that is what we're hanging our hats on. So when it comes to why we're on the short side of the contract, those are the main reasons why. But when does it make sense to be on the long side of the contract? Well, here's the first scenario. When the VIX is super low. Like, you've got a VIX at 11, 12, 13, 14. You're just not really getting paid to sell premium. You're just not really getting paid to be on that short side of the option contract. And so in these markets, when volatility is at these levels, it's now going to make a lot more sense to be on the long side of the contract because A, option prices are cheaper. So whether you're buying the options outright, again, something else I don't know that I would necessarily suggest, or even buying your spreads, they're going to be relatively cheaper than they would be if volatility was higher. But then also remember, volatility has a tendency to mean revert. Like volatility has a tendency to move back towards its long run average. So with a long run average VIX at like maybe 16, 17-ish, when you've got a VIX at 13, 14, like there's some upward pressure for volatility to expand. Now volatility can live on the lower end of the range for a very, 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 very long time. And so it doesn't mean that it's going to revert back, today or tomorrow or the next week. But statistically, this is a decent time to take a shot by buying premium and playing for that volatility expansion. Okay, so scenario number 2, earnings, right? If you've been around the Tasty world for any length of time, you know we love to trade earnings. There's high volatility, there's lots of movement, lots of action, and honestly, it's just fun. Like you want to do something in your favorite stock, you want to do something in, some hot stock in the marketplace, you want to take a shot, whatever, upside, downside, doesn't matter. It's fun, it's engaging to trade earnings. Well, earnings can be a little, I don't know, man. I mean, it can be a little crazy. Right? The moves after an earnings event can be rather significant. So it can make a whole lot of sense to maybe buy options going into earnings rather than selling options. By and large, we do think the opportunity is still on the short side of the contract, even for earnings announcements. But I respect the fact that some people might look at the scenario and the situation and say, man, I'm looking at AMD earnings. I'm looking at Amazon earnings. Hey, maybe you're trading NVIDIA earnings. And you're like, hey, I don't want to do this from the short side. I would much rather do this from the long side. That's totally fair. That's very reasonable. That's going to be a great time and a great scenario for you to lean into the long side of the options contract and consider buying some premium. You could buy vertical spreads. Hey, you could buy expected move butterfly, shout out to yesterday's calculated risk. You could buy a lot of different strategies, diagonals, calendar spreads even, around earnings and play that long side of the option contract in a much more controlled way. Okay, scenario number 3. It's also going to give you a little bit of strategic diversification. Right? When you've got a portfolio, when you've got a book, as the pros call it, and it's mostly short premium, it's mostly short options, it's like, that's all well and good. You got the probabilities, you got the theta, you got all those things. But just to smooth things out a little bit, just to smooth out your directional bias, just to smooth out your exposure and smooth out the different strategy sets that you might be using, it can make a little bit of sense to add in some long options and add in some long spreads and add in some debit strategies that really kind of balance everything out. Now, let's be clear about this. You're buying verticals, you're buying calendars, you're buying diagonals. In my humble opinion, those are not going to be the things that move the needle. Those are not going to be the things that ultimately kind of get you where you're trying to go. And so we can't expect too much out of our long premium strategies and put too much pressure on them to carry the load and carry the weight. That's what the short premium is supposed to do. And so it definitely allows us to strategically diversify, but we just have to temper our expectations. Make sure that we're not asking too much out of these strategies, things that they were really never intended to do. Because remember, when you buy options, especially naked options, but oftentimes even with spreads, what are you giving up? What are you sacrificing? What are the gotchas, as they say? Well, effectively, you're not going to have high probability. You're either going to have like a 50-50 shot, like an at-the-money spread, or you're going to have very low probability, 10%, 20%, 30%, with like a butterfly or something like that. And you also don't have time working for you. So the two primary pillars of what we like to lean on as a premium seller are essentially going to be either A, non-existent, or B, working against you when you buy premium. So hopefully now you can kind of see we can't really expect too much out of these strategies in the end in terms of being a really significant needle mover. And that's why at Tasty Trade, we lean on the probabilities, we lean on theta, we lean on the short side of the option contract because we do feel like that's where we're going to be able to tap into the big needle movers. Those are going to be the things that get us where we're trying to go and move the portfolio forward. But still, there's a time and a place to add a little bit of long premium to your portfolio. And hopefully now it's a little bit clearer to you what those times are and where those places are. And I'll see you guys next time.
Welcome to Trading Trends. I'm Ilya Spivak, head of Global Macro here at Tasty Live, with a very special guest joining us today. Jeff Curry's here. He's the executive co-chairman of ABAC's Commodity Futures Exchange, a senior advisor to the Carlyle Group, and the global head of former global head of commodities research, I should say, at a little place called Goldman Sachs. Welcome, Jeff.
Hey, it's a pleasure to be here. Looking forward to it.
I have the perfect guest here, I think, for the events that we have unfolding in the world. Obviously, we have some sort of a U.S.-Iran deal, maybe possibly finally coming together. You've pointed out that you can't print molecules, and so all of this stuff may be kind of a moot point. What do you think is going on here? Obviously, crude is down on it.
Well, I think there's a couple things creating the downdraft in prices. One is people were anticipating a deal, so they've quit buying. There's a buyer strike going on. You can see it in tertiary inventories around the world. They're dropping, which tells you they're withholding their buying. The Chinese are withholding their buying. All of them are withholding their buying, which means you're going to have pent-up demand on the other side of the deal. So that's point number one. The investors liquidating their positions. Anticipation prices are going to drop. By the way, when the deal on Friday, more likely than not, you're going to rally because you have all of this selling pressure into this, which I would argue is probably the more likely outcome here. The other factor is what's likely this deal has a near-term impact, which it could unleash the pent-up oil that's inside the Gulf right now. That comes out, but that's not much. Call it 60 plus million barrels. We're drawing 6 million barrels a day. That buys you 10 days of inventory. That's not a whole lot. Longer term, there's a much bigger issue here. You listen to the likes of Maersk and Mitsui, they're not willing to take the ships back into the Gulf right now. And the reason being is they don't see how this thing is solved. So I think there's a lot of unanswered questions right now. It means that the uncertainty remains high, and the sustainability of the deal is highly questioned. The bottom line is both sides are claiming a victory, bragging about things that don't match. So I'm really curious what's going to happen on Friday when these issues come to a head.
And of course, the immediate read-through when this war began was, all right, so we have a disruption in oil. That means inflationary impetus. That means higher yields. That means a stronger dollar. That means the price of gold comes down. All of this obviously coming together. And it's a very interesting time to have this deal because, of course, we have the FOMC policy announcement, the first one for Kevin Warsh coming up. Do you think that the markets are right to still think we've got a rate hike on the menu here because all of this is not going to go away quickly and the inflationary impetus remains?
I definitely believe there's this stuff's not going away quickly because even if you wanted to, one, you got to resolve the mines. France just said they're not willing to start demining this until they see how it plays out on Friday. Then after you get rid of all of the mines, you got to get the ships to come back. That's number one. They got to get the ships to go back in there. What's going to get them to go back in there when the deal doesn't have all the parties involved party to it? The Israelis weren't a part of it. The other Gulf states weren't a part of it. And when you look at the likes of, and I think it was yesterday, J.D. Vance said, who's going to pay the $300 billion that's owed to the Iranians? And our Gulf friends are going to take care of it. Well, were the Gulf friends consulted? Nobody's seen any details of this. These are big questions that need to be asked before those ships are going to come back. Okay, so let's say they agree to bring the ships back in. Then you have to go find the ships, and the ships are all out of place right now. It's going to take, bare minimum 6 to 8 weeks just to get the ships back after you've demined it. And then they gotta feel really comfortable that there's not going to be another outbreak and you got your ship tracked in there. I mean, so that means you got to have some time behind this and be comfortable that it's a sustainable deal. So I think there's a lot of question marks that remain open here, which means in the interim, you're still drawing inventories. Markets are getting tighter and creating the potential for substantially more upside.
Well, I think the question of inventories is a very important one. I mean, I think you've made the point very clearly that much of the kind of resilience we've had to this oil shock so far has come because inventories have been pulled to such an aggressive extent. And certainly not just in the U.S., where it looks like we're exporting a lot to kind of cover the gap, but global inventories as well. How much of a price shock and how much of a durable price shock do you think there is here? Obviously, we've seen CPI and PPI numbers are already showing spillover from this into core. Is this something that's with us here? Is this now an inflationary shock that's already in the cake?
By the way, you're already seeing it. As you point out, you're seeing it in the numbers already. It can only get worse from here, not better. Because the situation is tighter today than it was 2 months ago, than it was 3 months ago. It's progressively getting tighter every single day this goes on. So therefore, you have to come to the conclusion that global supply chains are more stretched today than what they were then. So if it was a problem already in the CPI data then, it's got to even be a bigger problem today and tomorrow until this thing absolutely resolves itself.
That's right. Okay, so let's then follow that lead. So if this is more of an issue, we already have an economy where the consumer is getting squeezed by this, certainly not just in the US, but everywhere. Let's focus on the US for a moment. We have this blistering build out of AI that's driving the economy, but the consumer is obviously a much bigger piece of the pie, and that's the piece that's getting squeezed. Are we starting to flirt with some sort of stagflation type of a dynamic? Obviously, you can't call stagflation so early, but is this where we're heading, and what is the Fed supposed to do with this?
Well, I'm not going to be going out saying I'm not a macro guy. I got to make the stagflation type of argument, but I think they're stuck between two conflicting dynamics. You have AI as a deflationary force, and you have commodity scarcity as an inflationary force. So you got these two things going in very different directions. And I think we're going to create a lot of cross signals for them. But I also want to make the point is that the deflationary pressures on AI are predicated on the ability that it's like the old tech model, infinitely scalable at zero marginal cost. This one's not infinitely scalable at zero marginal cost. This is your standard commodity supply curve, because not only does it have data going in it, but it has atoms and molecules who face upward sloping supply curves. So this is not your standard tech model anymore. This is good old-fashioned commodities. So, I like to do is we're replacing humans with commodities in AI. And human beings are renewable, commodities are not. And I think that point gets lost. So, that deflationary pressure that comes from traditional tech frameworks, I don't know if it really applies here. This is just good old-fashioned commodity production. And I think this is what's been lost by the investors. They think that these companies are magic and that they can trade at whatever times earnings. These are good old-fashioned cyclical commodity companies now. They get 10 to 15 multiples, not 30 or 40 multiples. Then that point, I think, is completely lost on many of the investors, as well as the macro community, assuming how deflationary this whole thing is going to be.
I actually agree. I think you look at the growth mix, at least in the first quarter, you see business investment spinning at over 10% annualized rate. Meanwhile, consumption is growing slower than the economy itself. And you go, well, I wonder if you spin a tiny piece of the economy that fast, what's going to happen? Inflation. So the build out may be inflationary, and then we'll get to the deflation part when and if this thing is finally built eventually, possibly. I think you're spot on here. So for me, as I look at this, sort of the natural question then becomes, we've had these really exuberant moves in stocks this week with the announcement of this deal. Ostensibly, people are celebrating that we're going to get the inflation risk out of the equation. We're going to get oil back down and sort of get back to business as usual. Do you think all of this is actually setting up to be a disappointment for stock markets?
Absolutely. Unfortunately, I think that is going to be the case. And but one thing I don't understand, the corporates are telling you, I'm not willing to do this. The foreign governments are telling you they're not going to go minesweep this because they don't believe it. So why do U.S. financial markets believe it if the corporates don't, the other foreign governments don't? That's the part that I'm a little baffled by, that they're just selling all of this really hard and trading it as if it is a permanent sticky deal. But the reality is very few participants actually come to that same conclusion.
What do you think is the demand destruction aspect of this? I mean, obviously we're going to get to a place, ostensibly, if crude oil keeps marching and the consumer keeps getting squeezed, where it's going to start to bear down on the economy as a kind of cyclical squeeze. What's the window where that starts to counteract the supply shortages and sort of the bottleneck there?
I think it's not going to happen in the U.S. Unlikely to happen here in Europe. It's most likely going to happen in emerging markets and places in Asia, and we're already beginning and have seen it. So it's not something that you will likely feel at home, which is part of the reason why people are ignoring this. It's something that's going to happen more broader on a much bigger scale than just happening, on a more smaller scale. So I think these are I think what'll probably happen is once it encapsulates and becomes bigger, is the U.S. is exporting oil and product all around the world. The end game is that the U.S. prices spike and shut down that hard to the rest of the world. That's how this probably ends. So the Americans will feel it, but it's not going to result in demand destruction because they're too rich relative to the rest of the world.
One last question here. Obviously, the implication for all of this, as we've said, has been higher rates because the markets have sniffed out the inflationary impetus basically on day one of this war. And one of the consequences has been gold prices, which were on a relentless march last year. And really the whole precious metals complex has come down significantly because, of course, these things don't yield anything in real terms. And when rates go up, that's not a good thing for them. Do you think that is a thing that's going to continue if we're looking for crude oil to continue to be sticky at these higher levels? Is gold going to continue falling here?
Yeah, I put out a piece, a few months ago where I was short gold. And the reason being is for precisely what you just said. The rates are going to be higher. They're having to sell gold to fund defense and energy security programs, which is putting a lot of downward pressure. Last week we went as low as 4,000. I think the key message is you don't get long gold again until you're on the backside of this, and central banks are now beginning to think about rate cuts. And at that point, that's why I think you really open up the upside on gold. 5,500 was the previous high. I think we could even double from there, because ultimately you're asking what kind of share of central bank assets does gold need to get to you look at places like China. On a global basis, we're somewhere around 27. Actually, with prices down, we're probably back down to about equal to where U.S. Treasuries were as a share of reserve assets. So call it in that 25, 26%. But if you go back to where we were in the 60s or 70s, you got to push that up into the 40 to 50% range, which is essentially another doubling in the price from here. So that's why I would argue that there's still a lot more upside left to gold. However, I wouldn't want to be long today. I don't think we're ready for it.
And that, ladies and gentlemen, is where we'll leave it. Jeff Curry, thanks very much for joining us. Let the folks know where they can get more from you.
Yeah, you can see in Carlisle.com a couple of pieces: The New Dual Order, The Abundance Illusion, You Can't Print Molecules, and another one is The New Marshall Plan. I would take a look at all of those. Those might be useful.
Beautiful. Thank you very much, Jeff. We hope you'll come back and continue to enlighten us here on Trading Trends.
Thank you. Take care.
Prediction markets are certainly having their moment right now. In my view, it's just another way for traders to take a bet. That's a good thing, though, right? For tasty traders, that's what matters. This is how options traders think. They're thinking in the terms of probability, in terms of betting. How much is the market implying? What's my payout if I'm correct? That's what we have on a pretty interesting guest here today. Maria Canizzo, founder of Kelvin, an AI platform used to help prediction market traders. Before Kelvin, she was VP of product over at Zero Hash, where she built crypto infrastructure for some of the world's largest financial institutions. She's previously held roles at BlackRock and 21 Shares, so she has the institutional side, she has the crypto side, and now she has the prediction market intelligence angle as well. Maria, welcome to Trading Trends.
Hi, thank you so much for having me. Very happy to be here today.
So let's start about prediction markets at the top line level. For a trader who's never used Kalshi, Polymarket, or an event contract try to ground this quickly here. A contract may ask whether or not the Fed could hike at the next meeting, if CPI is going to print above a certain level, or a company contemplates or completes an IPO by a certain date. So what's the prediction market? How does pricing work? And how does the settlement work compared to other financial assets?
Sure, yeah. Well, as we know, more and more of the world is being priced as an explicit probability. So we have Fed, we have sports, we have IPOs as well coming up. The challenge is making sense of them. So some traders are actually starting to use event contracts as precision hedges on specific binary risks. So it's early and liquidity is a constraint, but that's the direction we're going. As an example, let's say your book is rate sensitive. So a no cuts in 2026 contract pays off in exactly the scenario that would hurt that book. Some people might ask, what is the difference between hedging your portfolio with options versus hedging your portfolio with prediction markets? And the answer is an option hedges the market's reaction to an event, so the volatility, the move in the underlying asset, and an event contract pays on the event itself. So these are binary contracts. They settle at $1 or 0, and therefore you have defined risk on both directions. So as a prediction market trader, your max loss is what you paid for the contract, and your max gain is $1 on each contract. So you know your risk going in when you're setting up your strategies.
So our Tasty audience already trades probabilities every single day. Option traders are constantly thinking about implied volatility, expected move, break-even skew, defined risk, whether or not the market is overpricing or underpricing an event. If someone already understands options, what's the easiest bridge over into prediction markets? Where does the logic overlap or perhaps even break down?
Yeah, so let's take a macro lens at Fed rates as an example.
Sure.
So the Fed has held rates steady for the past 3 meetings. We have next meeting coming up next week with our new Fed chair, Kevin Warsh. And an interesting find in prediction markets is that Warsh leans dovish, but the market is pricing roughly 57% odds of 0 cuts across all of 2026, while the Fed's own dot plot still calls for 1. So we do get a new fresh dot plot June 17th, so that's something to look out for. But this is just one of the ways you can use macro events to as a part of your strategy with options, equities, prediction markets.
So when we're thinking about the options, we're talking about how much the stock can move, how much time is left, correct, volatility inputs. But you mentioned already that the payoff structure for prediction markets is often binary. Is the event happening or is it not? So do you find in your research that options market pricing or say predictions market pricing is more efficient than options market pricing?
That's a really good comparison. I would say they're pricing 2 different things. So you can actually use both of them together. As you mentioned, options are pricing volatility, they're pricing movement, they're pricing the magnitude of maybe an event. Maybe we have an earnings event coming up, and you would take a position in an option based on what you think the magnitude of the outcome would be versus the earnings result itself, which would be the prediction market, whether they'll beat earnings, whether or not. So there's actually some pretty interesting strategies that traders are coming up with to take positions in both options and prediction markets to play a more holistic view on these macro events.
I'm trying to think about edge here in this case. For options traders, there are some folks who just so fundamentally understand how pricing works. They can just look at the options chain and say, this is out of whack. I need to buy this. I need to sell that. I can make money doing this without respect for the underlying. So how does a prediction market trader get edge? Is it just by having speed and access to information before everyone else?
That is one of the ways. So prediction markets, as we've all been learning, they are an information game. It's all about information asymmetries, finding information quickly before everyone else does. However, prediction market traders can't just trade headlines. So especially with Kelvin, providing that underlying research, we encourage traders to really look at what is underlying that headline, what are we actually impacting, and use it as another data point. So some traders are even using prediction markets as a data point into other models, into equity models, into options models, and larger strategies, which is a flip on the viewpoint of, let me take a position in a prediction market and hope that I'm right. Instead, we're seeing that prediction markets actually have around an 89% accuracy rate across, on average, across all of the categories. So what's interesting is we can actually take prediction market analytics and plug them into more traditional strategies.
You've had a lot of experience at various institutions. I mentioned this at the top of this show, but Zero Hash, BlackRock, 21 Shares. What did you see in prediction markets that made you say traders need a better platform than this, that led you to Kelvin at the end of the day?
100%, yes. So I've been in crypto for around 10 years at this point, and I've been a trader myself. Early on, I've traded equities, options, Forex, crypto, and now we have prediction markets. But what I'm seeing is prediction markets feels like crypto, let's say 2017, where we had an explosion of the exchanges, but really no data, no tools, and traders just kind of flying a little bit blind that early on. And now we're seeing volume just pour into prediction markets. It is coming from crypto somewhat, and we have all of these different categories with really no tools at the moment. So having something that is AI native, that can synthesize information faster than any human can, and is connected to real external data sources, is something that really helps ground traders in reality, versus maybe taking a little bit more of a blind strategy.
So I think the question at the end of the day for most traders is whether or not prediction markets are just another sentiment gauge where they can actually give you insight into the market that maybe other products or asset classes don't. So what do prediction markets see that the stock markets just aren't right now that provides them this level of intrigue and interest?
Yeah, I think what makes prediction markets so powerful at the moment is they are global. So it's taking in global information. It's information of the masses, if you will. Something that prediction markets have maybe that traditional markets don't. Let's take a look at IPOs. We have SpaceX coming, biggest IPO ever. But what's cool is that you don't need to wait for the bell anymore. So these companies aren't public yet, but you can already trade on when they will be public and what they're worth. So that's something that prediction markets has ahead of traditional markets.
You mentioned liquidity before. It's coming in. The space is new. It's a new way of expressing one's view in the market. But how should traders think about liquidity in market? Are these markets ready for serious size right now, or are they still viewed as ways to express targeted expressions around a specific event?
I think there's a lot more headroom when it comes to liquidity. So a lot of these strategies that are just now being explored and developed, in order to really have an impact on traditional markets or to have a really strong hedge in larger portfolios, let's say like hedge funds or larger funds, we're definitely going to need more liquidity to come into the space. So really excited to see how that grows over time.
As we wrap this up, when you think about prediction market participants making mistakes, what's the most common one? Are they trading around the headline? Are they anchoring to stale probabilities? Are they just chasing a consensus? Why do people fail?
Yeah, well, I think a lot of traders in prediction markets, it's a very social activity at the moment. So trading off of headlines, trading off of social media, And there is this perception that you do need to move quickly and you need to get in before the probability shifts. So sometimes moving too fast can also be a hindrance to making a solid, informed decision backed by data and using prediction markets in your broader portfolio strategy rather than a single, maybe you have a single high conviction bet. But prediction markets, I believe, have more value in your larger portfolio.
She's been Maria Canizzo, founder of Kelvin, an AI research tool for prediction market traders. I've been Chris Vecchio. You've been watching Tasty Live's Trading Trends. Come back for more videos. Like and subscribe. We'll see you next time.
Welcome to Trading Trends. I'm Ilya Spivak, head of Global Macro here at Tasty Live, joined by who I think is perhaps only our second repeat guest here on the show. Rick Rule is once again with us. He's the founder and CEO of Rule Investment Media. Rick, welcome back.
Pleasure to be back with you. Thank you.
Rick, I've saved all kinds of hard questions for you since our last conversation, and I want to go right to the dollar and gold, which we explained last time, how it has been that since the beginning of this war in Iran, we've had, of course, an inflation scare, and against that backdrop, interest rates have come up, and so contrary to what people might have thought, episodically, the dollar is up because there's been a reach for liquidity and higher rates, and gold is down because things have sold it to gain that liquidity and gain exposure to those rates. I want to keep that conversation going. Obviously, this inflation scare is now impacting the broad range of markets. We're seeing it in stocks. We're seeing it in all manner of asset classes. And I wanted to see if in your mind this is an input into the larger gold conversation. Obviously, people have looked at gold as something of a value hedge against fiat currencies being hampered by tremendous levels of debt across most large governments, not just the US, certainly, and not just Europe, certainly. And so I wonder if this kind of inflation in your mind, in that it inflates the debt away to some extent, if that hurts the long-term case or changes the long-term case in any way for gold and precious metals and kind of physical value as a counter to fiat in general.
I think a study of history would suggest that fear of the decline, or in certain cases the decimation, of purchasing power held in fiat instruments has been responsible for most gold moves over the last 1,000 years. People attribute all kinds of attributes to gold. What one finds is that, as an example, other forms of fear, war, political unrest, things like that, have a near-term impact on gold, but they seem to have a negligible long-term impact on gold, except sometimes for participants like refugees, the Jewish community, the Vietnamese community. Those people had a different use for gold. It wasn't speculative. It wasn't investment. It was survival. But for most people, in less dire circumstance, the primary motivation for gold is to shield one's savings from the depreciation in the purchasing power of the currency. It's important to note, as a student of fairly recent history, that is to say my lifetime, that reaction to inflation takes place over longer periods of time. As a very young man, I began to notice and become interested in inflation literally in high school. In 1968, I began reading what are now regarded as Austrian economics or hard money books. And I would suggest to you that although inflation was a topic on people's minds, that the investing public didn't really begin to react to incipient inflation till 1972. In other words, there was a hiatus between the point in time when academics and politicians described inflation and the time that people began to react to it. During that 5-year period, as an example, A hamburger at McDonald's went from 20 cents to $1. By the next year, with the Arab oil embargo, the price of gasoline went from 25 cents to $1. In 1968, 1969, 1970, despite the fact that we were undergoing inflation, investors' expectations of the future were set by their experience in the immediate past. And the 1950s and 1960s have been very good times. People were extremely optimistic. You're probably too young, but your older listeners will remember things like the Nifty 50, which is to say high growth stocks that did extraordinarily well. When your anticipation of the future is set by your experience in the past, and your experience in the past 2 decades is rosy, you don't react to negative stimulus as well. So it took probably 5 years for the population to react to incipient inflation. And I think the same circumstance is happening today. Exactly the same circumstance. We have lived through what I believe is the most benign economic climate in human history in the period 1982 to 2022. People's expectation of the future is set by their experience in the past, by the dips. Believe government inflation numbers like the CPI. If you believe in the CPI and you believe that the destruction of your purchasing power is clipping along at 2.5 or 2.6%, then current interest rates seem very adequate. You know, the 10 years yielding 4.4. You're getting over 100 basis points in real yield if you happen to believe in the CPI. My problem is I don't. I believe that the CPI is better characterized by Mike Maloney as the CP lie. I believe that the deterioration in the purchasing power of the U.S. dollar, marked by the basket of goods and services that I consume, suggests that the destruction of my purchasing power is proceeding along at an 8 or 9 or 10% clip. That presents a very different picture. If you're making 4.4 in a currency that's losing value at, say, 9, you aren't making 4.4. You're losing 4.5. It is when that realization becomes more widespread that gold really performs. Gold is viewed by many people right now, after a 50-year hiatus, as an investment class or a speculative class. I would argue that 1,000 years of human history teaches us that gold is a liquidity class or an insurance class. And right now, people don't feel the need for insurance. My suspicion is, unfortunately, that feeling will change.
Well, I think you make a very clear distinction there, and it echoes what we talked about last time as well, that when we say that the dollar is set to underperform, we're not talking about underperforming against other fiat currencies. No. We're talking about underperformance against hard assets, and fiat currencies as a grouping underperforming against hard assets. And typically that conversation is presented as, oh, well, governments will try to inflate away this debt, but we don't need them to try. We have the inflation here. And so I think the next kind of natural question is, well, gold is having a bit of a hangover here after an incredible rally last year. One thing you've talked about recently that hasn't been caught up in this macro narrative is uranium as another kind of vehicle for sort of expressing a view on physical assets and the kind of value storage that is. Break that down. What's the conversation with uranium?
Well, I need to start by saying in most commodities, the easy money has been made. The easy money occurs when a commodity goes from being hated. It doesn't need to go to being loved. It just needs to go to being unhated. When uranium was at $20 a pound, although it took the industry $40 a pound to make it, so the price had to go up, it was a hated commodity. The move from $20 a pound to $85 a pound means that the easy money in uranium has been made. It also means, however, I think looking forward, that the sure money is in front of us. Why do I say that? Well, for several reasons. The most obvious reasons is that the world needs more power of all kinds. All kinds. Global power demands, global energy demands are set to double by 2050. And we don't have the capacity to produce that much energy. We just don't have that much. Energy will be rationed by price. Nuclear power is extraordinarily reliable baseload power. And importantly, in today's political discussion, it's baseload power that doesn't generate carbon. It isn't the same as burning coal and burning oil. Uranium has, in 5 short years, gone from being a pariah to being a politically correct commodity, which amuses me greatly, frankly. The thing that's really changed with uranium, though, Ilya, was and is the conflict in the Gulf. It has been 50 years since the world cared about energy security. If you dial all the way back to 1973 and the Arab oil embargo, that form of energy insecurity stimulated, as an example, the French to build what is now the 4th largest nuclear fleet in the world. It stimulated the Japanese to build the 3rd largest nuclear fleet in the world. The impetus for that was energy security. Energy security ceased to be a concern for 50 years, but is suddenly a very relevant concern. Uranium is the only fuel on Earth that has enough energy density that the Japanese, as an example, could, if they had sufficient reactor capacity, store enough uranium to power the entire country for 5 years in one uranium storage facility. You can't store that much oil or that much coal or that much natural gas. You can't build that big a battery. The only material that can give energy-short nations, Korea, Japan, China, for that matter, Taiwan, Singapore, energy security is nuclear. The only one. And the big thinkers of the world are beginning to come to understand that. And I think ordinary citizens are beginning to understand it too. That's very important. We are right now producing less uranium than we consume. And 2 things are impacting demand. One is that the Japanese are now speeding up in earnest the restart of the plants that were closed as a consequence of Fukushima. This isn't demand that's going to occur 10 years from now. This is demand that's going to occur 10 months from now. A very different circumstance with regards to pricing. It also is part of a broader trend to nuclear plant construction. Even nations that forswore nuclear, in particular Germany and the United States, are learning that if they are to fund their existing economies, never mind data centers, that they need reliable, inexpensive baseload power, and their voters would prefer that power to be non-carbon generating. I would suggest that the biggest unsung beneficiary, if there is ever beneficiaries of a war, would be uranium with regards to the Gulf conflict. People think of oil, they think of gas, they think of nitrogen, nitrogenous fertilizer, sulfur, helium, all things that move through the Straits of Hormuz. They don't think about the geopolitical attractiveness of a form of energy that gives a country energy security. And there is no other form of energy that gives a country energy security.
Well, I think that's a really important insight here. It's sort of the next step in the conversation where you say, okay, well, today it's a story about a bottleneck, but a year from now, 2 years from now, 3 years from now, there will be some kind of resolution of this bottleneck this way or that, but countries will have learned that they live in a different world now. I think you made the point last time we spoke that the 40 years that were there sort of through the Volcker disinflation almost right up to COVID is a very different period than what we're entering now. Certainly deglobalization and inflation and thinking about kind of the dissolution of U.S. enforced norms would suggest that countries need to start thinking about things like energy security in these kinds of terms. In expressing a view on uranium, because I think, obviously with gold it's easy. There's any number of ways you can gain exposure, from physical to ETFs to futures. Same thing for silver. What's the vehicle for exposure to uranium in your mind?
There are several. I think for most people, the lowest risk exposure to uranium is to buy something called the Sprott Physical Uranium Trust. Note here conflicts of interest. I'm the largest shareholder of the manager. I'm not an officer. I'm not a director. I'm not an employee. I'm just a beneficiary. The Sprott Physical Uranium Trust is a deposit receipt representing physical ownership of uranium at 4 facilities worldwide. Uranium is one of those commodities that one is well advised not to try to buy and store at home for fairly obvious reasons. So the best form of physical ownership is in fact certificated ownership, and by far the most liquid of those vehicles is the Sprott Physical Trust. If someone wants to take a bit of operational risk, I would suggest that the highest quality uranium producer in the world is the Canadian domiciled Cameco, the symbol CCJ on the New York Stock Exchange and the Toronto Stock Exchange for your Canadian listeners. Highly liquid, really a full cycle uranium shop, all the way from producing uranium to enriching uranium to, by now in its engineering group, building uranium mines and processing facilities for others and generating power. The third that people might want to look at is Kazatomprom, which is the largest uranium producer in the world, formerly a large position of mine. I've sold my stock because of middle management defections. Middle management defections that I didn't understand. And I have a hard and fast rule. If there's a risk I don't understand, I sell the stock. There are also a range of uranium speculations, but I'd prefer not to talk to your viewers about those. They require a lot of work to be a responsible holder. And I've found with 50 years of experience that many audiences love the name but aren't prepared to do the work to prepare themselves to own the name. So we're going to leave the speculative ones aside, I think.
And that is perfect. How do you feel about an ETF like URA and sort of ETF type exposure?
For a lot of people, it's probably appropriate. I'm old school. The idea that somebody, including my former employer, Sprott, constructs an index that has probably 50% of the stocks in it being stocks I wouldn't otherwise own. The idea that I have to pay somebody a fee to construct a portfolio that I normally wouldn't own for free is problematic to me. I realize that most of your listeners have lives. They have kids or grandkids. They like to garden. They like to read. They like to do things with their life other than study uranium juniors. And for them, the ETF is probably appropriate, if inelegant.
And there we have it, folks. Rick, I have, of course, 1,000 more questions for you, but we're just going to have you back to get to those. Tell the good folks where they can get more from you.
I'll give them incentive. Anybody who cares what I have to say about natural resources and wants to personalize it, including, by the way, uranium juniors, can go to my website, ruralinvestmentmedia.com. There, if you list the natural resource stocks that you own, I will personally review that portfolio and rank it 1 to 10, 1 being best, 10 being worst. And I'll comment on individual issues if I think my comments have any value. Please, as a sidebar, I know yours is a trading community, no crypto, no tech stocks, natural resource stocks only. The other thing I would suggest to your audience is if you care about natural resources, a conference, which I personally believe is the finest natural resource conference on the planet, takes place July 6 through 10. Not surprisingly, it's called the RULE, Natural Resources Investment Symposium. If you go to rulesymposium.com, you can learn more. The physical conference is sold out, but you can, if you wish, attend the conference from the comfort and convenience of your own home via live stream, rulesymposium.com. By the way, ours is the only conference I know of, live or otherwise, that has an unconditional money-back guarantee. if you attend the conference and think for any reason whatsoever, you being the sole judge, that we didn't deliver full value for your money, email me. I'll give you your money back. Nobody else I know in investor education maintains ironclad money-back guarantee. We've done it for 30 years now. I'm delighted to say we've had to refund about 0.1% of the tuitions that we've charged over 30 years, but that guarantee is your guarantee that we're confident our content at rulesymposium.com can make you money.
And there you have it, folks. If that doesn't explain why Rick is here explaining things to us, well, go check that stuff out and you'll find out too. Thank you, Rick.
Always a pleasure, Eli. Thank you.
Welcome back to Signal versus Noise, where we take a look at the options tape and ask the question, is there any unusual activity that's worth discussing and maybe even trading around? Today's names are two trades, both hitting close to the close yesterday, but with very different messages. The first one is Tesla, ticker TSLA, which is tied directly to the SpaceX IPO, set to open around 175 perhaps here. That has not yet started trading at the time of this recording. The second ticker is Meta, which may be the AI name that the market has not yet fully repriced. But let's start with Tesla here, currently trading at around $394 a share. Someone bought the Tesla June 18th, 432.5 call, 6 days to expiration. Tesla was trading around $399 when the trade hit. The strike was about 8% out of the money. Premium was $3.31 million, and the volume was 14,263 contracts. The open interest jumped by 5,389 contracts in a single session. That's a 202% increase. So this is not a quiet repositioning. It's not someone taking a little dip of a toe into the water. This is a big call sweep done into the close 1 day ahead of the SpaceX IPO. And that timing tells you a lot about the trader's intentions here. SpaceX is being listed today under the ticker SPCX. The IPO price is $135 a share. Reporting ahead of time says it may trade closer to 171, 175 around the open, which would be roughly 27 to 30% above that IPO price. And in doing so, the company would be raising, well, that $75 billion that it was seeking, making it the largest IPO ever. The demand behind the scenes is reportedly $350 billion. The book is about 4.5 times oversubscribed. No wonder we're looking at a potential pop at the IPO, at the open. So it's not just another trade here, right? Tesla is coming in the context of this Musk halo effect. Tesla owns SpaceX exposure through its AI conversion, the XAI conversion, with the FTC approved on March 11th. So if SpaceX rips on the debut, the Musk halo effect can spill directly over into these Tesla shares. That is your bull case here. SpaceX opens strong. The retail demand is enormous against a tiny float, roughly 3 to 4% of the shares, and traders start treating Tesla as part of the broader Elon Musk ecosystem once more. The call buyer is making a bet here that a successful SpaceX debut lifts Tesla quickly. It's going to happen within the 6-day expiration window. There's no time for a slow-moving story. This is a bet that things will work out well, and they're going to work out well very, very quickly. There's a little bit more of a piece here, the institutional side. JP Morgan just upgraded its Tesla coverage from underweight to neutral and raised its target from 445 to 475, excuse me. But that's a massive reset from a major bank right before the SpaceX IPO, and the target is now sitting above the call strike in this sweep here. So the tape is giving us the trade. We have a catalyst right now, and we have a sell side upgrade all at once. Now, the risk here is obvious, perhaps. For those that were following the SpaceX IPO roadshow, there were some detractors that popped up along the way. Morningstar, which is seen as a fairly neutral rating agency, said that the fair value for SpaceX is closer to $63 per share. So if it comes in at 171, there's a massive gap between enthusiasm and perhaps fundamental value. But it's an Elon Musk company. Jim Cramer pointed out that SpaceX could soar to unsustainable levels after the debut, which may be a pretty honest description. The float being only 3 to 4% matters a lot here. The founder lockup being 366 days matters a lot here. The index rules, particularly for the NASDAQ, could start to force passive buying within the next 15 days. This structure might make for a massive first day move, and it can create a market where price gets distorted fairly quickly, especially through second order effects like Tesla as a proxy bet on SpaceX itself. So while the SpaceX play here through a Tesla call sweep is fairly clean, it is the halo effect trade. If the IPO opens up strong, if market goes full Musk again, then Tesla's going to catch a fast bid. If the SpaceX absorbs capital away from Tesla, the halo effect may just become competition. But right now, all signs are pointing in the right direction. So maybe there's some signal within this particular trade. There is another trade, though, and that goes through Meta. There were two Meta call trades that went across our screen here. The first, August 21st, 6:30 call, 70 days to expiration. The stock trading around 560 at a time. The strike is 11% out of the money. The premium is about 4.09 million spread across 2,066 contracts. And then you have the July 31st 640 calls that hit the tape here. The strike's about 13% out of the money. The premium 1.14 million spent across 854 contracts. The open interest on that line was 0 before this trade, and now everything that you see here is entirely new positioning. So the combined bet is about 5.23 million in bullish Meta calls. And unlike Tesla, there's no real IPO halo trade effect going on here. This is a simple, the market has misunderstood Meta's business model. It is undervalued. This is a re-rating trade, which may be a little bit less speculative, as it were. Meta trading around 568 is about 29% below its all-time highs established near 796. Meanwhile, the business is still printing the enormous numbers that you would think would be accretive to higher share prices. Q1 revenue is $55.5 billion, 20% higher year over year. That beat by roughly $900 million. Operating margin is 41%. Cash levels, $81 billion. The AI numbers are starting to perk up too. Meta has 1 billion monthly active users. Llama has 1.2 billion downloads right now. Even Threads, which I'm not a Threads user, it still has 450 million active users on a single monthly basis, which has actually surpassed X. That was surprising for me to learn. Ray-Ban Meta sold 7 million pairs in 2025, up from the 2 million total in 23 and 24 combined. WhatsApp business messaging is now up 74%. So right now we have an interesting setup here. It's the AI infrastructure companies, the ones that are selling the shovels that are being rewarded. Those that are buying the shovels, the service layer on top of it all, they've been punished because it's costing a lot of money to actually build the build out. But consider it right now. Meta has one of the largest AI distribution networks in the entire world, and the market does not talk about it as it does in the same way as an NVIDIA, Marvell, or even a Google, because it's not a hardware company just yet. Meta is an AI company that no one is actually calling an AI company here, and yeah, they deserve to be dunked on after the metaverse and all. But this is perhaps what the call buyer's seeing. They're seeing the future where we start moving away from the bottleneck and we start looking at the actual applications. This is a company with over $200 billion in revenue, 41% operating margins, more than 1 billion AI users, and the stock is still 29% below its highs. The trade that we're seeing here in Meta is a bet that we're not going to get back to those highs, but we can make a significant leap towards there over this next, say, 70-day window, 49 to 71-day window here. And that's where the signal versus noise trade today gets interesting. The Tesla side of this, prospect of trades here, these are event-driven trades. These are binary event risk trades. They are hoping for SpaceX to come in with a bang, that the largest IPO in history lights up the board and the Musk halo effect continues to work its magic. But the meta signal is that there's going to be a shift in the theme around AI, that the market is going to get past this recent bottleneck phase around memory chips, and we'll call it hardware with Dell and Hewlett-Packard performing fairly strong in recent sessions. We see there's a little bit of a divergence right now in the expression here, but both may be true. I'm curious how the chat is handling the SpaceX IPO. Our very own Tim Knight tried getting in for 1,000 shares, was only allocated, I believe, 24. Were you successful in getting on in SpaceX? Let us know below. This has been another episode of Signal versus Noise. You've been watching Tasty Live. Like and subscribe for more videos. Welcome back to Signal versus Noise, where we take a look at unusual activity on the options tape and ask the question, is there something real going on here, or people just speculating? You know, Jermal, today's episode, we're going to go with a little bit of a twist on that framing. Sometimes when someone says you should sell your kidneys before you sell your Bitcoin, and then they go and sell the Bitcoin before they sell their kidneys, it makes you wonder about the kind of conviction that's remaining in the market. And that's bringing us to MicroStrategy and Michael Saylor today, because Michael Saylor, the man who said, sell your kidneys, he's still walking around with two of them, as it were. At least that's as far as I know here on this Thursday, June 4th. Before people start throwing tomatoes at the screen for my tacky jokes, Let's consider how much they've sold here. 32. Oh, no, that's right. 32, not 32,000. They only sold 32 Bitcoin, roughly $2.5 million worth between May 26th and May 31st. So, okay, the size doesn't matter here. This is a bit of a narrative break, if you will. Bitcoin's been getting hammered this week. What's going on here?
Look, this is really kind of more about what's going on with Bitcoin and what it's turning into. I mean, it used to be this never say die product that you just held on to for life, right? And now it's become more like a treasury asset, it would seem. And the real big story here, Chris, is what did they sell for, right? And in this case, they sold to satisfy some obligations. So I think that's the real thing about it. It's not the size, it's what did they sell for? And this is something we're going to continue to see in the future. And so as a result, obviously the stock is taking a huge hit. I mean, it's taken a huge hit over the last year and change anyway, but it's even taken more of a hit more recently as a result of this news. And we've seen some options activity. We've seen, I think of all of them, the most interesting is further out, but there's some options activity that went down in the June 18th expiration. They bought the 131 puts. And again, honestly, open interest didn't change a whole lot on many of these trades, but nevertheless, they bought some options in the June 18th expiration. They bought some nearer term options in the June 12th expiration, bought the 128 puts. So both of those are around strike. But then, Chris, the big trade that happened was further out in October expiration on the 50 strike. The 50 strike. I mean, you can see the stock is trading $131 right now. They bought on the 50 strike, and that, I think, is the one that stands out the most. But nevertheless, I mean, this is just more of a story of once upon a time, there was no chance you would expect Michael Saylor and MicroStrategy to be selling Bitcoin, and now they're selling to satisfy some obligations. And that, I think, makes people just a little bit nervous.
Strategy discloses that it sells its 32 Bitcoin at a price of roughly $77,000. And Jermal, I just want to put this in perspective here. That's absolutely microscopic. MicroStrategy owns roughly 843,000 Bitcoin. So selling a handful of them, 32 is about 38%, 0.0038% of their whole total holdings. That's, again, not anything. But there's a change in behavior. Saylor's been the flag bearer for Bitcoin accumulation over how many years now? He changed his verbiage recently where he called MicroStrategy a net accumulator moving forward. For every one Bitcoin that they sell, they're going to try to purchase 9 or 10. But that's a very different type of mindset and level of conviction than never sell or sell kidneys before you sell. And the market's starting to take notice of that right now. It's just a more bad news than what's been a pretty long crypto winter here. But I think perhaps the change that we most care about as tasty traders, volatility has finally come back into the space. There's been a rapid expansion of volatility, which is pushing around these option prices in recent sessions.
Well, there was sort of this romantic idea in a way, right? It's almost like what we experienced for the last, seemingly 100 years with Warren Buffett. I mean, this idea that you're buying something and you're holding on to it forever. And I think as much as people have loved and made fun of Michael Saylor, they appreciated that idea that you're going to buy something and hold on forever, no matter what. And now I think it almost seems more like that MicroStrategy is becoming more like a managed Bitcoin fund, if anything. And maybe this is going to be something, albeit not all the time, that we see every so often that they sell for various different reasons, because that's kind of how funds work from time to time.
And you're right. MicroStrategy is effectively a leveraged Bitcoin company. They've spent about $64 billion accumulating Bitcoin. That's worth roughly $53 billion mark to market. So that's an $11 billion deficit right now. And when you think about the preferred dividends, the financial obligations, and the capital market dependence to keep the whole game going, you're really starting to stand on stilts here. So the liabilities, once they're factored into this equation, the never sell mantra that Michael Saylor has held, it runs into the gravity of the cash flow obligations that they have to the outside world. So Jermal, I'm curious what the audience thinks here. Is this signal? Is this noise? Is MicroStrategy a sign of the times? Is this the end of it all for Bitcoin as we dip below 65K? Let us know in the comments below. Thanks for watching Tasty Live. Like and subscribe for more videos.
What's up, everyone? Mike here from Tasty Live, and we're coming at you with another episode of Options in Action. If you've missed this series, it's basically a new series where I take an old whiteboard concept or maybe a strategy that I talked about previously and bring it into an advanced light. We take a look at the platform and we talk through the practical application of some of these concepts. We're going to go through the entire YouTube playlist, the old whiteboard series. So we have talked about call options, put options. We've talked about premium. We've talked about strike prices and expirations, you name it. And today we're talking about the age-old question: can you make more money trading short premium, or can you make more money trading long premium? And what are the gimmies and gotchas, as Dr. Jim says? What are the trade-offs with selling premium versus buying premium? We're going to take a look today, and we'll break it down on this edition of Options in Action. So we got this SPX chart pulled up here, and this is not the SPX stock or index chart. It is actually a chart of a long call out in December, the 8,300 strike to be specific. You can see here SPX at the top is trading at 7,300. So we're looking at this call option 1,000 points out of the money to the upside. And this is the December cycle. So before we dive into this and before I start spewing nonsense, I just wanted to say, when you're selling premium, there's a difference between selling premium in the S&P 500 products like SPX or MES or XSP or SPY. There's a big difference between selling premium in those sorts of products versus selling premium in the equity space, right? S&P 500 or other indices, even products like SMH that have moved quite aggressively with the tech sector popping off and selling off at the same time, there's things to consider, right? Short premium in the S&P 500, I've said this before, I think if you can trade successfully short premium on both sides of a market in an equity, you can definitely do that in the S&P 500 simply because the S&P 500 moves less. It doesn't have the same binary events. It doesn't have the same binary nature of equities. You could have a CEO step down and the stock price be down 20% pre-market or after the market closes, or the opposite can happen. They can announce something that the market likes, and that stock is up or down 20% when the options market is closed. It's not necessarily going to happen in the S&P 500. There's also market stops. Even if there is a big crash in the S&P, there's certain levels where the market stops trading. That doesn't necessarily help you in the case of not taking on risk when it comes to short premium. If we're talking like short puts, for example, into a market move like this, or even strangles. But what I will say is over the years, I've learned that there's a time and place for all strategies, right? I have long premium strategies where I'm buying options. It's a lower probability trade if you're holding trades to expiration. But I like to say if you're buying options, you get what you pay for. I don't really buy options that are near term. I don't buy 0-day options. I don't buy 7-day options. In my mind, you're buying a lot of implied volatility in those cases, and it becomes just that much harder to be profitable on those strategies because you have this super decaying asset that is, if it moves against you directionally, it's basically going to become worthless, and it becomes that much harder for it to reverse and work in your favor. If you're buying a leap option, though, totally different story. Leap options cost a lot of money. You get what you pay for when it comes to long premium. But I think when you're buying premium, it doesn't necessarily have to be a naked option. It can be. I actually have a position in Nike right now. I bought a leap option out at the 60 strike all the way out almost 600 days away, January of 2028. So this was a situation where, Nike drops to multi-year lows. We're talking decade lows. This Nike hasn't been 45, at least around this price point, since 2015, if I'm not mistaken. So the further a price falls, especially in a product like Nike, where I think we'll still see some upside potential there, yes, I could sell a put to collect that premium. But at the same time, Nike's already fallen and it's still down at 40. If I sell a put 16 days away for $100, sure, I could sell that. It's a higher probability trade. You can see my probability of profit is nice and high at 66%. But I take on the undefined risk nature of Nike, where maybe they announce something, the stock's not down another 10 points, and now all of a sudden I have a $900 loss on my hands and not much management in terms of what I can do. It also takes a decent amount of buying power, $800 relative to a $40 stock. So for me, instead of selling a put, especially when a product like Nike or any other equity gets to multi-year lows or decade lows, I'd rather just inventory some long-term premium. And you can see here, the further out in time you go, because you're avoiding the implied volatility increase of something like an earnings announcement, something I mentioned earlier, you've got plenty of implied volatility here in the near-term cycles that isn't necessarily reflective of these long-term cycles, right? Look at this expected move for June 30th. You have a plus minus $4.60 implied move with a 60% IV almost, but you look at January of 2028 and it's only a 17-point implied move, and that's because the implied volatility is significantly lower when you get all the way out here on the curve. So will I be trading Nike? Will I be selling premium in Nike around the earnings announcement in a defined risk way? Absolutely. Like I said, there's a time and place for everything. I think for Nike with the upcoming earnings, I'll probably sell something in this 22-day cycle, but I'm going to buy something in July or August. I likely will go to something like a diagonal spread or calendar spread in that sense, because I still want to trade intelligently. I still want to reduce cost basis, which has always been something that we've said here on Tasty Live. I want to make sure that I am reducing my cost basis and improving my probability of success anywhere I can. So in this case, if Nike's offering super high premium to sell something against even a long option I'm buying, whether it be a calendar spread or diagonal spread, we can look at this here, like the 45 strike in July, trading for $2.50, we'll call it. The 45 strike in July 2nd, look at that. You have 2 weeks of a difference in time, but only a 40-cent difference in the option prices. I'm absolutely going to be selling something against that long option that I buy if I'm bullish, and same thing if I'm bearish. But longer term, Nike's down to 10-year lows. So what does that mean? It means I'm going to get really far out on the curve here and risk $500. This option hasn't really moved all that much, which is interesting. Nike's still chopped around, and this 2-year leap basically is trading for $500. My whole thesis is, would I be surprised to see Nike go from 45 back up to 50 or 55 or 60? It was just there a couple months ago. So my answer is no, I would not be surprised. And if I'm buying a leap option that has much lower implied volatility, I know, yes, it's a little bit more costly, but I'm out of the IV spike in the near term. I'm inventorying long-term delta, inventorying premium that isn't going to decay against me all that much. And if we get a move in Nike from 45 to 50 or 55 or 60, that option is going to be worth $1,000, $1,500. And we can see this here. If I right click on the option in the chart, the 60 strike, if you right click on the bid or ask, you can have this menu pop up here. View the option in the chart, and here we go. It's been trading for $500 basically ever since I bought it. But back here, when Nike was at 55 and 60, this option was trading for $1,500. So from a risk reward standpoint, as a product like Nike or any other equity gets to decade lows or multi-year lows, I'm going to be inclined to lean into the long-term positioning. I did the same thing in Microsoft, right? Microsoft went from 550 down to sub 400 levels. What did I do? I was buying into some near-term stuff. We set up some short premium trades, of course, but I also did a really long-term calendar spread at the 500 strike. I bought January of 2027 and sold September of this year, and that was like a $500 trade. I was just like, well, I don't know what's going to happen in the near term, but I do feel like over the course of the year, Microsoft's going to be higher than where it is now. And that ended up being the case. We saw a nice bid, got all the way up to 460. And just looking at the order chains here, you can see I've had some decent trades up until that point. And the only trade I have left is that calendar spread in Microsoft. And it's up a couple $100 right now. If we look at the 500 strike, I bought it for $500. It's up $400 right now. So I still want to have it on. I think there's a bullish case for it. But to answer the question, selling premium versus long premium, I think when you're selling premium, you have to be able to withstand all variance within that product you're selling, right? Because from my perspective, the most success that I've had in products where I've sold premium It's been in products where I've traded small enough or the product size was small enough to where I could manipulate the strikes, manipulate my time and expiration, or a combination of both, right? That's the beauty of undefined risk. You have the flexibility to be like, you know what? I'm done with this strike. I'm done with this expiration. I'm going to buy this back and I'm going to move it out a month. I'm going to move it out 2 months and move my strike and collect a credit still. So that is how I approach undefined risk these days. It's going to be a much higher probability of success naturally, because when you're selling premium versus buying premium, if you sell an option, you just need the stock price to stay out of the money, or in this case, above your 37.5 put. If you're buying premium, you need a directional move in the stock price, and that's as simple as that. So when you think about that, if I'm selling premium and I just need my strike to be out of the money, I'm going to be much more inclined to sell near-term premium because I know that implied volatility is higher. There's not enough time, or there's not as much time for the product to move against me in a big way. It can still happen, of course, but that 30 to 60 day window is where the implied volatility is nice and high relative to a nice blend of time value as well. So that's why we are selling premium in that window. We have research that shows that that's kind of the sweet spot of implied volatility value plus time value. So selling premium in that 30 to 60 day window. Buying premium, I prefer to be outside of that 60-day window. Honestly, I would rather buy premium in a 90-day, 100-day option cycle if it's something I can afford. In the case of Nike, I can do that in a 25K, 30K account, of course. Even smaller, you have the ability to do it because the stock price is so low. But in something like SPX, $7,300 stock price, I don't have the ability to sell premium in here. I can trade spreads in here. I can do calendar spreads, some diagonal spreads in here, but sometimes the stock price is the determining factor of your strategy. So keep all this in mind and just really make sure if you're selling premium, you need to be able to withstand the variance of any kind of move. I prefer to, if I'm selling a put or a strangle, let's talk about puts. If I'm selling a put, I would rather sell it in a product where I can just hold that premium or take the shares. I would rather not exit at 2 or 3 times the loss of that short put, because if I'm selling an undefined risk put, I kind of want to have that bullish delta anyways if it does get down there. I don't want to be stopping myself out and then 2 weeks later see that it could have moved out of the money. So that's just me. But to summarize, if you're buying options, you get what you pay for. I think in this kind of market environment, I'm always going to have something against it. Like if I'm buying a 60-day option, I want to be selling something in the 30-day cycle or maybe the weekly cycle against it. If there's an earnings announcement where that premium is really juicy and I can reduce the cost basis on my long option, because the more you can reduce the cost basis on your long option, the more flexibility you have going forward to have that long option be profitable or even a scratch. If I'm selling premium, I'm very cognizant of the fact that it is a higher probability trade. You're going to have a lot of winners when you're selling premium, but you should also understand how to manipulate that trade. With defined risk debit trades, when you're buying premium, there's not a lot of things you can do. There are certain things like with calendar spreads and diagonal spreads where you can manipulate that short option by moving the strike or moving it out in time. But with short premium, undefined risk short premium specifically, you can do a lot of different things. You have a ton of flexibility in the ability to manipulate strikes. And if you look at my order chains for the MES position, this is my year-long strategy for 2026. I've clearly manipulated this position over and over and over. And every single time I do it, I collect more credit. I started with 93 points in credit. I now have 700 points in credit overall, which means my break-evens are 700 points beyond my strikes. And this is a profitable trade because I've been selling premium to offset any kind of intrinsic value losses that might show against me. So short premium, I like to reserve it for either products that I can afford any variance in, or something in like an index, like MES is a great example, or IBIT even, the Bitcoin.
All right, yeah, I'll talk to you. There she is. Good, you found the place. Good, you're not stupid. I dated 3 stupid girls in my life. I loved every one of them. So maybe you're the next one. Having a good day? I'm having an awful day. But then it got really good again. So I'm feeling all right. Hey, where'd you go to college?
I went to
University of Penn State Community College. You didn't know they had one of those, did you? Yep, the Fighting Rams.
Oh.
I'm one of the Rams now. Do you have any sexual fantasies?
Excuse me?
I do. My parents are watching. They're sitting on a rainbow. I'm a half man, half giraffe, and I'm dressed like Brett Favre. What does that mean?
I don't know.
Yeah, talking about it gets me pretty hot, though. Uh-oh, there it is. His pants just got tighter. I'm a vampire. Can you believe that? Does that make me more mysterious and attractive? Uh-oh, watch yourself. We don't want to get hit by a car. My brother did that once. He can't talk now.
God, that's serious.
Yeah, pretty serious. Are we getting serious? I think so. How many kids do I want? 5? 11? First meal. Here we go.
That was rude.
This is on you. So much time is flying by.
Yeah.
You're very funny.
Oh, thank you.
Does anybody ever tell you that?
Yeah.
Well, you're not that funny, so don't worry about it.
That's interesting.
Not a big fan of Sam's anymore. But now you know everything about me. I feel like I'm opening up so much. God, I'm scared. This thing's moving so fast.
Yeah.
Oh, wow. I haven't cried like this in a long time. Are these tears? Uh-oh, here we are. Front door. Big first kiss moment.
Oh.
This is just moving a little too quick for me. You're a great kid.
Clip thy waxen wings, thou economic Icarus. Discard these feathery adornments, thy flight's too vigorous. Rather, garb thyself with the soft fur of the bear, and dwell in low burrows of the valley fair. Forsake thy previous highs and perilous summit, for lo, I am short, so I must needs thee plummet. O market, I implore thee, make no high. Like some comic Fozzie, unclip thy bow tie. If thou dost tumble, I shall offer thee up a succulent hoagie. So, ye markets, remain as bearish as beloved Yogi. Follow thee the lead of Kipling's Baloo, and may the move be sweet as honey to Winnie the Pooh. With joy I watch descending chart lines straighten, run down with quickness and sweetness, like Lord Walter of Peyton. Let curious traders admire thy Berenstein way, and joyfully stealing some porridge, let us now say, sweet bearish market, never would I cage her, but admire her drop like some terrestrial Ursa Major. Come down, ye markets, to this sylvan glade, and let the bears have their day at Tasty Trade.
World of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Global markets never sleep. Explore them with Forex on Tasty Trade. Get in on 80-plus Forex pairs, 24 hours a day, 5 days a week. FX marks the spot. Trade it on Tasty Trade.
Hello. Happy Thursday, which is a virtual Friday. This is the last trading day of the week. And we've got a green day going. ES, NQ, RTY, all green. I suppose because they signed the peace deal a day early, or a couple of days early, whatever. I'm having a pretty good day. A lot of red on the screen. The market was at lifetime highs just yesterday, as measured by the Dow, but I am fully short. I've got some dry powder left, but I'm much more aggressively positioned than I've been than in a while. And it's been a good week for charts. You know, I got bearish on XOP because the right triangle, that worked out. I called the top on SpaceX, which was insane. That worked out, although I was really worried that I shot my mouth off on that one. And gold, Bitcoin, a lot of good things. A lot of good things happening. And I've got a goodly number of charts to thumb through. So let's jump in. And we begin with the NQ, the tech-heavy NQ, which is having a strong day up, hundreds and hundreds and hundreds of points. We're near lifetime highs on this. And we're still below the broken trend line. We're just below lifetime highs. And I'm very short right now. In fact, I've gotten so bearish on tech that I'm even shorting stuff that if I had any sense I would not be shorting, like those bottle rockets over in storage media companies, and even some semiconductors here and there. So yeah, the gloves are off, the bearish gloves are on, and I'm just shorting anything with a ticker symbol, but still being very impatient with anything that doesn't behave itself. I will chop things off as needed if not behaving, but otherwise, obviously with 40 different positions now, all bearish, I'm ready for some downside. SMH was interesting this week. We're at a lifetime high right now. I was already short by way of being long January puts, and I added to them here on this day. I sold them, some of them, here, and today I got right back in again. So, these things have like hundreds of days on them left, literally, so I'm not sweating bullets on this one. The interesting thing about this trend line is that right now, with all the strength, we are exactly below the broken trend line, which if it holds and repels it, that's exactly where I'd like to get more bearish, which I did. So this is by far my biggest options position. January 2027 puts on SMH, and we will see how it goes, because this, all the stars are lining up except for this one. But if this starts to turn south, if this starts to weaken, because it seems to be feeding on itself right now, but if this starts to weaken, then all the stars will be fully in line. So I'm ready if it happens. One item I'm not shorting, although it's still in the realm of the kinds of stuff I am, is SanDisk. It's very young, has very little history to it. Lifetime high on this, and it's been playing jump rope with its own trend line here. It's above it right now. However, I have shorted earlier today storage technology STX, or Seagate, STX, and that is teetering on its own trend line here. I'd like to see it break it, of course. Lifetime high earlier today, but I'm short that. Also short WDC, Western Digital. Did that earlier today. And you can see that on both an intraday and a present price basis, lifetime highs on this one. But these have all been just bottle rockets. I mean, look at this. Just straight up. An item I've been mentioning from time to time, both morning and afternoon lately, has been Carvana. Carvana, CVNA, had a really nice tumble yesterday thanks to its compatriot CarMax falling. It has recovered much of that today. I've bought more puts because I love this pattern. And yesterday, I believe, completed the pattern. And these are my only short-term puts. And for me, short-term is like September instead of next year. But should the happy day come when we wake up and this thing's just plunging like crazy, then I'll get out. Tiptoeing lower, doesn't do it for me. This thing needs to just basically collapse for me to hit the payoff that I'd like to see. It's profitable so far, sure, but that's not why I'm in it. I'd rather have a nice fat profit when I'm taking a position this aggressive. So I still like Carvana quite a lot. Let's take a moment. 1 week out now, We have 5 trading days in the bank, I guess. Do we? Yeah. 4 + 1 is 5. Yeah, the math checks out. So this came public, of course, last Friday. IPO price of $135, and it opened much higher than that, or somewhat higher. The low, let's just call it 150. It's 149.34, but just make it simple on ourselves. So 150 has been the lifetime low so far. On a 24-hour basis, it got as high as almost 230. It got up to like 228 something. And yesterday was the first red day in its whole history, which was the 4th day. And then today we have another red day back to back. So judging from the IPO price, it's done great. I mean, it's presently at 170. Let's call it 180. It's presently at 180. The IPO price was 135. It's done fine. It's been out a week. It's done just great. But I've got to believe some people are getting a little bit nervous. And I would not be completely shocked if we actually saw this trading next week at, a lifetime low, which sounds very dramatic, but just means like below 150. Because at that point, what it can be said is that every single person in retail land, well, every single person who's bought this as a public entity, post-IPO, is in a losing position. We're not there yet. I was also stunned to see that even though the options on this just came out this week, it was like the top options volume of anything, if I recall the article I read correctly, which is sort of stunning. So a lot of attention on SpaceX, a lot of trading activity around SpaceX, and about a 20% dip from that peak we saw. I haven't looked at the other space stocks like AST and all that. One I glanced at was Firefly Aerospace, and this has been pretty much read every day for weeks at this point. It's gone from the 60s down to the 20s, and as I've said over and over again, the thrill of the anticipation. It's like what are the wisest words ever from Star Trek? Well, that's a rich canon to draw from, but I think it's when Spock said that wanting is better than having. And that is definitely the case when it comes to all these rocket stocks. Wanting SpaceX to come out, anticipating it. The psychology of tomorrow. Won't it be great when? Fill in the blank. That is a very seductive mistress for humanity, and definitely worked in the world of rocket ships. So, I haven't thumbed through them, but they're certainly, the fever's been broken. One item that I also shorted not too long ago, which is in the same category as the bottle rockets I've talked about, is AXTI. That one's doing fine already. The others I'm just kind of hoping break. This one's broken, and we're down today on this double-digit %, which is cool. And just to back up here, you can see that until about, a month or so ago, this thing did nothing but go up. And we had a whole series of higher lows and higher highs. And the tippity top of this was right there. It opened basically at its peak. And it's been slogging down. I don't remember exactly when I got this. I'd like to think I got it here. I'm not sure. But it's definitely very profitable so far. And I'm hoping to hold on to it a lot longer as we unwind some of that bottle rocketness. Another item that has done well is Equinox, EQX. I mentioned this yesterday. I think I was castigating myself for not doing a better job with my gold trade, which I kind of screwed up 9 ways to Sunday. But I did short this one before Warsh yesterday, and this is working out well. 2 nice fat red bars on this one. And as I pointed out yesterday also, I think they're all starting to blend together. It was bad enough when I had 1 show, now I'm on 2 shows, and so I'm not sure who said what to whom. But I think I mentioned the very nice top on this, and we're reversing away from that, because gold is down triple digits again, and the miners are falling too. Some other various and sundry shorts out there. I mentioned this one earlier, H&R Block. This one has been slipping for weeks now, and today it's down about 2.5%, but So far, so good. Hang on to that. There's really precious little I'm closing. I toyed with covering Microsoft just because it was such a big profit so far, but it's like, well, why? I mean, this chart stinks, so just tighten up the stops. That's what I've been doing, tightening up the stops. XLF, I shorted early today because I noticed, I haven't drawn it here, but I noticed it was pinging right up against its trend line. And so far, so good on this one as well. We've got a nice fat bearish engulfing pattern on this, down about 0.8%. And we'll see how that continues to go. The trend line, is pretty sure I had drawn it. I don't see it anymore, but it was something like that. Yeah. So we've been dancing with that trend line, but we've got a nice reversal on that today. Just because I was like, well, I might as well say one long idea. I'm not doing anything about it, but I just want to mention KLAR, Klarna, looks kind of interesting. It has been executing a series of higher lows. It has pushed above its price gap. I just thought once in a blue moon mentioned something bullish. If the market were cheap in general, I'd be a lot more excited about it. But anyway, just saying, KLAR. Crude oil continues to sink, although it's calming down. The sinkage is less dramatic than it was, say, on Tuesday. We're down in the mid-70s on this. But the ETFs that are in that realm are doing nicely on the downside. And if you're not in it, you know, if we get a bounce, it might be a second chance at it. Here's XME, which is the energy select sector, and beautiful little head and shoulders on this one. The measured move on this, I haven't figured it out, but it's not here. It's lower. So maybe we'll get a bounce on this to get another chance. So that's a very pretty little pattern. And as I mentioned earlier, XOP had this cute little right triangle pattern here, which whose base is defined by this inappropriately colored line. We'll make that red. So if we get a bounce to that line, that too would be a fresh opportunity to get bearish against energy. Seems a little bit late right now. As I said, I foolishly covered Schlumberger before it got really good. This has been plunging 5-6% a day, so this is a real nice tumble on this. Although in my defense, it's not really defense, but to counteract this a little bit, I am still short Halliburton, HAL. And in this case, let's just real quick draw a very obvious little pattern right there. So yeah, that's worked out nicely too. And this is a good example of the kind of things like, well, maybe I should cover it, and maybe so. This is getting pretty long in the tooth in terms of how much is drooping, but those have worked out well. Bitcoin is having a pretty bad day. You remember me yesterday dying to wrap up the show so I could go short some more Bitcoin, and I did. This is working out nicely. And as I say, maybe we're not going to get to 70. Maybe this is as high as we get earlier this week. The key, of course, is to break the kinds of lows we'd seen last week. But this is being driven, I suppose, in part by concerns about Michael Saylor's strategy. The company, not the noun. MSTR has had every single day this week has been a big fat red candle. And today is the fattest of all. So it's been falling every day this week. This had been about a $548 stock. Now it's hanging on to barely triple digits, about 100 and something. And it's very vulnerable. And what's really drawn attention to this is their companion security, STRC, which, as you can see, has plunged to lifetime lows. This is the 11.5% dividend means by which they gather cash to buy Bitcoin, but not doing so well. Lastly, gold is slipping nicely, about a 3.6% drop on this, and I think we've got plenty lower to go. This is it's not particularly clean, but this is a very well defined, especially from the right triangle perspective, bearish pattern. So anyway, long weekend ahead. I've got a couple new videos coming out in the next several days, so you'll see those. But have a good long weekend, and I'll see you here on Monday. Bye-bye.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
Mike, what does it mean to be assigned?
When you are assigned, you are ultimately short an option that's in the money, and the counterparty has the ability to exercise that option. So if you are assigned, it means your option, against your will, ultimately, has turned into 100 shares of long or short stock.
What does a green scratch mean?
Ooh, a green scratch refers to stubbornness getting the best of you. And when I say you, I mean me. Green scratch refers to rolling a position, defending a position, and instead of just closing it for less than loss that you're seeing, or maybe a $100 loss, $50 loss, a green scratch is when you close it for maybe a 5-cent winner, 10-cent winner, 15-cent winner. Just the ability to see that green number on your screen and get out in a profitable way as opposed to a loss.
Ilya, we're back. It's the final 30 minutes of the trading day, final 30 minutes of the trading week. Tomorrow's Juneteenth, so federal holiday markets will be closed. You're watching Last Call. I'm your host, Chris Vecchio. He's your co-host, Ilya Spivak. We're here to take you through the rest of this afternoon drive. Ilya, before we get to it, let's get into it. Stocks here are still holding up. They really haven't moved all that much for the past few hours. 2.2% higher here on the NASDAQ right now. About 8, maybe 0.9% higher on the S&P 500, moderating around 75.56, 75.60 or so over the past hour or two. But of course, with that move higher in stocks comes the push lower in volatility, and that is our North Star around these parts. Back below 17 in the VIX at 1682, with our front month July expiry volatility futures contract in at 1868. So bouncing right around some of the lowest levels that we've seen in recent days. But here's where this is an interesting wrinkle. Of course, it's a triple witching day. So we have single stock, equity options, yada, yada, all expiring today. And so that mechanical flow often, I don't want to say disturbs or distorts the equity market, but it has a tendency to perhaps push things in around in a manner that creates some disparities across the board. So, for example, a day like today, gold is still getting hammered down 3.6%. Silver is getting absolutely smoked down another 7.7%, Ilya. Dollar's going up quite strong. DXY is sitting at its highs over a par now, 100.88. This is actually the highest level we've seen in more than a year. So there's some things that are happening right now. But you know what? Let's forget out the inconsistencies for a second and go to everyone's favorite. Sammy's baby. Semiconductors are closing out this week at new all-time highs. Micron, pick a name out of the hat. ASML, AMD, Intel. Intel's up 11% here in today's market, Ilya. So there's a little bit of bifurcation right now. The AI trade, the semi-cap trade, AMAT, all those names, they seem to be coming back into gear right now. So if you're tech, if you're in the AI infrastructure stack, this Friday, this synthetic Friday, has been good. Let's not talk about any other stocks, though.
Yeah, it's an interesting kind of day. I think you really get to see from the indexes, and S&P is as good as any, but NASDAQ is showing the same story. You're looking at a situation where we had the upside gap at the start of the week around this memorandum of understanding between the U.S. and Iran being something that markets decided was tangible. And rightly so, as we now know, but we get that upside gap at the start of the week. We go, hey, that's good. And then the Fed comes out. We go, hey, that's not good. And we end up basically where we started. So it ends up being essentially something of a scratch week, absent that gap. But if you look at the price action outside of stocks, you just mentioned the dollar, you mentioned gold, silver. It's an interesting story there because they're moving as though a hawkish Fed is going to drive interest rates higher, but the bonds aren't necessarily complying. They're not complying. They're also not really going anywhere fast. And so there's an interesting sort of bifurcation here in the story about what the markets care about. And you wonder if after the press conference today that J.D. Vance gave and said, look, this starts a clock on a 60-day negotiation, the markets don't come back next week and go, right, okay, so that's done then, because last time it took years to negotiate a deal. This is not going to get done in 60 days. We're in some sort of limbo now, but the strait has been returned to motion.
It has returned several ships. I think we've had more. I think north of 10 ships now cross. It was 6 overnight, but I know that doesn't seem like a lot, but in the grand scheme of things, that's more than we've had.
Things are moving.
Things are starting to actually move again, which is wonderful news if you're a fan of people not starving. Go on.
Right. And so I think the markets come back next week, and my thought process is they come back and say, right, so we got the MOU. This thing is frozen in time, probably for a period of years. There's a provision in this MOU to kick the 60 days out as long as both sides agree. Both sides love stalling and have an interest to stall. So, okay, great. Everybody wrote down all of their rosy scenarios on a piece of paper. They're going to be at an impasse about them until the end of time. Meanwhile, the oil is flowing. We're kind of back to where we were in January. So, all right, fine. What's left? A hawkish Fed that's going to hike rates this year as far as Fed fund futures are concerned. So I wonder if we don't, now that we've reset in a way this week, don't end up next week with something that risk sentiment doesn't like.
Oil here is bouncing a little bit higher in today's session. It was down over 3% earlier, but back to 75.85, stabilizing right around that low. I'm curious, if we're in a ceasefire for 60 days, if you're one of these countries that's been negatively impacted, what are your top priorities? Get oil, get some dollars just in case it hits the fan again.
Yeah.
So
sell some gold while you can. Get your hands on some cash.
That's one of the more interesting divergences that played out since the Fed meeting yesterday. We were talking how, both of us have been leaning a little bit short gold here. Mm-hmm. I only went in to just try to build into a position in the 10Z contract before maybe going up to MGC. This thing has been like a knife through butter today.
Yeah, I barely got a chance to add.
No, I didn't have a chance to add. I was looking at other things. I was today in the trenches buying more stocks. So NASDAQ, semis. So I wasn't paying much attention to gold. So it was a little surprising.
Kiss of the back of support.
Yeah.
My God. Please tell me technical analysis doesn't work, everybody. Just look at that.
No, it's pretty sequentially clean here, and we have rising real yields still going on across the board. The dollar is actually quite strong today. The dollar yen is breaking through 161. BOJ's got a problem on their hands. But this is one of the reasons why I'm looking at the stock market rally today, and as nice as it has been for some of the, particularly the shorter term positions that I'm in right now, I do have a little bit of a raised eyebrow here when I look at gold and the dollar and what's happening with treasury yields and oil.
Yeah. Yeah. I think you have to, again, go into this mindset where you have to remember what stocks did the moment that the words ceasefire emerged. Now, we've had multiple ceasefires. We've had multiple violations of the multiple ceasefires. But the moment stocks heard ceasefire, they ran. Nothing else did. Everywhere else, there was a shock. Everywhere else, there was an inflation conversation. But the problem is that before, stocks could do that because they had a steady stream of news flow from the earnings season.
We get Micron next week. Micron is one of these companies that's how much of its net income is it retaining right now? Like 80%? Ilya, 1141, and it still has a forward PE ratio sub 10.
Yeah.
Which is incredible, because you and I have been having that conversation since it was trading around 700.
It's incredible. And I think you have to ask yourself whether incredible things are more often than not some sort of new thing or some sort of thing we've seen before. And the thing we've seen before is when you see weird things like this, when you go, how is this even possible? Typically,
I know how it's possible.
Go on.
We've broken free of the constraints of the previous boom-bust cycle in semiconductors and chips, because now the demand for compute is so high and has risen to the level of strategic importance akin to national defense or energy. And so you have sovereigns, and you have sovereigns now. This is China, the U.S., Europe. There are different types of buyers in the market now that have fundamentally altered the cycle.
That is an idea that I'm not going to disagree with.
We've been kicking it around for weeks now.
What I would point out, though, and again, this is where this is the debate to have. Either that, what you've just described, is a smooth path, or it isn't. And I think what history tells us is that you do not just get to extrapolate that path in a straight line ever. That has never happened once with these kinds of technologies and with these kind of frontier breakthroughs.
It's an exponential curve.
Oh, it's not even that. It's let us say something resembling a coat hanger.
Okay, so you say, is this something new or impossible? Literally flashing across my Twitter feed right now are blue, orange, and white confetti going across New York City because the Knicks are NBA champions. So
fantastic.
Things that have never happened before.
All kinds of things are possible. It's just sometimes you have to wait. You have to wait decades for them to build.
Well, thankfully, the way that I'm operating in these markets, at least with SMH, I'm not too concerned about waiting decades because it's 29 and 43 days to expiration here, Ilya. I'm continuing to operate and holding in the initial leg of the short put spreads we get this bullish falling wedge coming here. We start to get a breakout right as volatility dips. Love to see that in a growth sector. If you're looking for bottom left to top right price action, you get the chart pattern that you want that says continuation up and volatility starts coming in. And volatility for semis, when volatility's up, is typically bad for semiconductor stocks, at least in recent months. So you get those two things coming together. You clear the most recent swing high. Okay, we get our breakout into new highs, pull back. I use the opportunity to get in a little bit more long delta here, Ilya, selling another short put spread in this market, continuing just chase it up reasonably. Why around these levels? Because it's below the swing level that, defined the previous swing high in the wedge. So as long as this is still working out, we shouldn't be clearing out the lower low if the trend is continuing and now breaking out into its next uptrend. So I'm very comfortable holding with that going into next week, as I am with my M&Q and rather, broadly speaking, any NASDAQ exposure. The level that you and I were talking about yesterday was effectively 30,000, which had been support resistance numerous times. We got there, and then we started to bounce during overtime, and then we just kept bouncing, and we haven't really looked back. So there was no reason to take the position off, and thankfully being patient and having the discipline of respecting the technical level and letting the market tell me if, do we need a bail here? I didn't get jittery. So while I'm
Take a look at a daily, though.
I'm not thrilled with going into a long weekend with the bag that I'm holding, but there's also nothing telling me besides the fear of an extra day off that I shouldn't be doing this right now given the price action. Unless we want to throw it across.
I don't know that I agree with that last bit, because I think if you look at the daily here, what you see is you're not really doing anything. You've churned for the past 4 days, and you're churning against what is essentially the June high. So what has actually occurred here is a blistering uptrend from the lows in April has turned sideways, and momentum has been lost. So the question is, we're consolidating ahead of something. What are we consolidating ahead of?
Ilya,
I would say if the conversation next week is fundamentally, oh no, higher rates, which is the conversation to have because the Iran conversation is ostensibly on the back burner for who knows how long now, unless, of course, something goes wrong in these negotiations. We'll see. But the risk now is for the story about Iran to get quieter. And if it gets louder, it'll be for bad reasons. So if that's the setup and the Fed is the thing left after the dust settles, this is very well a double top contender as it is anything else. There's just no knowing. So we're within the bounds and we're going to need to see, but we're much closer to resistance than we are to support. So the risk reward in my mind isn't very good on the long side whatsoever.
Well, I obviously have a different view than you. That bounce off the 50-day moving average last week in the form of the bullish engulfing bar that we see here, right? Move below the prior day low, close above the prior day high, and get through both the 1 week and the 1 month with the bounce off the 50. That was a compelling signal. I see 1, 2, 3 candlesticks here. That looks like a Morningstar candlestick pattern, kind of, but it's again giving you a little scoopy right against the 1 month and the 1 week where we're finding support. So during this correction period where you're right, momentum has been lost. Momentum's been lost effectively for a month now. When you see the indicators, they've been breaking down for the past month, and yet prices haven't deteriorated. To me, that is the picture perfect. We're breaking out to a new level, consolidating, accumulation, not distribution.
I think you very well could be right. That would be textbook here, as would a double top situation. There's just no knowing at this point.
Well, I'll give the
for
Bears
me,
something
it's
to
a
hang on
range
to.
with risk reward tilted favorably on the downside.
I'll give you something bears to hang on to. We're entering what Ryan Detrick over at Carson Research, she put up a great chart today. I think that's what GAD used in the market measures this morning, but it was the June seasonality. So from since 1950, from June 1st through about June 17th, the market puts up about a 0.45% gain in the month of June. From June 18th through June 26th, it has historically given up all those gains. So Ryan Detrick over at Carson Research labeled this window the June swoon, as it were. It's the worst 10-day trading window of the year.
That's fun.
Okay, I'm not bothered by that. Particularly,
I'm not bothered by it either. I hang none of my bearish hopes on those kinds of things.
No. So look, I'm comfortable with the level of risk that I have right now. I recognize that we could just be range trading here. We could be going to the top of the range, but the little signs of momentum picking up have just been enough for me to say it's worth looking to see if this thing is getting ready to take its next leg higher. Because in fairness, it's been a month of sideways chop.
Fair enough. I mean, I think that is a quintessential distillation of exactly where we are in the markets. We're consolidating after a big rally, and the conversation is the consolidation going to break up or is it going to break down? And there's arguments that are reasonable on both sides, and positioning can be made reasonable on both sides depending on where you are in the range. So all of it makes sense. Now the price action just has to resolve which one is right.
I got some volume numbers here from our man behind the screen, Frankie. He says that 75,000 July 22nd VIX calls traded today in between, and 42,000 of the same Series 21 calls, but maybe those are closing. He said that we should go over and check the open interest in some of these strikes out in July, because there's been a rapid accumulation of open interest in the 25, the 30, and the 35 strikes here in the 33 days to expiration for the VIX options. Ilya, 25, 220,000, 30, 135K, 35, 316,000. Frankie points out that these Julys have more volume and open interest than all the other cycles he's checked. Interesting. Don't know what it means just yet, but someone is clearly thinking about what happens in maybe a month from now. Where are we in the midst of that cycle? Likewise here, Ilya, I'm going out to 61 days. How long is that ceasefire with Iran? 60? You're starting to see some accumulation around those big figures again. The round numbers, 25, 30, 35, as we get into the second half of the Iran ceasefire window. So, Ilya, yeah, maybe J.D. Vance gets his handshake with the Iranian president or foreign minister, whatever is going on with this Switzerland signing deal tomorrow, and maybe in earnest for the next week or two.
Apparently, he's signed already, right? Is he going?
Apparently, this is what I've seen. Maybe I have outdated information. Highly possible.
Okay.
But I would think that in the early stages of the negotiation, that's when the temperature is going to be lowest. They're going to try in earnest to get to a deal. If the frictions come, it's going to be after they meet and start talking for a little bit and be like, oh my gosh, this thing isn't going to happen within 60 days.
The president had to big brother JD Vance and sign it ahead of it and release it on Truth Social before he went. High comedy.
Ilya, top sector performers here today as we make our way into the final 10 minutes of today's trading session. Thinking about how broadly this market is trying to figure things out. Breadth is okay here, Frank. If you could get the exact an updated breadth number, the last one I have is from 20 minutes ago. I'm looking in terms of what sectors are performing well. Semis are soaring now. They're up over 6%, Ilya. That's your top performer for today's session. Really head and shoulders above everything else on the screen here. This, I believe, is going to be the second best day for semis since the rally started in March, because the best day that we had previously was June 11th here on our chart. Sure, maybe this market's bubbly, Ilya, but how do you step in front of, and I know a lot of people are saying that this thing is overvalued, how do you step in front of something that's putting in its best performance in the midst of a historic bull market?
You don't. It's very simple. It's not that you don't play. It's that you see where you are and you go, okay, the way I'm going to participate in markets is going to be like this versus like that. I think when you look at this, a low volume melt up with fading momentum, if you look at all of the momentum indicators here, you've got MACD and stochastics. I use RSI. It doesn't matter. They show the same thing. Higher highs with negative divergence. So momentum is fading. I think you look at this and you go, given the incremental, the marginal dollar, where am I going to spend it? Am I going to spend it buying a dollar that's breaking out of a major range, or am I going to spend it chasing semiconductors? For me, it's very clear which one of those is the more efficient and the more lucrative use of capital.
Okay, so did you see the news about Tim Cook last night? About Apple?
I did not.
Apple announced that it has to raise the prices on all of its devices because of the chip shortage.
That was 2 days ago, no?
I saw the news come down last night. But either way, I think
go on.
It's a really interesting point because this is now the cost pass through is moving into consumers because of the AI bottleneck.
Yes.
And that's something that Apple has shielded customers from for a long time, and now they're saying we can't do it anymore. It's going to impact our margins too negatively. You guys have to pay higher prices for this stuff because these chips are so dang expensive. Mm-hmm. Apple is the largest consumer products manufacturer on the planet.
Mm-hmm. Yeah.
That to me is that not a narrative confirmation? I mean, semis are up 6% today after that news. Is that not more narrative confirmation that there just simply aren't enough shovels to go around right now?
Well, that's the whole thing. And this is why I say you cannot extrapolate this in a straight line, because this begins to eat itself at a certain price point because it destroys demand. And then there is a bust. Just watch what's going on in China right now to get a great perspective on exactly how this looks.
You think
there is a property bust that has imploded?
Video? You think people are going to give up their devices that allow them access to YouTube and Twitter?
Absolutely not.
People lose their houses first.
That's
Apple's
right.
got people in a chokehold.
There is absolutely no way that society is backsliding on what has essentially been a social shift in the way everybody lives. It's like telling people that have spent a decade using a dishwasher that they now cannot use one, or having a microwave, telling them now you can never use a microwave. You must only cook outside on the open fire. Those are your options. Who's doing that? No one.
I walked in this restaurant once, and I actually doing prep work for food.
Yeah.
And the head cook comes in towards the end of the shift. He's like, "Hey, I'm getting a new dishwasher," and I go, "Oh, cool. When does it get here?" And he tosses me a towel. He goes, "You're already here. Get in the back."
There you go.
It's like,
there you go.
Glad I don't do that anymore. I just see lots of bottom left to top right in these markets here.
Yeah.
That to me as
Absolutely.
a momentum person is what draws me in. I know for shorter term traders, that's what draws them in. Some of these stocks are expensive. ASML, for example, one of these is a semiconductor equipment materials manufacturer. Their forward PE is already 38. This is a very expensive stock. The current PE is 64. It's not a Micron. But sometimes you just kind of have to throw those valuations out the window.
Do you though?
Yeah, Chip. Sometimes you got to race. Haven't you watched Chappelle's show? I don't know. What's a little sweetener here? What's a little sweetener here in ASML out the door? It's not your typical tasty trade, but Nasdaq's going out this week with a bang at 2.5% higher. You got to move through 1950 here in the short term.
And yet it's barely changed on the week.
I know. Keep hating.
I will. I absolutely will.
I know you will. So how do we size up a trade here? Well, this is a triangle of sorts, and I'm actually going to treat this as a bit more of a sideways consolidation given where we have some of these wicks coming into the market. So 1,800 up to 1,950, we'll call it 150 points, so 2,100. I'm going to go out a little bit longer to get that type of action here. I want to go out into mid-July, 22 days. Yeah, we do. 2,100, and where can we put a short call? Risking 3 to 1. I'm going to go 2,100, 2,120. I mean, again, Ilya, these markets look like they want to break out. I'm not going to get off this ride until it kicks me off. And it's working.
I mean,
they had ASML great last year. It's great this year.
ASML is a great poster child, I think, for where we diverge tactically here. It's sitting at the high. Now, you can choose to play for a breakout, or you can choose to say, you know what? If I'm wrong here on the short side, I'm wrong fast. But the risk reward is actually tilted better in the opposite direction, even just to stay within the range. Now, in fairness, it's tough to say those kinds of things with a single stock because it can blow past that high by a double-digit rise and scar you
may not move
deeply, and the indexes may not move. So for me, I'm not going to short single names like this because I don't have a death wish, but I am going to look at the indexes here and go, the risk reward is better on the short side. I've got plenty of duration. And more importantly, I've structured it as short call verticals, which at the time that I was putting them on were giving you better than 1-to-1 risk reward. What does that mean? It means that you're getting paid more upfront in premium than your max loss that you're locking in on the trade. And I will continue to harp on the fact that it's not free money because I don't trust the markets to ever give you free money in anything. They will find a way. Nature finds a way. But it's a very advantageous sort of setup. So for me, nothing changes. I've got 30 plus days on these verticals. I'm going to see if this top's going to hold.
Laura, let's quickly put up Refer a Friend before we get into this final minute of trading here and go into the close. It's a quick reminder. Go to tastytrade.com/refer a friend, tastytrade.com/refer a friend. $100 for the referrer, $100 for the referee, referral. I still don't know those terms, but it's still $100 in both directions. Recently extended as well. Thank you, Laura. That's great. tastytrade.com/refer a friend. Ilya, the markets are going into the close here at the highs with volatility continuing to slash 1636. It looks like we're going to get here on our VIX into the close. We have S&P 500 trading up to 75.78. We have our NASDAQ, that's 87 points for what it's worth, and the NASDAQ up 762, 2.52%. Oil prices, which were lower by about 4%, and right at the closing bell, that's what I want to see. Give me that exposure. 75.69 here in oil. It was down nearly 4% earlier. Now it's only up 0.42. The pains in gold today off 3.3%, and in silver, where it's off 6.7%. But the champ is here, Ilya. Semiconductors with another 5.8% rally. It's the second best day for semiconductors since the end of March. Ilya, I will give you the final closing thought as the bulls, they're going to take this one.
Sure. Strong end. Happy Juneteenth, everybody. Looks like the markets are not going to sell off before a long weekend on OPEX day. That makes sense.
That's nice.
That makes sense. That's nice. I think it's telling that gold is ending the day on its lows. That's wonderful. The dollar is ending the day on the highs. That's wonderful. That's the part of my portfolio that's heaviest at the moment. I think the most interesting and compelling thing here might be oil, which could be starting to find this wartime range bottom here. So I am very curious to get back on the long side there.
75, 64, 71 points higher, not quite the close that we thought we'd have. But you know what? Volatility stays down. Listen, we're off air tomorrow because it's Juneteenth federal holiday. And this weekend's also Father's Day. So to everyone who's going to be celebrating something in the next few days, hope you have a nice few days off. Remember to manage your risk when you can. Futures market opens on Sunday night, which is why we will be back for first call, 5:55 Eastern, 4:55 Central Time. This Sunday, it's true, June 21st. Be there. Until then, good luck out there.
See you then, everybody.
We are back. Good morning. You're watching Tasty Live. Jermal, you and I get the co-pilot seats this morning. Liz, Mike, I think even Dr. J, they're all out of office. So people have to listen to me on the Knicks parade day. It's going to be delightful.
It should be, man. I'm sure it's going to be great, man. It's always kind of fun, having had these here a little recently. No small humble brag. Again, not for a basketball team. It's been a long time since that happened. But, the Cubs and more recently, the Cubs was probably the most recent one. Also the Blackhawks. It's always cool, man, being in the city or being around when they have a parade. That's good times, man. So, congrats, bro.
Our request to do the show from the New York Stock Exchange, which just happened to be along the parade route today, was unfortunately turned down.
Of course. That's actually the cool part too. Like that you go by certain stuff, you know what I mean, on the parade. Like that's got to be dope. I mean,
it's been so long. Canyon of Heroes is actually downtown. A lot of people think that's up in Midtown, but that's actually downtown on Broadway as you make your way past the Wall Street Bowl there.
It's called that for a reason.
Yeah, no, it's gonna be fantastic. I'm very jealous. I may or may not be live streaming random CCTV footage across New York City to see the throngs of my fellow lunatics, fanatics, dare I say?
Yeah.
At 4 a.m., Jermal, the pens started filling up at 4. It's gonna be wild. I'm incredibly jealous that I can't.
You already know. We already know it's going to be a day, dude. And again, I mean, most people, I think about everybody at this point, it's a holiday tomorrow. So it's really on.
I screwed up so bad. Why did all of our coworkers have to have surgery at the same time?
I know, right?
What's up with that? Oh, is that a HIPAA violation? Well, Dr. J's tweeting pictures of it.
I know, right? This dude's tweeting pictures and drugs he's taking afterwards.
Yeah. It's like, maybe rein that in a little bit. Take one step back.
I couldn't do it, man. I would just be done. I would be done. But Dr. J's got his people, he's got his people his rabid fans. They want to know what's going on with him every second. Even